Imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down. Cut through the noise and set the context for you. Hear from top policy makers and thought leaders from the world of business and beyond. The big question really is, are companies using dark patterns to take you for a ride? The big question we're asking today, is the US heading towards a recession? The big question is, are we sacrificing our health at the cost of convenience? The questions you care about, asked and answered. The big question. Very good morning. You're watching India Market Open and expect another day of when nobody really knows what's going to happen and we all have our fingers crossed. That's generally the mood, isn't it, guys? You don't know what's going to happen overnight. I mean, that post from Donald Trump to he says, so-called supreme leader of Iran, where we know where you are, but we're not killing you yet. That's the big concern. Is US going to plunge headlong into this conflict?
I've never seen the leader of the United States, and that includes Donald Trump in his first term, send out a message like this for a major global leader. Because ultimately that's what you're talking about. Even if you put Kim Jong-un in that space, it's not something that you anticipate. That the President of the United States is saying, we're not killing you yet. So unprecedented times.
Unprecedented times for sure. But from an investing parlance, the markets world over are kind of holding out okay. There's not much damage to the tape, which is maybe a good thing. And guys, I actually let Tawana give the first update on this, and then there's this very interesting takeaways from the BofA Global Fund Manager survey, which kind of stood out for me. So we'll talk about that.
No, so just one more thing on that post, and we can pull it up, which I found interesting is he says, we won't take you out, brackets kill. So
in case you had any doubt about what we're talking about.
In case you couldn't figure out what he was saying by take out. So that was, okay. But US markets down in the red in regular trade as Israel and Iran conflict has risen. Now, apart from the post that we're talking about, the trading of missile strikes from both ends has only escalated. So, which is why you've seen the Nasdaq about 1% down, and I wonder if you can pull up the S&P 500 as well. The Dow futures are pretty much flat at this point because it's a wait and watch. Remember, the other big factor includes what the Fed is going to do. So there you have the Dow future. So positive and in the green, but very mildly. So I would say flat to positive. This is what Donald Trump is saying. He's posting, we know exactly where the so-called supreme leader is hiding. He is an easy target, but is safe there. We're not going to take him out. Bracket kill, exclamation mark. At least not for now. But we don't want missiles shot at civilians or American soldiers. Our patience is wearing thin. Thank you for your attention to this matter. So that's the post. Now, all eyes, of course, on the Fed meet outcome later tonight. Bond yields have dipped ahead of that Fed meet outcome, a 10-year at 4.39%. There was retail sales data which came in worse than expected, and that is also a bit of a dampener, but no major reactions. It's as if, markets are collectively holding their breath right now, waiting to see what happens next. Oil prices have risen a tad after that threat to the Iranian leader from the US president. Brent is at $76 or thereabouts. Asian markets have been mixed as Iran-Israel conflict has increased uncertainty. Economic data out of Japan has also been a bit mixed, but there you have it. The Hang Seng about 0.75% down, Shanghai flat, and the Nikkei about 0.5% up. I'm going to pull up the implied open for India very quickly and just give you a sense of what's happening there. Expect to open about 37 points down is what the implied is saying. But I would say range bound and waiting to find direction.
Yeah. So, just before we dive headlong into India, I thought this takeaways from the Global Fund Manager survey were interesting, right? So they say that the investor sentiment recovered to pre-Liberation Day. That's become a term now. Goldilocks bull levels as trade war and recession fears abate. The BofA Global or Bank of America Global Fund Manager investor sentiment improved to a 3-month high, and usually these things worry me. I like it when the sentiment is at the lowest, etc., because that's when you can make investments and feel good. But this is also good to know that the sentiment is higher. Cash levels have dropped to 4.2%, not worryingly low, but dropped to 4.2% from 4.8%. But the last two lines are the main, are the ones that stood out for me the most. That the fund manager survey is the most underweight the US dollar in 20 years.
Which is great news for us.
Which is great news for us if it plays out exactly as what people expect. Usually, if everybody's in the same lane, then you're probably in the wrong lane. So that worries me. And they say that and therefore BofA is quick to realize too, because they're saying that the 3 most contrarian trades based on this FMS sentiment are long US dollar. If you are that, then you are contrarian. Short gold, that is. Long US, short EU stocks, that is also the most contrarian. And long consumer, short banks, that's from a US parlance. But if you look at it from a global macro perspective, if you are long US and short EU, then you are a major contrarian investor.
And gold as well, you mentioned.
Yeah, so they say if you're long dollar, short gold, then you are very contrarian.
I don't know anyone who wants to be short gold right now.
So if you're there, you're contrarian. You remember Sandeep Tandon that day said that we think 3,500 is the peak. Yeah. But I think the biggest thing is 20 years, the fund manager survey is the most underweight the US dollar. If this were to play out, it's great for fund flows.
Yeah, speaking of in the wrong lane, well, practically everybody in India drives on one lane. So I wonder what that means.
Alex is thinking of his morning drive here. I can feel the pain.
That's a civics lesson here.
All right, so let's talk about what happened in trade yesterday. Just to set the tone, of course, for today. And it's not necessary that this is going to determine trade in any way. But yesterday's trade, you saw buying by both foreign institutions and domestic institutions, about 1,500 crore rupees, to the extent that you saw net buying by foreign institutions. Domestic institutions buying quite a considerable chunk, 8,200 odd crore rupees. Now, Indian equities did lose ground in that choppy session, and it was choppy. Global geopolitical uncertainty continues to cast that dark cloud. So what happened at the benchmark level? It lost about 0.4% or so, and the mid-cap and the small-cap index dropped 0.6%, 0.7% respectively. Now, they traded, the benchmark Nifty 50 traded lower through the session, but the broader markets actually dropped quite considerably, losing as much as 1% or so from the high point. They were trading in green territory, and then they lost ground. So pull up the market breadth line charts, if you will, because that market breadth actually shifted quite considerably through the day, midway through, or not midway through, but maybe about 1/4 in, you saw a drop quite considerably off the advances, and that ended up with a 4:9 ratio, 4 gainers for every 9 loser. IT remained the only bright spot, but it also gave up ground, ended with gains of about 0.7%, and defense continued to gain, though the rise was a little muted, gains of about 0.4% or so. The Pharma index was the worst performer on the day on account of that threat of tariffs that came through from Donald Trump. Now, metals also underperformed, losing about 1.4%. A part of that had to do with the big drop that you saw in Hindustan Zinc. And interesting that we hear about in OFS by the promoter Vedanta. You have a 5.2% fall that took place in Hindustan Zinc yesterday. Of course, there's also the capex plan that was announced later in the day. Hind Copper as well, losing about 3.8%, and the other big loser in the metal pack was GSPL, which lost about 3.4%. So underlying sentiment seems to be a little bit cautious. Of course, the global big event beyond geopolitics is the Fed policy.
Most certainly. And, you know, I think we'll all watch out for what comes out of the Fed tomorrow. A few people expect that it might be standing pat, but could they hint towards the end of quantitative tightening? Because that could be the big thing as well. It's not politically sensitive. You might be able to enact that. And I mean, that might be good news from a liquidity perspective as well. But from a trade setup perspective, just that same point, right? That markets were lower yesterday, but no deep cracks being seen for now, which is a positive. We've been highlighting that how that 24,600 level is the key thing to watch out for. So I think keep an eye out from that perspective. I was just thinking about what could drive, right? Everybody thinks of what could drive sentiment, market mood, etc. And if you think of it, because the Q4 ends on May 31st and Q1 begins on July, that's literally about 15 days left for the markets to find the next reason. And therefore, Q1 earnings, which are around the corner, are the next tick mark on the reason to react list. I mean, you could argue there is Fed, blah, blah, etc. But the main reason from a market's perspective would be Q1 earnings. And I dare say, when we start getting in those preview notes and the pre-quarter updates, you will see strong numbers because we'll be having the benefit of a low base in Q1 of FY25. So keep an eye out for that. And I think Tamanna or Alex will speak more about it, but I just thought, I mean, the aviation sector might be the one which might actually fly a bit low today based on some data that is coming. So maybe from a sectoral perspective, we've been talking about IT so much, we've been talking about metals so much, I just thought a different sector might be aviation to focus on today.
But see, most of the aviation issues, at least domestically, has been from an Air India perspective.
That too.
Advantage Interglobe, or Advantage Indigo is how it would seem. Though the clean chit from the DG say on 26 of the Dreamliners would give some comfort maybe to the to the airline, but are people going to book tickets on Air India in a hurry? I don't know.
I mean,
it's
the
a valid
jury is
point
out there, right? It's a very valid point. But I also thought that and I'm guessing either you or Alex are going to speak about it, but the GMR monthly updates.
Yes, it's on my list.
So aviation might be a bit low. So just keep an eye out for aviation stocks in general, airport and airlines, all forms could be.
That has been a bit of a, I think, shocker to people with what happened in Ahmedabad. All right, some of the other factors. I think the possibility of US entering Iran-Israel conflict is the biggest risk-on factor globally and for India as well. Everyone's going to wait and see how that plays out. And you're going to see that range-bound kind of hesitation, possibly in Indian markets as well. The Fed outcome is the other one. The consensus is that they won't change rates and there won't be any major action there, but commentary, of course, outlook on the economy, and if there is any move, like Neeraj said, on quantitative easing, could be some of the things as far as the Fed is concerned. In the Indian context, Nifty is in a consolidation phase with a broader range of 24,000 to 24,400 to 25,200. That is the range in which the Nifty seems almost stuck at this point. A clear directional move will likely emerge only after a decisive breakout in either direction. It has to be up or it has to be down. The 25,000 level remains a strong psychological and technical resistance at this point. It's the mountain Indian markets have to climb. The immediate support is 24,850, next level at 24,700. A decisive break below this could lead to further bearishness. Now expect range-bound trade as uncertainty continues. The India VIX has dropped to 14.4 though. This is a positive sign for bulls as it indicates decreasing volatility and fear in the market. So the underlying mood check is not negative. Remember, from an Indian context, economy is fine, no big shakes over here, consumption doing okay, monsoon is above normal. All of those signs are good. The Bank Nifty also has closed with a bearish trend on low volumes in yesterday's trade. So resistance at 55,970 and support at 55,650 as far as the Bank Nifty goes. But before we get to the F&O watch and F&O cues of the day, I want to talk about the big story this morning. The expiry days for BSE and NSE have been swapped. Expiry for NSE is now on Tuesday, while SEBI has agreed to BSE's proposal for expiry day on Thursday. We spoke to Sundaraman Ramamurthy, the CEO at BSE, on these developments. Listen in.
There is a shift in the expiry for BSE. Why have you agreed to shift your expiry from Tuesday to Thursday?
As you would recall, when this single contract weekly expiry came, the exchanges were asked to choose for an expiry day. At the time, there was a public announcement of NSE that they are going in for Thursday. So NSE chose Thursday, and so BSE took Tuesday. We were working with Tuesday. We were very happy with Tuesday as expiry. We had no concerns about it. But since NSE has requested for Tuesday now, in the overall interest of the market, we have taken Thursday.
Sir, since the time you moved your expiry to Tuesday, we have seen gain in market share for the Bombay Stock Exchange. How will this Thursday expiry change that dynamics?
Market share, as you call it, and the volumes in an exchange are a function of multiple factors. So at this point of time, taking just one factor, talking about it, would not be possible. We need to wait and watch as to how it spans out.
One of the effects of this Tuesday expiry for you was that you gained premium turnover as a result of this market share gain as well. Do you think that the premium turnover that you have gained will be retained once you move from Tuesday to Thursday?
Thursday has been traditionally an expiry day for a longer time in Indian markets. Thursday expiry has seen the premium market and the option market develop over the period of an entire week, next week, next to next week, next month. So as I said, multiple factors decide as to how the volumes happen and how the premium turnover's quality change. At this point of time, with only one factor, we cannot make any statement. In any case, traditionally, Thursday has been the expiry for Indian markets for a very long time.
Sir, can you clarify for us whether all contracts, weekly and monthly, now will have an expiry of Thursday, or is it going to be some contracts on Tuesday and some on Thursday?
The thought process of the regulatory framework was that once the expiry day is chosen, all contracts should expire on that.
What is the kind of adverse impact that you see on your transaction revenues, because your premium revenues or premium turnover is going to shift from Tuesday to Thursday and there may be a hit?
As I told you, transaction revenue is based on the market volumes. Market volumes are a function of multiple things. One factor alone impacting it cannot be prejudged. It should not be prejudged as well.
When does these changes come into effect? If you can give us an indication.
The regulators have clearly stipulated in the circular that till August 31st, the weekly contracts that has been introduced will continue. No fresh weekly contracts will be introduced further. From September 1, 2025 onwards, the new regime of the new expiry days will start happening. So we will do exactly in compliance with the regulatory directives.
Okay, so the jury is out about the medium to long-term implication of this move. In the near term, it's expected to hit volumes for BSE, and to that extent, it could have a bearing on earnings. We'll talk about that in more detail and also tell you what the brokerages are making of it. But the competition, what do they have to say? The National Stock Exchange, Sriram Krishnan, Chief Business Development Officer, spoke to us when the announcement was made, and here's what he had to say.
After the Monday expiry, which we had proposed, was put on hold in line with the request from SEBI. So I think the market participants, after the Monday expiry being put on hold, came back to us and said, Tuesday would be the next best thing. That's what's outlined. That was what was outlined in the consultation paper as well. And so we had applied for Tuesday expiry as our preference, which is in fact approved now by SEBI. So we're very happy to have received the approval and very grateful for the same.
Okay, we're speaking now with Gurmeet Chadda, Managing Partner and CIO at Complete Circle, joining in on the conversation. Gurmeet, a very good morning to you. Just, this was something that the street was anticipating. NSE, of course, it's an advantage for them. Their pre-market, pre-listing rate may be going up, but BSE is the listed player. What is the kind of impact do you see?
Hi, good morning. I think, if you see last 2 years, BSE's market share went up from almost being negligible to, 20-23%. And that also contributed to, the stellar rise in how BSE is also done as a stock. Even if you see last 1 year return itself, would be close to 200%. So I think there could be some near-term reaction because they could, in the short term, impact the turnover as well as market share slightly. Could vary from 5 to 10%. We'll have to see how it goes. I'm not really a derivatives guy to tell you that. But Tuesday had that advantage of 1 day extra. And so some impact would come. But I think over medium term, I agree that it could readjust. Also, Tamanna, I think just ignore the near-term reaction. I think there is a lot of FOMO in listed and unlisted space on exchanges and capital marketplace, and people are suddenly giving 60-80 multiples to these businesses without realizing that they are very, very cyclical, and they are dependent on mark-to-market moves. And for example, derivative contracts, as a significant percentage of the overall revenue. And one soft quarter for the market, which we saw when correction started happening in October, or maybe let's say 2 or 3 soft quarters, which a lot of retail investors haven't seen, could impact these businesses. So you can't assign that kind of earning multiple. So it's not like banks where earnings will deviate 1 or 2%. Earnings can drop 20-30%. We saw that even in CDSL, when the earnings became soft, or even in CAMS, because there is an impact of mark-to-market on this. So you just have to be careful. We don't get over, that FOMO may not make us, pay such high earning multiples to capital marketplace.
Hi, Gurmeet, morning. I just want to get a sense then, what according to you is fair value for BSE if it's trading at trailing 80 plus times, and even if you have a small impact on the EPS on account of this shift, what is fair?
See, I think, I'm no one to assign fair value. It's the market will decide, I'm too small investor to decide that. But, if you see globally, exchange trade at about 20-25 times. Now, India is, let's say, a high growth market, and we have new investors coming in. You can maybe assign a slightly higher multiple. But to assign 80-100 multiples, assuming market will keep going up and investors will keep getting added at the pace we have seen. So mind you, we now almost have 19-20 crore demat accounts. Maybe unique could be around 12 crores. So yes, we have a high growth trajectory ahead, but it will not be 40-50%. what we have seen post-COVID. So I think somewhere even the growth expectations have to reset. Also, if you see, algos are now making up a big part of the F&O volume, and regulators equally concerned on retail losing so much money in F&O, especially to these sophisticated hedge funds and long short funds. At some point of time, even the F&O volumes, which in India are even higher than United States, will also see at some point of time some moderation. Right, so I think any fair multiple should be in a way of, in my view, should not be more than 30-40 times. Even 30-40 times obviously is on the high side. But assigning 80-100 multiples and assuming this will do well for next 5-10 years typically leads to very, short-term disappointments.
Let me just one quick follow-up there. Because NSE will now, I mean, when you think of traders, right, on a Friday, when there is a weekend, they would want exposure to the closest expiry, which is Tuesday. So there is an inherent advantage in that session, in that ways to NSE. So the multiples notwithstanding, and I take on board the point there completely, but do you reckon, I mean, because the notes today that have come out are saying that, BSE will be able to recoup some of this thing by other factors, etc. But do you reckon that there could be, by virtue of the fact that there is valuations and NSE now has this inherent advantage, that we might see a soft start on BSE which might stay lower?
I think there will be some impact in the near term on BSE, definitely, because they also gained because of Tuesday expiry, and the market share almost jumped up to 22-23%. But if you see last few weeks, it has stagnated. In fact, last couple of weeks there's been a slight drop. So over a period of time, the day may not make a difference. But I agree on that Friday point completely. Also, if you see NSE on the unlisted side, was factoring this in. Just see the movement in the unlisted space last 1 month. It's almost up 40-50%. So somewhere in the market also there was a sense that the expiry may go to Tuesday, and some bit of reset in my view has happened to a certain extent. Markets are much smarter. They discount things much quicker than we do. So some of it has happened. Some of it may pay out, as you rightly said, over the next few sessions.
Okay. Thanks for that, Gurmeet. And, with that, starting on the stock list, BSE is the first stock on the radar. It's a thumbs down because of what's happened immediately. So that immediate impact will definitely be there. But think about it. If you want to play on the Indian capital market story and an exchange is what you're looking at, so until NSE lists, BSE is the only game in town and the only option. So keep that in mind. But just based on the news that has come in yesterday, BSE shifting its expiry to Thursday is a thumbs down. Here's what Jeffries is saying. They've maintained a hold with a target price of 2,900 rupees. They're saying expiry day shift may impact volumes a tad and scope to mitigate impact. Our interactions with market participants indicate a 5 to 10% impact on volumes in the near term and build up thereafter. They say BSE's ability to build liquidity in longer term contracts can offset this impact. Implementation of common contract note can aid market share in the cash segment. They are, though, trimming the EPS estimate just by 1 to 2% on lower volumes. UBS, on the other hand, is maintaining a buy with a target price of 2,633. They say the new expiry day can impact BSE's market share gain momentum. Change in expiry mathematically can impact 15% of volumes and loss of one trading day for BSE. We expect gain of volumes on non-expiry days, negating some loss of volumes due to change in expiry day. Goldman Sachs has maintained a neutral. They have cut the target price mildly, though, from 2490 to 2430. They say moving expiry day to Thursday says BSE could lose 3% of market share. They cut BSE's FY26 earnings per share by 2%, but FY27 and 28 estimates for earning per share are largely unchanged. Risk reward seems balanced to us. Just, a quick poll around this table, if at all. Yesterday we had a technical analyst come and say that if you see a 4 to 5% drop in BSE, buy. I'm not so sure you'll even see a 4 to 5% drop or get that opportunity today, because yes, the news is bad, but is it that bad? Can BSE make it up? I don't know. What do you guys think?
I think it's going to be a pretty steep fall. Whether it's 4 or 5%, I don't know, but it will be a steep fall.
See, I'm losing bets with Tamanna, so I'm not laying a bet, but I think it will be over 5%.
This is not a bet. This is just a sort of mood check.
I would be I think there will be an over 5% drop easy
Yeah.
on open. If it recovers later on in the day, maybe.
We'll wait and
but
see.
I think the drop could happen.
We'll wait and see. So on the news, it's a clear thumbs down because the news is negative, but how the street reacts is something that we're not in the business of predicting. We'll have to wait and see. We're in the business of reporting it. All right, Voltas is the other one that we're talking about, and a bit of a contrarian view here again that I'm taking, sticking my neck out on it. I'm giving it a thumbs up because even though they have come out and said that monsoons and the early monsoons have spoiled the game for anyone selling refrigerators and ACs more than anything else, cooling solutions. That sharp drop you're seeing in the intraday was actually at the same time as we talked about what analysts are saying in the closing show yesterday, and Neeraj had broken that story. But here's what the deal is with Voltas. So early monsoons have impacted their summer AC sales. That's exactly what Blue Star told NDTV Profit. Impact on volumes will be around 25% as compared to last year. Growth for full year will be at 10 to 12% versus 20% expectations, reducing production by 20 to 25% in first 2 quarters. Now, what Voltas has indicated in their analyst meet, 20 to 25% year-on-year dip in RAC volumes, industry-wide, and a similar trend for itself. They do see a pickup in June, particularly in North, which contributes 35 to 40% of Voltas's revenue. Channel inventory remains elevated at 6 to 8 weeks. Freebies, that's installation warranty, etc., are being rolled out by players. Despite subdued demand, players have refrained from broad-based price cuts. Now, here are what the brokerages are saying. Nuvama is retaining a hold with a target price of 1,190. So come down a bit from its earlier target price. They're saying it's retained its call in a medium-term target of gaining market share. Management expects international electromagnetic projects to stay weak. No new orders in FY25. Domestic should see a pickup in order flows and execution in FY26 and 27. They've cut their earning per share estimate by 8% for FY26 and 5% for FY27. UBS, though, is maintaining a buy with a target price of 1,725 rupees. They say the early monsoon has impacted sales, but it's priced in. The pricing is not seeing a disruption, but higher value add being offered. Despite weak demand, capex plans are on track, and the joint venture, that's Voltbek, is performing well. RAC to remain fastest growing category, although a non-linear growth. MK is also reiterating a buy with a target price of 1,450. They've said it's already built in a weak industry outlook. So here's the long and short of it. Early monsoons have spoiled the game for AC makers. Voltas has seen a bit of a hit. They've told analysts they're going to see a hit. Question is whether the street has priced it in. We might see some weakness at start, but overall, not that negative for Voltas. Jeffries yesterday said they prefer Voltas over Blue Star. Bharat Forge, no confusion here. This is a clear thumbs up today. The company has signed an MOU with Turgis Gaillard to offer an Aroc UAV in alignment to India's defense ministry. This is basically drones, unmanned aerial vehicles. That's what UAV is. So Aroc performs long-range surveillance missions while flying at high altitude and for long periods. Just the fact that defense is on such a hot streak, drones is at the forefront of every conflict, and you're seeing that with what's playing out in West Asia between Iran and Israel right now, which is why the thumbs up to Bharat Forge.
Absolutely. I have very clear indications as to how these stocks that I've picked or rather the fundamental developments should be rated. The first one is on a significant earnings win, or rather order win. Polycab India is a stock that I'm talking about, and it has entered into an agreement with BSNL for an order worth close to 6,500 crore rupees, and this is related to the BharatNet project. They are setting up that BharatNet in Karnataka, Goa and Puducherry circles, and this will be done over a period of 3 years of construction, but there will also be a period of 10 years of maintenance. This is to set up the middle mile network of BharatNet, and if I remember correctly, BSNL has rolled out quite a few orders, so it's certainly something to track. It's a pretty large order at that to be executed over a 3-year period. The second one is also an order win, EMS Limited, and this is in the sewage treatment space. It's not a very large company, just over 3,000 crore rupees or thereabouts. It's gotten an order worth 183.8 crore rupees from the UP Jal Nigam, and the order is for construction of components for sewage treatment in one of the cities there. The order will be executed over a period of 24 months. So watch out for this in trade as well. Usually there are reactions to these order wins and it could move higher at the open. The last stock is what Neeraj was referring to at the start and has to do with the aviation space. GMR Airports came out with its numbers of volume data or traffic data for the month of May, and it said that it saw muted traffic in May on account of, and it said this is the reason, geopolitical conditions. Remember, this is when Operation Sindoor took place, and so it affected travel plans to a large extent, and they do control Delhi Airport. That is the airport that saw a considerable drop. In fact, domestic passenger traffic dropped as much as 6.5% at GMR's Delhi Airport. The overall traffic handled rose about 0.8% in May to over 1 crore. Why is this important? Because it is the summer season and it is usually when a lot of people travel for the summer holidays. This is a very strong period seasonally for the aviation space, including airports. The bright spot, however, for GMR is that Hyderabad and Goa saw considerable rise in traffic. Hyderabad saw 15.3% increase on a year-on-year basis, and Goa rose as much as 9.6%. They handled the new airport. So that should be taken as a positive, but the story is that the volumes have gotten affected.
Okay, very quickly, the three stocks on my list. One is Hindustan Zinc. So Vedanta is going to sell 1.6% equity at a floor price of 452 per share. This is a discount of 7%. The point is the quantum of equity that is coming out is a lot lower than what was anticipated. So keep this in mind. And Ugro Capital is the second one on my list. They're going to acquire an SME lending company, Profectus Capital, for 1,400 crores. Profectus about 3,460 crores of AUM. The interesting piece is Ugro itself is, the market cap is 2,000 crores and they're making an acquisition of 1,400 crores. That's a very large one. Would love to understand from the management what's prompted this. So they'll be on air and we'll talk to them about it. Zydus Wellness is interesting because PPFAS mutual fund has bought 46.27 lakh shares, 7.2% equity at 1,900 a piece. So therefore, watch out for this one. Very conservative fund management, and if they bought such a large quantity, maybe you want to research the business as well. Of course, Alex did a show recently with the PPFAS think tank, so you might want to tune in for that as well. But Hindustan Zinc in particular, guys, was interesting simply because we kind of spoke about this on the Heard on the Street segment yesterday. Somit alerted that there could be, this was in the offing, but the fact that the quantum of equity on offer is a lot lower than what was anticipated.
Just quickly on that Zydus Wellness thing, because anytime Parag Parikh does an acquisition like this, you think about valuations, you think about earnings potential, all of those things get discussed very, very minute detail, right? So we were looking at the trailing, it's 36.3 times, which for a consumer stock is not very, very expensive. Last 5 years, EPS growth is 11.3%. And so if you extrapolate that, that's what, assuming about a 32.5 times 1 year forward, not very expensive from a consumption standpoint.
Just the size of the block acquired by Rajiv Thakkar and team at one go.
So obviously exciting because it's a house with pedigree like Parag Parikh coming in, so that brings excitement. But just generally talking about the appetite for blocks, it's as if some EOSS sale is going on, end of season sale in the street right now.
Insane. Vishal Megamart, a case in point yesterday.
Yeah, so that appetite out there, no matter what else is happening in the world.
Which points to the flows data that we have been seeing from domestic institutions also.
And the cash that they were sitting on.
Yeah, so if you want to read the tea leaves right now about what the market mood is, I don't think anyone can come out and say that it's negative from any perspective. Perhaps only that people want to wait and watch because there's things happening which is outside our purview. But, Neeraj, you spoke about Hind Zinc, and I think that is one of the big stories of this morning. In fact, let me get in Hiral to talk about what brokerages are saying on this deal.
Thanks, Tamanna. So it's interesting because along with the OFS that is expected today, you have a 12,000 crore capex that the company did announce yesterday. What's interesting is that the capex is going to be funded through internal accruals as well as debt, on the back of which you have a Numava who's gone ahead and maintained a reduced rating. They have a target price of 403. What they are indicating is that the capex that has been announced actually provides volume growth visibility from here on, because this is a 3-year plan. Secondly, they're targeting to increase use of renewable energy to 70% of the total energy by FY28, which will provide tailwinds from a margin perspective to the company. And a free cash flow generation is expected by FY27. The overall capex will largely be met by internal accruals as per Novama. Secondly, you have a Motilal Oswal as well. They've gone ahead and maintained a neutral, and they have a target price of 486. The major reason they are seeing is that the zinc smelting capacity is what will be increased from here on. The project to be completed over 36 months, and basis this, they're expecting a 10% rise in silver price, which could boost the EBITDA for Hind Zinc by almost 550 to 575 odd crores. So overall, yes, there is positivity on the back of the capex plan, but no major change in terms of ratings by the brokerage houses.
That's interesting. I think it'll be a positive this morning because of what is coming in. You'll hear from Arun Mishra as well of Hindustan Zinc, so we have the story covered for you. We'll take a very short break, but on the other side, we're coming back with the other stocks that you should have on your radar and what your top calls should be. We're also speaking about the IT sector, which seems very, very resistant to all of that turbulence. It was the only sector which closed in the green yesterday. So that conversation after this break.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he
Back with India market open. We might start off slightly soft. The question is, can we build on from there or will we stay sideways? Now, one sector that is defying all forms of negative sentiment is information technology, and somebody who tracks this very closely, amongst other things, of course, Sandeep Agarwal, fund manager and co-founder at Sovilo Investment Managers. He manages the whole PMS, but his erstwhile avatar had him tracking IT in particular very, very closely, amongst other things. So Sandeep, naturally when we think of IT, we think of you. Good morning, thank you for joining in. What explains this newfound optimism at IT? You could look at it that it's playing tic-tac-toe, but the optimist will say that every single point of time that IT is being sold, it's being bought into. And a lot of commentary from sell side around how the second half might be positive as well. What are your thoughts?
Yeah, hi, good morning, and thanks for the interview. But so, you know, if you see fundamentally, and unfortunately, fortunately, we are analysts, so we always see at fundamentals. So if you see fundamentals, then, you know, this move which has happened is really surprised us, because this year, if you see the commentary of any company, and even if you take their optimistic guidance, the valuations which are there, they are not justifying the growth. The growth rates are not justifying the valuation. And I think, you know, there is something to do with our expectation that, you know, Trump has till now delivered on whatever he has said on terms. He has created at least some noise around tariff and everything. So people believe that even the corporate tax rate, which he has been talking about, cut, that will come at some point of time. And if that happens, then there will be a lot of additional money which will be there with the companies, and they will probably go and invest in tech, because tech is definitely getting a lot of spends, because people want to be ahead of the curve, they want to spend. So one could be that. Second, I think this geopolitical and this Middle East crisis also push a lot of uncertainty, and because of which also maybe there would be some buying. But fundamentally, if you see the numbers, the commentaries, honestly speaking, there are no places where there are any kind of value left. Everything is super expensive. So only people who want to hide as quasi cash or dividend story, maybe because of that reason they are doing well, or maybe people are buying the index funds and there is a weightage of this stock, so they are doing well.
Okay, so I think, Sandeep, the argument has been with people that we've spoken to that something like a Wipro has guided towards such bleak future and such bleak outlook on earnings that it can't get worse than that. And if anything, it might get better. So, and I guess to a certain extent, what you're saying is right. We've not seen anything materially, fundamentally change on the ground, but you are seeing a few more deals getting signed, a few more extensions of deals. Is that not enough to move the needle for you?
No, so deal momentum is good, to be honest. Last quarter when results came, everyone has given that deal number. And the problem is that that deal number is generally very small amount of the total revenue which you have to do, because this business is like 70% is repeat and 30% is what you have to go and hunt and get new. So that momentum is good, but it doesn't suggest that there could be, let's say, a 10% growth in any of these companies. And if the growth cannot be even 10%, we are giving upwards of 20. That is 2-3 peg ratio for industry which is matured for the larger names. I don't know how do you justify that. And I personally believe that if this Middle East crisis would not have been there, or it is that they don't have good dividend, means probably it is only a hiding story which is there to call, because at this valuations and this growth, honestly speaking, very tough to buy.
I mean, I know you can't give stocks right now, Sandeep, and good morning, Tamanna here, but are you long IT? Are you buying into this momentum that IT is seeing? Just give us some directional idea.
So, we have bought a lot of IT in October 2023, where there were when people started, writing off the sector, we got everything damn cheap. And we have a firm belief that the stock price is building in every negative which can happen over next 3 years. And we started, trimming off last year. So we have trimmed off everything almost in last 6 months. We don't have anything. And means the recent move of last 1 month has hurt us also, but it's fine, because we cannot have something which fundamentally doesn't justify the valuation. So across the board, we feel that valuations are very, very stretched. ER&D is a super play.
One minute. So have you exited all your IT positions from the last 2 years?
Not 2 years, last 6-7 months, 80-90% of the positions have been trimmed.
Okay, so that's the headline there from Sandeep Agarwal. Thank you so much, Sandeep. So Sandeep Agarwal, who tracks IT, understands the space, has trimmed 80% of his positions in the last 6 months. So there you have it. The Nifty IT in the last 6 months is down about 13.5%. All right, thank you for that, Sandeep. Always a pleasure speaking with you. Let's get on. Somil Mehta, Head Alternate Research, Mirai Asset, Sher Khan, and Mayuresh Joshi, Head of Research, Market Smith, on the show this morning. Very good morning to you, gentlemen, and thank you so much for joining us. So let's start with where you're seeing the Nifty and the Bank Nifty going.
Good morning to everyone. We've been stuck in this range for a little while now. We're not going anywhere. But yes, the resistance is 25,200 and the support is at 24,500. So this is the range which we are in for the last probably one and a half month now. And overall, the undertone definitely remains positive, and there is a lot of sector rotation, and there is a lot of stock-specific action. And at the moment, I think we should be more focusing on positive momentum stocks, positive sector rotations. Buy on decline should be the strategy for where we find the momentum. Right now, we can see that IT is doing good. Financials, a little bit of financials are doing good. I think the large cap banks would be doing good in a couple of trading sessions. FMCG is trying to inch higher, and metals are just trying to get into a positive momentum. So I think at the moment, IT and financials should be the focus, and that's where my bets are.
Somil, I guess to a certain extent you can liken it to running on a treadmill. You're not going anywhere, but you're still making a little progress. So from that perspective, what would you buy at this point? What are your buy calls?
As I said, IT is looking great. Financials are looking great. HDFC Life is looking good. A small consolidation has broken on the upside. So HDFC Life looks great in the short term. Stop loss would be 758 and the target would be 800. The second one from the IT space, the large cap name, TCS, again, a small flag pattern breaking on the upside, taking support at 20 and 40 daily moving average. After a very long time, there's a breakout here. But TCS stop loss would be 3430 and targets would be 3700.
All right, so there is an IT stock in your buy list today. Mayuresh, I don't know if you heard the conversation with Sandeep just a short while back. I'll reiterate the point that we're focusing on, that he bought a while back and then he's exited all of his positions over the course of not all, but 90%, 80 to 90% over the course of the last 6 months. So basically he's used the pop that you've seen in IT stocks to exit. Is that something that seems appropriate to you? And I'm not asking you to comment on the strategy. I'm saying in terms of the valuations, is that egregious at this point? Does not justify the earnings potential?
Morning, Alex. Two things. One, I think in terms of what the street believes, that earnings might start coming back as we head into the second half, putting back everything that is as a headwind to the sector. What happens in terms of tariff impositions, what happens in terms of the tax cuts, what happens in terms of geopolitics, and how does that affect discretionary spending. I think there is a hope that the second half of this calendar year, orders, pricing should largely come back, but it is dependent on too many things and too many variables as we speak. So as a strategy, we obviously have some positions in our global portfolio for a few mid-cap IT stocks, but they've been taken at way lower levels, Alex. So stocks like a Persistent, as an example, or a Coforge is something that we might keep on holding. But the logic is that to add at these levels seems to be a little bit improbable. Valuations, as you rightly said, a tad bit on the higher side as far as their standard deviations are concerned on average over the last 5 years. And with the expectations of what can come through and what cannot, we are not trying to build in guesstimates on what can or what cannot happen. So in that sense, there is hope that the second half there will be some element of respite, but will they go through a periodicity of pain, at least for the next quarter or two? I think the possibility remains high.
Mayuresh, good morning. A clutch of newsmakers in today's trade, and let's start off with some of those, right? So we've spoken at length about BSE and NSE, so we'll leave that out. Hindustan Zinc was down in trade yesterday, presumably due to this upcoming stake sale, though it's a much lower quantum by Vedanta being sold, and at a point of time when silver prices are skyrocketing. Is this an opportunity for somebody who wants to invest in a metal stock?
Morning, Neeraj. So I think if somebody's taking a bet in terms of where the silver prices will move significantly higher from the current level, and there are sufficient indicators to probably point that out, both in terms of demand dynamics, both in terms of end user applications, in terms of inventory levels, and the correlation that silver has to gold. So I think there are quite a number of triggers for silver prices to move higher as we speak. Obviously, I think Zinc becomes a key beneficiary in terms of silver production, and they do have the capability in terms of upping silver production as commodity prices move in their favor. Having said that, I think the expectation in terms of how other businesses are expected to move ex-silver, I think that is the bigger question for Hindustan Zinc. Obviously, expectations of demand coming back, where there again is some element of hope that in the next calendar year, demand should start coming back slowly and steadily, specifically as far as China is concerned, Europe is concerned, and therefore pull up LME prices to a certain extent. I think the complete operating leverage is not getting played out because LME prices still remain depressed because of lower demand. And therefore, I think silver prices might move higher, but the other commodities that Zinc produces might still be circumspect as we speak. Obviously, I think the biggest beneficiary...
Mayuresh, are you buying Zinc this morning?
No, absolutely not. I think the logic is very simple, Kaman. I think the other commodities is not something which is going to play. I mean, it's going to play positively even if silver moves higher. And a 6% dividend yield is a compelling factor, but not the only compelling factor to go out there.
Okay. And what about you, Somil? Buy, sell, hold on Zinc?
Hold, I would totally avoid at this point of time. It's had a very good rally on the upside, and I don't see anything very in the very short term. I'll just keep away from the stock at the moment. Wait for a good opportunity to buy into these stocks, because metals have just started moving up. Hindalco, Tata Steel, and all of these stocks have just started moving up, and I'll just wait for more positive momentum to get in.
Okay, so avoid for now from both our fundamental and technical analysts this morning. But focus on retail. Avenue Supermarts has expanded in the country's most populous state, Uttar Pradesh. Morgan Stanley is maintained an underweight, but is quite bullish on the expansion. Mahima is joining us with details of what Avenue has announced and what Morgan Stanley is saying about it.
Right, so as you rightly mentioned, Avenue Supermarts has announced expansion in UP market and has opened a new store in Ratan Mall, that is Agra. Now the total number of stores for Avenue Supermarts stands around 421. This is the first major store opening in the state of Uttar Pradesh, which is one of the most populous state. In terms of what MS is saying about this expansion, they've maintained underweight with a target price of 3260. They're saying that DMart follows an ownership model for its retail stores and follows a cluster-based approach for store expansion. They are viewing this store opening expansion in the UP as a positive step. They'll closely track this entire move of DMart and company's pace of expansion in the state, and they'll see as to how the company actually caters to the opportunity that they have in terms of opening large stores in UP. Now, in terms of what the management also said in the Q4 con call was that they're seeing better growth in tier 2 and tier 3 cities, so their focus will be in the tier 2, tier 3 cities, and they also mentioned that they're seeing relatively larger like-for-like growth in cities which have fewer stores. So their strategy for FY26 is surely going to be expanding in tier 2, tier 3 cities and cities where they have lesser stores, so that the like-for-like growth goes up. So this is the overall view as to how this is being viewed, this expansion of Avenue Supermarts in Uttar Pradesh is being viewed.
Yep. Okay. So Mahima, but one large retailer to another, because Trent in a clutch of brokerage calls that have come in, right, which remain fairly bullish. What are they saying?
Right, so basically these brokerages have come out with their readings on the annual report that Trent posted last week. I'll start with City on Trent. It's maintained buy with a target price of 7,600. What they're saying is that the 200 store expansion per year is likely doable, and this is doable ensuring the quality as well as experience, economics and location as well for Trent. This is especially for Zudio. They're saying that new stores will reach high throughput maturity within the next 12 to 24 odd months of opening, and majority of same-store sales growth for Trent is volume-driven, as Trent does not take any price hikes. Value retail is not a zero-sum game, and there will be multiple winners in this retail space. And Trent barely consolidates or closes stores, so this will lead to better store economics as well. Morgan Stanley again has maintained overweight with a target price of 6,359. They're saying that management has retained confidence of achieving the ambition that they had mentioned back in 2023. They're aiming to grow 10x bigger in the near distant future, and in terms of how the company is expecting to achieve this 10x revenue in 10x revenue as compared to FY23 to FY32, the focus remains on quality of stores portfolio as well as increasing the store density in proximate markets. The company is expanding into underpenetrated markets and also increasing revenue growth and share in the micro markets as well. So they are also kind of targeting the tier 2, tier 3 cities going forward in FY26, and of course cities where they have lesser stores in terms of expansion. Lastly, return ratios according to Morgan Stanley have improved to record levels, and that has aided better profitability, and also improving asset has also overall asset turns has also improved for the counter. So considering all of this, both of these brokerages are positive on Trent.
Okay. Thanks a lot for that, Mahima. So 25% CAGR revenue growth is what Trent is forecasting, apparently, right? Because they're at 17,000 crores in FY25, 80,000 crores by 32 means about 25% growth. So that's pretty strong as well. Somil, between the two, is there a trade or a medium-term investment that the charts might be suggesting, DMart or Trent?
I'll be cautious on both actually. Speaking about trend, trend is just at a very, very crucial levels at this point of time. It has started correcting a little bit in last 1 week, and I'll be a little cautious because it is at 200 daily exponential moving average, which is 5,600. It has been trading between 57 and 54. So I think it is forming a head and shoulder pattern on the hourly charts. If it breaks below, then I think the next level to watch out would be 5,000 levels on the downside. So I'll be a little cautious. If it closes about 57, then I think the next rally start on the upside. But it'll be a little, cautious at this point of time because the momentum indicators on the larger degree and on the daily charts both are on the negative side. So a little cautious here.
We need to slip into a break. We'll talk about this with Mayuresh as well. In fact, on the other side of the break, would want to know if fundamentally a 25% CAGR growing company like Trent is an investment candidate or no at these valuations. We'll be right back. Stay tuned.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down, cut through the noise and set the context for you. Hear from top policy makers and thought leaders from the world of business and beyond. The big question really is, are companies using dark patterns to take you for a ride? The big question we're asking today, is the US heading towards a recession? The big question is, are we sacrificing our health at the cost of convenience?
Welcome back. You're watching India Market Open. Now, clearly, one stock that is in focus is Hindustan Zinc. Now, it's brewing. Yesterday, the stock was trading ex-dividend, and the company did go ahead and announce a 12,000 crore capex. And this is not it. Their peak capex is going to be around 32 to 35,000 odd crores, and this will be between FY28 to FY30. But let's welcome in Arun Misra, CEO and whole-time director at Hindustan Zinc, to discuss more on this. Mr. Misra, good morning and welcome to the show. The board has approved setting up of a 250 kiloton integrated zinc metal complex. This will be at Debari with a total capex of 12,000 odd crores. Taking into consideration it's a part of your company's 2 times growth plan, if you could help us with more details.
So we had announced, if you recall, after about 3 months back, that we are launching a program of 2 million ton per annum capacity augmentation. That is currently 1.1 million ton, will go to 2 million ton. So that means we have to add about 0.9 million ton of metal capacity. And we want to do that by expanding our current mines, put up new mills for processing the ore, and then put up expanded capacity of zinc smelting as well as lead smelting, and then put up additional silver refinery to get an overall target of about 2 million ton metal, and which will be roughly 80-20 ratio between zinc and lead. And we will roughly 1.6 million ton of zinc and about 0.4 million ton of lead, and about 1,500 tons of silver. So with that broad numbers, we started work. And we said that within a span of, in a time period of 2 to 3 months, we will take board approval on part by part expansion and then announce to market. So this is not a phase of expansion. This is only phase of announcement. And first phase of announcement, we are announcing today 250,000 tons of zinc smelting capacity in Debari. Of course, it will have its own fumer and it will produce about 30 tons of silver per annum. And also we will expand Rampur Agucha mine, and we will put up a mill there to process the ore. And this overall about 12,000 crore expenditure we will have, and we'll take the capacity to about 1379, take it roughly about 1.4 million ton of metal producing capacity.
Right, so this is for the 12,000 odd crores. What is the priority with regards to the remainder 20 to 23,000 odd crores which will come up by FY30?
So we will put up another about 450,000 tons of zinc smelting capacity, around 200,000 tons of lead smelting capacity, and another about 700 or 750 tons of silver refinery. Also the fumers and all that we will put up along with the electrical and effluent treatment and other infrastructure which are required. So after this first phase, we are still on the drawing board for the balance phase. It's total expenditure that will require. And I'm sure it's another 30 to 45 days we should be through with all the numbers, take all board approvals and all that, and then come back and announce in the market. We are very keen on expanding the capacity to 2 million ton. And we should launch all programs on the ground in a manner of maybe 3 months from now on.
Okay. And what's the kind of revenue recognition that you're expecting on the basis of this capex?
No, so some of the capacity will keep coming up early, and some of the facilities will be like this 250,000 tons capacity in Debari. This will be very most modern cell house that we will have, very high efficiency, low cost of production. We will try to produce value-added product out of the SHG that we produce, and it will hit the market faster than the other facilities which will come up. So entire revenue that will come up after about 3 to 4 years from now on, we look at doubling our revenue and doubling our EBITDA as well.
Okay, and what's the IRR that you're expecting, in terms of this project?
So as of now, this particular expansion would have about 14% IRR. It is much better than our borrowing rate because we are a AAA rated company. So this is better, and we will also, this will even be better if we consider a little bit of debt and then equity IRR will be far better than even 14%.
Mr. Misra, the key question that comes up over here is then what is the free cash flow generation profile expected to look like during the peak capex years? Because Hindustan Zinc being a dividend rich company, how are you expecting that to pan out?
No, so it's not a big issue for us as far as free cash flow is concerned. we will try to manage within our annual capex outlay that we have. And a little bit of extra cash requirement is there at that particular year that we may fall back upon debt if required, to keep our cash flows safe.
Okay. And because the project is going to be funded through internal accruals and debt, does this in any way change your dividend policy?
The dividend is a matter of board, but nevertheless, I can say in this entire project, in our thinking, nowhere it is in our mind to change the dividend policy or to deny shareholders from the right of rightful access to whatever gains that we make. We will ensure that that remains unaltered. At the same time, we will have to look at what is the net value that we are giving to the shareholders. I am sure the market will appreciate the investments we are making, the revenue being doubled, the EBITDA being doubled. I am sure shareholders will appreciate the much bigger return that they are going to get.
Okay. In addition to that, are you aware of any stake sale plans by the government or promoter Vedanta? Because the government stake sale plans have been put on hold right now. But what are you hearing, if you could dwell on that?
No, frankly speaking, sitting on from my position, I can't comment on any of such speculations. So as far as we are concerned, we are to create more and more value for our shareholders. This announcement of creating additional capacity in that direction only.
Okay. Let me put it this way. How will Hindustan Zinc benefit if, the government sells out completely?
No, benefits in the sense it will be more, our market cap will be on market driven. Right now the float in the market is much less and most of the shares are between the two blocks of Vedanta as well as the Government of India. If there is more float in the market, perhaps the real value of the share can be discovered, and we hope the market cap only improves from there.
All right. Very lastly, I'm sure you are seeing the way Iran-Israel war has been developing so far. How does this impact Hindustan Zinc? Because I do understand there is an export portion, still small in terms of volumes, but what is the overall impact?
No, our exports are not much. About 20% of our product gets exported. So roughly about 20,000 tons or 15,000 tons a month that we export. And we export mostly to Southeast Asian countries and our neighboring countries, Nepal and other places. Some amount we do in the Middle East, which is in Dubai and Saudi and countries like that. We don't have any business in Iran. We don't do anything there. Neither do we do any business in Israel. Unless there is an overall instability in the Middle East, I don't see any risk in our business as of now.
Right. So no major risk coming in so far with regards to the war in the Middle East. But thank you, Mr. Misra, so much for joining us on the show and sharing the views. So Tamanna, clearly, the pre-open trade is still indicating a 5% outtake. It's going to be interesting to see how the OFS and the capex plans impact the counter as it stabilizes.
Yep, absolutely. Thank you for that. So that was a conversation with Hindustan Zinc. Thanks for that, Hiral. Just some movers, early market. Hindustan Zinc definitely 5% down, but so is BSE in the pre-open session. So we've seen the end of that pre-open session. So is Voltas actually. Voltas also seeing a mild downtick as we close this portion of trade. Blue Star down about 1%. So AC makers under pressure. Manappuram and Muthoot, gold financiers also may see a bit of pressure at open. In terms of what is buzzing, look at a Polycab. Polycab after that pretty substantial win from BSNL, up about 2.5% in pre-open. Vishal Megamart, a huge block came off, and we've seen the appetite for some of those blocks. DLF in focus, they have a new project which has sold out within a week, and an ultra-luxury project as well. In fact, let's go across to Chandan Taparia, who's joining in now. Mayuresh Joshi is still with us. Chandan, let's quickly get your take on the index before we move ahead.
Good morning, Tamanna. Thanks for having me. So indexes got stuck in a range. The good part is that supports are intact. Whenever we go near 24,442, somehow buying interest emerges, but near 25,050 to 25,200, the index keeps on finding kept upside, or due to one or other reason, it's finding pressure at higher zone. But I believe somehow the consolidation which is happening from the last 26 trading session is going to be on end very soon. And once that decisive breakouts happens about 25,000 marks, market will see a next leg of rally which can take it to us 25,500 to 26,000. But I believe still we have few more days to get that consolidation breakout. But for immediate point of view, I believe till it holds about 24,700, look for a bounce towards 25,000. So I'll play the range between 24,700 to 25,000 marks on immediate basis.
I see, Chandan, that you're reasonably positive on IT as well, because I think you've picked one to buy this morning.
Yeah, so Nifty IT is started to witness some buying interest from lower levels. In fact, we have seen a consolidation breakout on the weekly and the daily chart, and every small decline is being bought. And the good part is that IT is also working as a defensive nature, and we have seen good buying interest in counter like Tech Mahindra, HCL Tech and all. So IT is on our radar, and we believe that selective IT counter could be in focus. So one name which I would like to mention here is buy on Tech Mahindra. So with support of 1685, I believe Tech Mahindra can head towards higher zone of 1777 marks. And apart from Tech Mahindra, I'm closely watching persistent system, where a small follow-up could lead to the fresh breakout. If it manages to hold 6,050 marks, then move can be seen to our 6,300 level. So most of the IT counter are in radar. Here we would like to pick Tech Mahindra and persistent system.
Specifically, you also have a view on AB Capital, right? What's the call here?
Yeah, so positively on AB Capital, after a long time, we are witnessing a massive breakout on the yearly chart. In fact, in 2017, the stock was quoting near 255, then it fell to 37 in 2020. So a 9 months long breakout is happening in the counter, and from last 5 to 6 years, the stock has been making high top, high bottom. On the weekly chart, we have seen a surge in price from 188 to 255. So multiple year breakout is clearly visible, and which can lead to the fresh leg of rally. So we are recommending to buy with support of 247. And here the counter has potential to rally towards 270, 275 marks.
Chandan, can I do a quick rapid fire with you, because there's just so many stocks in focus today. So we'll do a buy, sell, hold. Okay, let's get on that list. A BSC, let's look at a Hindustan Zinc, let's look at a DLF.
Yeah, so let me first comment on DLF. Here, buy. I believe positive bias could be there with support of 835. Look for a target towards 880. BSC, I think let it see the opening. Major trend is positive, but short term might see some corrective move due to some changes which we have noticed. But I think better to wait and watch. Hindustan Zinc, again, some decline could be seen, which can take it towards 470 marks.
Okay, Harsh is joining in now with the top brokerage call of the day. Harsh, we're very close to opening, so let's go through it quickly.
Well, yes, you have a Nomura big upgrade coming in on IndusInd Bank. They've upgraded it to a buy. Target price also hiked from 700 to 1,050. That's a 28% upside even from here. They believe the past few months have been turbulent for the bank. The bank has undergone also a significant cleanup. Compare the IndusInd case to an RBL and yes, there were leadership exits plus there were asset quality issues, but IndusInd Bank as such has healthy liquidity, good capital position, and therefore is better placed. Strong business model, at least in the retail segment, and that is expected to continue. Faster improvement in profit in the medium term versus RBL and yes, that's what they are penciling in. FY 27-28 EPS estimates have been increased by 14 to 16%. They are expecting ROA, ROEs to also improve. The outlook seems better, and especially the valuations. They're saying 0.9 times 1 year forward looks inexpensive.
Okay, IndusInd also in focus this morning. Very quick call on IndusInd, Chandan.
Well, looking at IndusInd Bank, in fact, the bank Nifty has been moving in a range, and IndusInd Bank got stuck in a range. However, the good part is that 785 is major support, but at the same time, it has been making lower highs, lower lows. So I believe if it declines towards 785 or with the support of 785, we can see a bounce towards 835.
Okay. I didn't get your view on BSE. It's an avoid, Chandan, at this point?
I think let it open, and after the opening, we will see whether it holds the key moving averages or not. As of now, early support could be near 2,200 to 2,300 marks.
Do you see anything worth buying at the start from the pre-open rates? Chandan, 10-second answer. Do you see anything worth buying right now?
Yeah, I'll focus on selective name from IT. So as I mentioned, AB Capital from Capital and Tech Mahindra from IT could be on my radar as of now.
Mayuresh, stay on. We'll talk to you about what to do with the BSE if you have it in your portfolio. One thing is that you want to buy it at lower levels. Second is you may still want to get out from it at the current valuations as well. So we'll kind of do that conversation because it's just about 15 seconds. Okay, some updates on the screen on the geopolitical side as well. There's a call between Prime Minister Modi and Donald Trump, and both leaders have agreed to meet soon. So that's important too, by the way. But let's get the first rates going this Wednesday morning. We're starting off lower, about 1/4 of a percentage point lower. Similarly for the Bank Nifty, I reckon IT almost similar, 1/3 of a percent. Mid cap, small cap should not be any different. 0.2% for the mid cap index, 0.16% for the small cap index. Let's get the heat map up on the screen. A fair degree of red, I would presume. Very little green. IndusInd on that brokerage note is up 2%. Let's see if it holds on to that. Oil has shot up, and as a result of which we're seeing ONGC up another 0.6%. BEL, Eternal, Wipro are the few others, but the two which kind of have some rationale of standing out are IndusInd Bank and ONGC. Maybe a bit more green now than on open, but a quantum of red out here. Power Grid, almost everything is less than 1%. Power Grid just hovering around that 1% loss. Then there's a Tata Consumer, JSW Steel, Axis, iShirt, Tata, HDFC Bank, Infosys. So just that. I mean, in the large cap space at least, there are not too many newsmakers today in the large cap space, remember. So more luck with Tamanna and Alex for figuring out larger movers. The large cap space, it's just Power Grid and Kotak on the downside. So banks are starting off slightly soft because HDFC Bank too is in the red. IndusInd Bank is a lone star of sorts, but I see the quantum of green going up, which is actually not a bad thing.
What a move on IndusInd Bank this morning on that Nomura note. If you had listened in to Harsh's big brokerage call, you would have got that cue going in as well. Let's quickly look at what's happening with the broader markets just for a second. It's going to be a stock-specific action-packed day. It's not about the indices today, so keep that in mind. About 1/4% down on the mid-cap 150, 0.5% on 250. Actually, the first few minutes not looking superb. As soon as we can, we'll pull up an intraday as well to give you a sense of where the mood is going. I want to pull up the India VIX if I can for a second, because you are seeing a bit of pain in positive territory, not great, inching up, nothing scary at this point, but the fact is that uncertainty and volatility building in. Let's look at the sectoral indices if we can and see what's moving there across the board. Nifty Realty doing well. I suspect because of DLF, they've sold off inventory worth 11,000 crores in a week is what they've done, and they put out an exchange notification on it just about half an hour before markets opened. Defense stocks taking a bit of cool off today. I wouldn't say taking a beating, but just about 0.5% odd down. Broader indices also not doing too well. Nifty IT hanging on there on a flattish trend. Oil and gas doing okay, possibly pulled up by an ONGC if at the most. Let's pull up individual stocks because that's where the story is. I want to see what's happening with BSE. The news yesterday, NSE has got Tuesday as its weekly expiry day. BSE has got Thursday. They put out a notification saying they asked for Thursday and they got Thursday. Their volumes are expected to dip because of this, especially in the derivatives space. Frankly, less than 1% down on opening is not bad. And this is something that we discussed in detail, that will you see not so much of a hit on BSE on opening. We'll wait and see how this pairs out for them. All assessments saying that at the end of the day, there will be some hit, but they have the capability of building up volumes again. Hindustan Zinc is the other one that we have to see. The stock took a hit in yesterday's trade after they announced capex, but now the real story and the real worry perhaps is Vedanta offloading stake. The stock about 6% down. Vishal Mega Mart in focus, a mega block deal absorbed pretty decently up in the pre-open session, about flat right now, but keep an eye on Vishal Mega Mart. Polycab is the other one we're looking at. Large order from BSNL stock about 1% up, no major moves there. Bharat Forge has an MOU with a French company which makes drones, about 0.5% up on that stock. Avenue Supermart has made a foray into Uttar Pradesh. Agra is its first stop, 1.5% up on that stock. Trent also is something that we're looking at. Positive brokerage views, the stock mildly up in the green. So no big movers and shakers this morning that I have spotted. Alex, if you had better luck.
Just a couple of names, Tamanna, and these are stocks, or this particular stock has moved quite dramatically in the recent past. I'm talking about Sterlite Technologies, because this, remember,
Just a couple of sessions back was up as much as 20%. It gained further in the following session. It's down about nearly 4% at this point, and signs of profit taking. This is par for the course. Also pull up something like an LG Equipment. It's buzzing in trade today, doing reasonably well for itself. It's up about 4% at this point and moving higher. And we've also spoken about IndusInd Bank at the start, but I do want to pull it up again because gains of over 3%, last I checked, okay, no, so it's cooled off just a tad bit. At one point it was up over 3%, so watch out for that as well. But Chandan, specifically on Sterlite Tech, if you managed to gain significantly in the recent past, would you also take money off the table?
See, if I look at the counter, I believe if someone has really got the good return, it's better to get some profit out of the market because just a couple of weeks back it was consolidating and formed a positive pattern near 70 marks. And from that level, I think it rallied by more than 40-50%. So I think after such kind of release, advisable to book some profit, but one need to keep in mind that major trend has turned positive. That is up by around more than 50% on monthly chart. So again, position has to be added on any small decline or keep some position because some chart re-rating is clearly visible if I look at the monthly, weekly setup. So those who are already holding, they can book some profit, and those who are interested to buy, utilize any decline towards 195 to 100 to re-enter the counter.
Quick follow-up on BSE. It is down about 2.5% as we speak, but not the big gash that we were anticipating. Seemingly, it's finding buyers at every lower level. So, Chandan, do you want to revise your strategy, or are you still going to wait for the dust to settle?
See, BSE is one of the strongest counter, and if I look at the YTD basis, it rallied well by more than 50% even after the corrective move of last 4 or 5 trading session. The good part is that now we have 2 weekly expiry. Only the interchange has happened for Nifty and Sensex. Capital market theme is likely to continue. Already the stock has rallied well in last almost 65 trading session from 1225 to around 3000 mark. So after a decent run up, I think some sort of decline is always opportunity to buy. So I believe the way derivatives business is growing in the BSE, the declines could be both. However, prices valued much, prices rallied well. So some sort of decline could be seen, but that could provide a buying opportunity. So that is the idea for long-term point of view, but for immediate point of view, till it holds above 2300 marks, I'll use any decline to buy for an upside target towards 2800 to 2900. Sentiment-wise, slightly declines is there, but for capital market theme and overall price behavior, I believe again the counter has opportunity to revamp and head to the new lifetime high marks.
Mairesh, if you had BSE in your portfolio, what would you do?
No, concur with Chandan. I think we would hold it. I think the rating rankings look very decent to us. Obviously, I think the change in terms of the expiry date, it might create some element of dent initially, but I think volume should recoup as we go ahead. And I think the entire business model that is based on trading volumes, that is based on the annuity business as well, that it carries outside trading as well. I think there is sufficient levers of growth over the next few years structurally. So I think anybody holding on to BSE should continue.
Some news flash on your screen. We'll get you the reason why DVs would be in focus, but Novartis and MSN have settled on 659 or 659 patent. That's the name of the patent for drug Entresto. Okay, this must be, we'll get you some details on this one. Pharma has, remember, been in focus since yesterday, simply because Donald Trump put out a mention that pharma tariffs are coming soon, and that whole sector took a nosedive in trade yesterday, so bear that in mind. Chandan Taparia, a word on maybe a Divi's Lab from a trade perspective, or any other pharma name, because the sector was very weak yesterday.
So like pharma is volatile due to the Trump comment. However, the stock has not really done well in last couple of trading sessions, has got stuck in a range. To comment on Divi's Lab, I believe some sort of consolidative move could be there. However, from last almost 18 days, it has been moving in between 6,500 to 6,850 marks. Even on the last trading session, it made low near 6,500. Today also respected 6,500 levels. So I believe those who are looking for immediate point of view, can use the support near 6,500 to witness a recovery towards 67.50 to 67.20 marks.
Just pulling up a little more information on what we've gotten on divvies. I'm just trying to pull the announcement as we speak, and basically the news flashes that you see on the screen relate to a patent for Entresto, that's the name of the drug, which expires in November of 2026. And also it relates to the related exclusivity which expires in May of 2027. Apparently Novartis and MSN have settled on 659 patent for the drug Entresto. What this means, we'll have to figure it out. It could see upgrades in the company's FY26 and 27 numbers. Divi's apparently supplies the API for Entresto, which is why it is important to bear in mind. Varsha, who tracks the space very closely, is joining us to tell you about the implications of this. Varsha, is this a positive development for Divi's?
Yes, absolutely. This is a positive development for Divi's. Why? Because the Novartis and MSN, which is the other, MSN is the other pharma company. Now they have settled on the patent for the drug Entresto. Now why this is a positive? Because Divi's lab provides API for this drug. Now the legal battle for Entresto now moves to next patent, which expires now. Entresto's patent expires in November 2026. This settlement could lead to upgrades in Divi's lab in FY26 and FY27 financial forecast. Now why this is important? Because it provides almost 8% to the overall revenue for Divi's lab. Previously, just to give a context, US Federal Circuit had rejected Novato's bid to block MSN generic Entresto, which was negative for Novartis, and because of that negative for Divi's lab. But now that has been settled, and that's why this is positive for Novartis, and that's the reason it is positive for Divi's lab as well, because FY26 and 27 will see the numbers from this hard drug, which is significant for Divi's to the overall numbers.
Thank you, Varsha. Thanks for putting this into perspective. And Mayuresh, you heard Varsha, and the stock is rallying, by the way. Actually, Chandan, can I very quickly ask you, is there a trade here in Divi's? It's just perking up.
So I think one can look for some buying opportunity. However, the good part is already, as I mentioned, that 6,500 is major support, and with that support already I recommended. So I think one can hold. Even now I'm revising the target, which can even go to 68.50 kind of level. So I'll hold the trade. Even I'll continue to keep the trailing with 6,500 marks to get more swings during the day.
Yeah, this is interesting, because this contributed to about 8% of total sales for Divi's in FY24 and subsequently, and 19% of CDMO sales. Mayuresh, any thoughts here? Would you be a buyer in Divi's because of this or generally?
For this and generally as well, I think it is a positive for Divi's. And generally, I think the business that Divi's is conducting at this juncture, they're actively involved in various new projects at different stages of the life cycle. At the same time, if you probably look at the supply of amino acids that they're probably doing for GLP-1 products. So if you look at the GLP-1 and the GLP-2 compounds, Neeraj, I think they are expanding capacities as far as the peptide pilot plant is concerned. From 50-liter odd capacity, they're actually expanding those reactors quite significantly. They're investing into backward integration to a large extent. And therefore, I think the kind of compounds that can probably come through can, in fact, improve EBITDA margins. So the EBITDA margin between 31 and 33% is something that what the street probably believes in, relatively leading to better ROEs. The ROEs can actually expand from 15.5%, 16% on an annualized basis in FY25. Almost 18.5%. So I think structurally the CDMO story continues, and Divi's and Lotus probably both play a good part in that. So I think continue a positive stance on both.
Okay, Divi's is a winning story this morning. IndusInd Bank is a winning story this morning. You're seeing quite a few. Even market breadth has also turned actually, and not looking half bad. So you're up in the green. It's a cautious start to the morning. There's no doubt about it. You're not going to have major fireworks, but I would say that it's not looking as bad at all. Nifty Realty firing quite smartly. Thank you so much, Chandan and Mayuresh. Always a pleasure to have you on the show, and have a great day. Meanwhile, we're moving on to an interesting segment of the market. Now, monsoons have stalled the sale or the extent of sale that was expected for room air conditioners. One company which is in focus is EPAC Durable. We're going to talk about the entire space. But before that, let's bring in Mahima to give us some context.
Right. So, as you rightly mentioned, early monsoons is definitely a bad news for summer AC sales. Now, Jefferies did come out with an interesting note yesterday saying that Q1 last year had a high summer base, because of which earnings of all of these companies, AC retailers as well as manufacturers of components of AC, will be impacted this year. They're estimating first Q1 FY26 unitary cooling products to decline in lower double digits for both Voltas as well as Blue Star, and they're cutting the 26 to 28 FY estimates of EPS by around 6%. The next trigger for these RAC volumes could be an inventory liquidation in Q3 ahead of the new BE norms, which will come on Jan 2026. Now, Jefferies has maintained a buy on Voltas, however, rated Blue Star with a hold. They're saying that risk to reward appears better in Voltas versus a Blue Star. We also spoke to the management of Blue Star, and he did indicate that there has been an impact on volume, which could be around 25%. They've also stalled their production in terms of the first 2 quarters, and they've said that the growth of full year will be at anywhere between 10 to 15% versus that of 20%, which was earlier expected. Yesterday, Voltas also did have an analyst meet where they indicated that industry-wide there has been a dip of 20 to 25% odd volumes in terms of RAC, and a pickup is expected in June. However, the channel inventory remains elevated, around 6 to 8 weeks is the channel inventory, and companies are also giving out freebies in order to boost their AC sales, and despite the subdued demand, these companies are refrained from taking any broad-based price cuts. Now, to take this conversation ahead, I think what will be interesting to know from EPAC will be as to how EPAC as a manufacturer will be impacted in terms of production, as well as how their margins will be impacted, and overall what is an inventory build-up that they're seeing because of this. But before that, we also spoke to the management of Blue Star regarding this. Listen to what he had to say.
It should be around 25% compared with last year, which was a growth of over 57% over FY24 in FY25. On that, there will be reduction of around 25%. So that will be the impact. But you do have many cost levers. So I think Q1 for room air conditioners will be bad. But commercial refrigeration is doing extremely well, and we are a B2B company as well as B2C company. So it is a disappointment. We will bounce back. That's where we are.
Okay. So that was our conversation on Monday with Blue Star. Now, Ajay Singhania is with us, MD and CEO of EPAC Durable. Ajay, great to have you on the show, and thank you so much for speaking with us. So we've seen the view on what Voltas has said, Blue Star has said, and this is clearly across the industry. But want to get your point of view on this. What is the kind of pain that we're seeing because of these early monsoons? Can you quantify it for us?
So I'll not call it exactly a pain the industry is facing. I mean, it's more of a phenomena like every 5-6 years we see when the expectations rise really high basis the performance what we achieved last year. So it's more of an expectation, but industry is not that bad. I mean, currently there has been some recovery in June. So obviously, like everybody else was mentioning, both Blue Star, Voltas in the earlier interviews you have shown. So the industry is on the verge to close Q1 at a degrowth compared to last year. The degrowth could be anywhere between 15 to 20%. Overall, the year currently looks like will grow, could be flattish or a growth of max 10% is what seems on the card as of now for the financial year 25-26. But overall, the tailwinds are still really strong. I mean, the industry, AC industry per se, I mean, has been on a growth path, and there's a long way to go. So, I mean, the story is not over. I mean, it's just the beginning of AC penetration. So we will see it continuing over next several years.
Ajay, good morning, Neeraj here. Sure, the story is not over. It is a long-term story, but the near term, I heard you say that there could be a degrowth, and at the same time, I heard you say that you would probably grow 10%. So I was just a bit confused. So is the degrowth for Q1, but overall you expect a 10% growth for the year?
Yeah, absolutely. So the Q1 definitely, because of unseasonal rain, especially April and May being kind of a washout in certain parts, pockets like especially South didn't perform well, then West obviously didn't fetch well for May. So overall North has been comparatively better as compared to last year. So there is some respite in June because of the heat waves in North. So overall Q1 is a degrowth, anywhere between 15 to 20% for the industry. But the entire year, it seems we are still on track to achieve a growth of anywhere between up to 10%.
Ajay, the reason why this is a bit, and I'm not saying it's an alarming situation, but the larger opinion was that both quarter one and quarter two, for most of India Inc. consumer-facing businesses, there will be good growth because the base was very low, right? Last year, elections, unseasonal rains, all of that. On that base, if you're degrowing in quarter one, is quarter two going to make up substantially? Because a 10% growth per se is not too much, simply because the volumes, at least in first two quarters, was probably not very high.
So here in, especially for AC, the cooling industry, if we see last year FY25, there was approximately 70% growth in Q1.
Okay.
Compared to the previous year.
Okay,
so,
I stand corrected.
Already put on a very high base.
Okay, I stand corrected. Okay. The other question therefore would be, do you expect momentum to recoup in quarter two? I'm presuming you are the supplier to these guys. Are the demand signs coming through now that the weak season because of unseasonal rains is behind you, or is it still lukewarm?
Since BT and Saab was sharing on the previous interview, Q1 being sluggish and some spillover of inventory already in the trade, Q2 will also be impacted partially, and the pickup will start only from Q3 because there is an upgrade happening in the AC industry. So the star ratings or the performance is going to go one notch up beginning of January. So since the production starts somewhere in September, October, so the full momentum in the production will begin from September, October onwards. So we'll have the spillover of inventory will have definitely some impact in Q2 as well.
Just trying to understand what are the kind of inventory levels that we're seeing right now, Ajay, because another point in our conversation with Mr. Tyagarajan that's coming out from Voltas's analyst call is that as inventory levels are building up, they are looking at maybe cutting production. So number one, what are the inventory levels? At this point, have they fallen dramatically, and if so, is it below 25%? And number two, are you now seeing production cuts roll out?
So two things here. In terms of inventory, the correction or the slowdown in the production already happened from the beginning of or the end of May itself. So the corrective steps in further production kicked in from the end of May itself. So June, there hasn't been substantial production as compared to the projections we already had earlier. So there was an estimated inventory of close to 3 million in trade. So AC is a 15 million odd market last year. So there was 3 million kind of inventory in trade plus almost 2 million with the brands itself. So there was roughly 33% of inventory in trade beginning of June. Liquidation has happened in June because of the heat wave in North. So end of June, I expect inventory would largely stand corrected since not substantial production has happened in June itself. So July onwards, it seems that we will be on track to liquidate most of the inventory and gear up for the new rated products from August onwards.
Okay, so hopefully the festive season brings in cheer because the inventory would be lower and maybe demand could be higher as well. Okay, keep an eye out for that. There were some reports, Mr. Singhania speculating that there's some show cause notices sent to copper importers, which included AC makers as well. Anything that you've heard with regards to this? Have you, I don't know if you've received it or whatever, but there's a lot of talk going around.
Yeah. So definitely. So as a country, India doesn't manufacture a lot of copper. I mean, especially there's copper called inner groove tubes and the tubes which go inside an AC. Those are not currently manufactured in the country, and we are a net importer. And that we have an FTA with Asian countries, Thailand, Malaysia, Vietnam. So since 2013, the industry has been importing at a zero duty all these coppers from all these Asian countries. Now, there has been a show cause notice sent to almost 2,000 plus importers, which includes almost everybody in the trade, all the brands, all the manufacturers of air conditioners, refrigerators, and traders. So everybody has received a show cause notice. So the department has been asking us to justify the valuation norms as per the FTA agreement, which as an individual importer, nobody, I think, has the capability to go to a third country and get it validated. So we believe as an industry, we believe it's more of a government stand to it's a government to government kind of a transaction, wherein the country of origin certificate is issued by the Asian, by the country. So everybody has received the notice, and we are trying to take a stand together as an industry here.
Okay, so what's the resolution here, sir? I mean, do you reckon that I heard you say that it's a government to government thing. So does the government come back and do something, or what's the impact? Assuming that this doesn't get resolved at the government to government end, what's the impact for a player like you, for example?
Yeah, so there is a 7.5% duty applicable on imports, which under the FTA we have not been paying. And since currently there are no manufacturers available, and the BIS is given only to a select few manufacturers in the Asian countries only, so we are currently, everybody is importing it from those suppliers, and we are paying a bank guarantee of 7.5%. So that, and since last almost 18 months, the bank guarantees have been applicable and everybody has been paying those bank guarantees. So, I mean, we have been pushing the departments to at least finalize whether a duty is applicable or not applicable. A final conclusion has to be done. And then, I mean, we don't mind if the duty is applicable to everybody, it's applicable.
Got it. But, Mr. Singhania, I completely agree. I'm not saying you are the one singled out, but my limited question therefore was that we hope it gets resolved, right? Because there is an industry-wide stand that you've taken. If it, in the event that it doesn't, is there a financial hit to the numbers on EPAC, if not at the operational level, then at the PAT level in the current year FY26 because of this?
See, I mean, if the duty is applicable, everybody pays it. So
yes, of course. But for you,
the impact on it is probably thousands of crores.
Okay, but for you, how much could the impact be, sir?
So individually, I'll need to probably get it calculated, but currently as an industry, India is importing close to 2 lakh tons, and 7.5% duty on it probably stands at a few thousand crores.
Okay.
On an yearly basis, and everybody has been doing it for past several years, I mean 10, 12 years.
Okay, fair call. No, just trying to get that sense going, and lovely. Thanks for being so candid about everything. I wish you all the best. Hopefully, the degrowth is done and the growth starts from Q2 onwards, Mr. Singhania. Thank you so much for speaking to us.
I just wanted to add a couple of things here. I mean, just not the AC. If we're talking about APEC here, we have maintained that we are looking at a 35% plus kind of a growth on an annualized basis. So this comes not only from AC, but from all the diversification efforts we have done over the last several years. So the other aspects of business for us, the small domestic appliances, the large appliances like washing machines, coolers, and the component business which we have scaled up. So all this are definitely witnessing a lot of growth. And like you mentioned, the good monsoon definitely leads to a better festive season. So for us, the small appliances and the washing machines, and those are bigger bets for us, wherein we are looking to scale up substantially.
Just the other side of it, if there's a heavy monsoon, then you need dryers along with those washing machines. Thank you so much. Thank you so much for speaking with us. And just a point to that, Neeraj, yes, monsoons have come early, dampener for AC sales. But the fact is, the trajectory we're moving towards is hotter and hotter weather, hotter summers, and it's high pollution. I don't think the demand overall for RAC is going to go down anytime soon. Maybe some dampener here with a base effect.
Yeah, so maybe a 10% growth on a high base for this year. But if indeed this whole income tax cut benefits and then 8th pay commission, discretionary demand picks up, it could be good for AC makers for sure. So certainly watching out for that.
Fundamentally, it moves ahead. But the other big story, an exclusive conversation this morning is with Ugro Capital. Mr. Shachindra Nath, who's on a buying spree, is with us in the studio. He's the founder and MD, of course, of Ugro Capital. Harsh is also joining in for this conversation. It's a space that he tracks very closely. Mr. Nath, very good morning.
Thank you.
And so you've added to your shopping cart and a largish size purchase there. Tell us about the acquisition.
Yeah, we have not been on buying spree. I think so in terms of the size and scale. Last year we did a small fintech acquisition, and this is the second one. We are largely an organic build over the last 3.5 years. We have been actually looking at an opportunity for consolidation. The consolidation which can, as you know, that our build out has been over the last 3.5 years. We've been seeing what is the most effective utilization which can improve our operating leverage. In last 2.5 years, we have added roughly around 200 plus physical location, 3,000 plus people, and obviously that has increased our OPEX quite significantly. And if we felt that if we can utilize our capital to increase the operating leverage, then in short to medium term, the ROAs and ROEs would improve dramatically.
Sure. But on Profectus, and then just for, context for our viewers who are coming in, you're acquiring Profectus, just the size of it and why this particular acquisition target. Can you take us through that?
Yeah, it's an interesting question. As you know that our aspiration is to build a dedicated MSME financing business. Number one, there are not many lenders which are only for MSME. Most of the lenders are diversified lenders. People do vehicle, consumer, PL, also MSME financing. So the assets to find which are only in MSME are aligned to our objective are very rare. Number two, the way we are seeing the market, majority of the assets which are available either are in unsecured businesses, and our view is that in next 1.5 to 2 years, lower ticket size unsecured businesses like microfinance company would undergo severe pain because there is an over leverage at the customer level which has happened. And that's why second objective is to find assets which are more secured in nature and which can also give more balanced portfolio for us. In that domain, actually Profectus fit fairly well. Incidentally, the story is, in year 2016, I and Actis worked together to set up an NBFC. I then decided to do it on my own, and Actis decided to set this up with Mr. K.V. Srinivasan. So I have known this asset also, its culture, its DNA, how it has been built, and 3 of its line of business completely aligns with us, what we do. So that's why we have a great opportunity to bring massive operational synergy. It should add to roughly around 150 crore of cash profitability to us. And if you think of it, to deploy a 1,400 crore of capital which we have raised in loan asset leads to roughly around 4% of origination cost. Now the same capital deployed without any net worth erosion would give additional 150 crore of profitability. So between the two choices, this was a great choice for us.
You're saying between the two choices of growing organically versus buying this, you're saying this was a better choice for you?
Yeah, so if you buy something which actually erodes the net worth, actually because we are preserving our capital very significantly. Our whole purpose of raising capital was to shore up our capital adequacy last time when we did that. So there were twin objectives. Buy something which can add to your capital adequacy net worth. It improves the profitability on immediate basis. When I say immediate, is obviously lag effect of 12 months, and also it improves your quality of the portfolio and secured asset. So on all 3 count, this fit fairly well.
But Mr. Nath, the other question that comes in, and of course, I mean you've thought through this acquisition, so I'm not doubting that. But you've raised capital. The Reserve Bank of India has done what it has done. The tailwinds are in favor of the sector. Growing organically without an acquisition, could that have been not such a great idea? Why this acquisition at the current valuations when you've also diluted capital at a lower valuation for yourself?
Of course. No, this is a great question. So you are right. So we raised our capital to achieve our organic growth. So we were at 19.4% at the end of March, and we maintained roughly around 18% of capital adequacy. The way we were growing, we would have ended up back at almost 22% at the end of FY26. That is not changing for us. That growth in focus on our emerging market, which is low ticket LAP and embedded financing, continues. So we are not changing that. This acquisition actually does not deplete our capital. So we've added 3,500 crore of asset. We would end up at 21% of capital adequacy. So think of this way, if we would have done everything organically, we would have ended at around 15,000 odd crores. We would have been at 22% of capital adequacy. But now we have added 3,500 crore of asset. We've added roughly around 150 crore of profitability, but we have not eroded the capital.
21%. Okay, just one quick follow-up. I'm sorry, Harsh, just one quick follow-up. What happens to growth? I mean, are there some numbers that you're forecasting as a result of this for, say, 26, 27?
So we will try to do 2 things. Our organic growth continues in the same momentum as it was doing. We will probably try to recalibrate our organic growth down by 10%. Not that we don't want to do it. What we have seen that our cost of borrowing has remained elevated vis-a-vis our peer set. We believe that our cost of borrowing is 150 basis points higher than any of our competitive set. The reason for that is that we are a very high growth company and we don't have the patience to say no to lenders and reduce our cost of borrowing. So sometimes between the choice of high growth versus reducing cost of borrowing, we'll focus on reducing the cost of borrowing. This acquisition would give us that capacity because we have done in terms of the asset growth on an inorganic basis, which means that if we grow 10% lesser to our organic plan, we will be able to at least bring down cost of borrowing by 50 basis points.
So, two quick questions with regard to Profectus. I want to first ask you, the top line number didn't grow very significantly. Give us some color on that and give us some color also on asset quality because that wasn't part of the disclosure. So, give us some perspective on both of those.
So Profectus, so as you know, Ugro has 4 lines of businesses, what we call the prime business, prime lab and prime business loan. We have a machinery business, we have an emerging market micro lab, and we have an embedded financing. 3 lines of Profectus business are exactly same. So they are in a prime lab, machinery and supply chain financing. Unlike us, wherein we have 70% secured and 30% business loan, which is guaranteed by credit guarantee, Profectus is a 100% secured portfolio. So 90% of their portfolio is roughly around 14% yield secured lab business in 29 locations. So their portfolio quality actually on a headline basis is better than us. They are at around 1.4% of gross NPA and 1.1% of net NPA. And given that they are in secured yield, largely lab business, their portfolio quality in current market would be far superior than most of their players. If you look at the private market, not the public market, businesses which are in this segment of the market actually trades very attractively. Profectus, the challenge have been that they have built a large base of cost structure, but they have remained in low yielding business. So it's fairly simpler. They, their entire portfolio yield is around 14%. Cost of borrowing is 10.5. So on it, standalone basis, they are at a 0.9% ROA and 2.5% ROA business. So for anyone to look at on their number, it would not look very attractive.
Correct.
But when we look at it, so at their 30 crore PAT, we would add back around 115 crore because we have an ability to take out the cost because 3 lines of business which are common. So 29 branches which are common locations, only 1 branch would run. A lot of other origination costs, technology, people costs would get, now operationally, reduced. So we looked at this as not as a 30 crore PAT business, we looked at it as a 140 crore PAT business because as an acquirer of this business, their 30 crore PAT would get added back with 115 crore, which we will be able to take out over a period of, once acquisition get completed.
Correct me if I'm wrong here. Does this mean that your ROA inches above the 3% mark in FY26 itself for Ugro consolidated now with this acquisition?
So we have very clearly said that this, on a consolidated basis on FY26, it will depend upon when the RBI gives approval, when this becomes our subsidiary and how much time it takes to, to consolidate this to us. But if I'll take rolling 12 months or if you look at 26 and 27, this acquisition would enhance our ROA by at least 0.7%. So whatever is our target of ROA, that would get enhanced by between 0.6 to 0.7%. This would also give opportunity for Ugro to improvise its cost structure because the base of asset is much larger. So definitely we think, so our target for FY27 is to reach 4% of ROA. I think so we should be able to fast track that by at least 5 to 6 months.
Let me just come to the part about fundraise and especially about CCDs. And we've reported recently IIAS had some concerns regarding the whole route taken on those fundraise, the 12.5% paid on coupons. What is your response to those concerns that a watchdog for shareholders has raised?
Yeah, I was quite surprised that for a small company like us that I think it's quite heartening to see that IS also kept a focus on us. Not necessarily they do it for all the companies, but they did it for some special purposes. But leaving that aside, IS normally is followed by institutional investor. Unfortunately for us, there is hardly any institutional investor for us. We are still, one of the target is to increase our institutional penetration because Ugro has been fairly successful in raising capital from private sources, private equity to sovereign fund. But leave that aside, I think so the way to look at about it, when we ended March 2026, we were at 19.4%. All of our lender covenants are at roughly around 18% of capital adequacy. If we didn't raise capital, roughly around 2,000 crores worth of our loan would have breached not the regulatory capital norm, but would have breached lender's covenant. In lending business, if you breach a lender's covenant, it can create a very massive cycle of loan recall, stopping the disbursement. You have to cut the operating costs. So the company had two choices: to raise capital on an immediate basis. Now I could have raised that capital, or board could have decided to raise this capital from new investors, or you could have gone back to the existing investors who have already put the money. Now, all our investors are professional financial investors. So we felt that the best option to raise capital is to go to the people who have already invested in warrants. They have some money already deployed, and negotiate them and bring the capital back. When you do that, then obviously they will ask for, what is best for them. Ugro during last 1.5 years, its lowest has gone all the way up to 148 rupees, and peak is at 308 rupees. So investor looked at and protecting their risk that where it can go below. And that's why they negotiated a commercial construct that how much we have to pay if they have to bring that capital upfront. Company tried negotiating better terms. So obviously we agreed that we will pay you, total coupon, which was commercially negotiated. But we tried reducing that coupon and saying that these investors should not get the double benefit, that they should take a very high coupon from us. Then if the share price, improves, then they also exercise the warrant and they take the benefit of lower price and also take the benefit of, the warrant conversion. And that's why we linked, saying that we are happy to pay you an upfront coupon to bring the capital now, but we don't want to pay you the second tranche of coupon if you happen to also exercise the warrant. And that's why we linked it. So that was the logic. Second question was that it should not be a bad deal for minority shareholders. Yes. Because the minority shareholder may say that you have given a preferential treatment to one set of shareholder, what about us? The incremental dilution, when we diluted at 265 to 185, was 4% of the company. Exactly for that 4%, we did a right issue. And on the right, we exactly offer the same discount. So we did 185 rupees of preferential allotment, 12.5% of upfront discount, which is coupon. And that's why we did a right at 185 minus 12.5% with 162, matching the same size. We never needed to do right issue. The right issue was done to match the same dilution so that every shareholder also have the right to put the capital. And that's why some of the large shareholder put capital in the right issue itself.
Okay. Well, we've run out of time, so we'll have to come back on more on this. But thank you so much, Mr. Nath, for coming down and answering all our questions.
Thank you so much.
On Ugro this morning. We're taking a very short break, but on the other side, we come back to what's happening in the pharma space. Aditya Khemka joins us for all that and more. We also have this great conversation with Ajay Srivastav, MD of Dimension Corporate Finance Services. All of that after this break.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down.
Back with India Market Open right here on NDTV Profit. Now, let's focus on pharma. And yesterday, Donald Trump reiterating that tariffs are coming soon. Aditya Khemka, fund manager at Incred Asset Management, Johnson right now with his thoughts on all that's happening in that space. And Aditya, thank you so much for taking the time out. I know we spoke to you when this first rumblings of this came in. Now, Donald Trump is reiterating that as well. I'm guessing your answer still stays the same from what had happened the last time. On the impact on the healthcare space in India.
Yeah, that's correct, Neeraj. Good morning. My answer hasn't really changed. The risk in the space has gone up and the reward has not. So from an investor standpoint, doesn't seem lucrative enough a space to invest in.
Okay. And now, Aditya, quick follow-ups here. The belief that a few people have had is that when we are talking about these pharma tariffs, the ones which are established in US or have health practices in the US and are exporters are the ones which get impacted the most. But one would reckon that even the secondary suppliers, right? So if CDMO companies are not supplying the final ingredient but the intermediates, right, or APIs, do they stand to get impacted as much if indeed these tariffs were to come in? I mean, have you given some thought to that?
Yes, we have. So basically, let's divide CDMO companies into two parts, Neeraj. One would be companies that supply to generics. The other would be companies that supply to the innovator pharma, the big pharma out of US, Europe, and Japan. Now, because they supply intermediates and API, first of all, we aren't clear if the tariffs, if at all, as and when they come, would they be applicable only to finished product or would they be applicable to intermediates, API, what have you, any stages in between. But let's say that clarity emerges and let's say it applies to everything. Again, because the business with generics is so tight on economics for the generic company themselves, the impact of the tariffs on the intermediates will probably be borne partially by the manufacturer/supplier and partially by the customer. But on the innovator supply side, which is true CDMO, as we call it, the CDMO business that really involves doing some high-end cutting edge work, that CDMO business will have the ability to pass on the entire burden to the customer. Simply because for the customer, the intermediate cost is negligible as a part of his overall cost of production. So they wouldn't care, if the tariff has to be borne by the customer.
So that's the POV of the Indian pharma companies. Very good morning, Aditya. The point is that what is the end goal of the tariffs? The end goal of the tariffs is not just to increase revenues. It's from the US administration perspective, it is make in America. Right. How much of a realistic threat is that? Because we keep going into this seesaw on the impact on Indian pharmaceutical companies. Is there any clarity that you have been seeing so far?
So the clarity we get from pharma companies, talking to pharma companies themselves, is that there is no way they can manufacture in America. One, there is no capacity there. For itself to establish capacities will take you 1 to 2 years to build the capacity. Then there is the regulatory process of getting it approved by the regulator, the FDA there, and then probably product launches. That's a 5 to 6 year cycle in its own. And hence, if the objective is make in America, which is the rhetoric, I think that cannot be served by tariffs. I mean, that just simply cannot happen because the cost of production might be 50-70% higher. And if you're putting 25% tariffs, it is still cheaper for the customer to buy from us, including the tariff, rather than to make it locally. So hence, I don't think the tariffs serve the purpose of Make in America at all. And remember, President Trump has another 3 years left for his term. So you don't know what the next administration will do. Will they keep the tariffs? Will they repeal the tariffs? So no entrepreneur takes a 3-year call, right? When you set up a plant in an advanced geography like US, expensive geography with expensive manpower, expensive land, you sort of seek a 10-year pathway. But there is no 10-year pathway here, given the administration has got only 3 years left and you don't know what the next administration will do. So I don't think Make in America, in short, can be achieved through these tariffs.
So in that context, if someone were looking at building a portfolio with additions of pharma companies from a 3 to 5 year perspective, what should they look at? I'm asking if there's a contra trade here, where perhaps companies with exposure to the United States should be in your portfolio.
No, actually, because if they impose tariffs and we don't do Make in America, the tariffs will probably stay for some time, right?
Okay.
Even if it is for the Trump tenure, which is another 3 years to go. So these stocks may not give you any returns for the next 3 years. So I would avoid these stocks, completely for the next 3 years, and then maybe look at what the new administration is trying to do, and then maybe rejig my portfolio according to the new policies of the new administration.
Okay, so would there be a focus on domestic focused companies? Would there be a preference there? And if yes, which ones do you see moving ahead?
So on the domestic consumption story of healthcare, I think we can play hospitals, we can play diagnostics, we can play domestic branded generic pharma companies. You have your different pharma companies which are mostly focused on India. I think those are the stocks which make sense for your portfolio for today and for the next 3 years. Because given the Trump administration, if tariffs come, these are the companies which are insulated. And also the API CDMO companies which do business with the innovators, because they will be able to sort of negotiate the impact of the tariff, if at all.
Aditya, the follow-up to that might be that if that is indeed the thing, would you, if so, I'm not asking you to make a portfolio recommendation at all, but what I'm asking is that in your mind, if people want to stay in healthcare, have investments in the pharma exporters, would you believe it might be a prudent move to consider, realignment of the portfolio while staying in healthcare itself?
Absolutely, yes. So see, you cannot miss healthcare as a theme in India simply because we are just 3.5% of our GDP is on healthcare versus United States at 17, Singapore at 9, and Russia at 10. So clearly, there's a long runway for healthcare consumption in India, and that's the theme we should be playing at this point. And if you have exposure to exporters today, it just might be prudent to switch the position because the exporters really are exposed to a lot of earning downgrades, tariff risks, and the valuations aren't really discounting those things today.
I know you don't talk specific stocks, but there's big news on Divi's today, and just looking at a series of patent legal battles pairing out. How are you looking at those factors, and anything specific that you're tracking on a Divi's or anything in that space?
So look, Divi's comes under the API CDMO space. They are partly generic, partly innovator API CDMO. And the legal battles are a part and parcel of the business when you do generics, because in generics, you're basically reverse engineering someone else's product. And if there is a patent, then you sort of fight it out in the court of law. So that's a part and parcel of the business. That doesn't bother me or my investment thesis on any company, including Divi's. But yeah, I mean, again, so I will not focus on companies that have a lot of generic exposure because the risks are really high, including litigation, US FDA, and then the tariff, and then the earning downgrades, which are coming because of some few large products going off patent. So I would rather focus on, companies that don't have this risk in their business model.
Okay. Thank you so much, Aditya, for speaking with us. Divi is doing okay today because, of course, the news that has come in is pretty good. Wockhardt also shining in early trade today. So some stories there popping. Overall, markets have seen quite a bit of an improvement from where you started off. Let's just pull up the intraday very quickly for you off the Nifty. And yeah, market steady, about 0.25% up after what was a fairly weak start, and that was problematic. You're seeing the Bank Nifty also doing fairly well, nearly 0.5% up. Nifty IT having a middling day today. I want to pull up some of the buzzers of the day. BSE, let's look at what's happening with BSE. Let's look at what's happening with Hindustan Zinc. Those were some of the buzzers of the day that we've been tracking. BSE has seen a fair bit of a recovery. I mean, Neeraj, not to gloat, but just about 0.5% down. And to be fair, we didn't have any bet.
Yep. I said, I'm losing bets with you, so I'm not going to place them. That's smart of me.
I'm still waiting for my last coffee, just for the viewers'
sure.
attention.
So let's get it today.
Done. Anyway, should you bet on the IPO that opens for subscription today? That's Aris Infra. Going across to Sajid now, who's going to tell us what this company is about and should you be looking at it? Yes, Sajid.
That's right. It's a platform company which is coming out with an IPO, and IPO opens today. Aris Infra Solutions. The IPO is opening on 18th and closes on 20th. Price band between 210 to 222 rupees. The company is raising nearly 500 crores, of which around 225 crores has already been raised from anchor investors. And the market value of the company is little over 1180 crores there. For investors who are investing, minimum lot size would be around 67 shares for them. If you look at the business, as I said, it's a B2B platform company which provides construction materials to many construction companies like L&T and others, which is there. The proceeds are going to be used to repay debt. There will be a debt repayment of 204 crores. They will be funding their working capital of nearly 177 crores, and there's an investment they are making into this subsidiary of 48 crores. The company has been loss-making for the last 3 financial years. In the 9-month period of FY25, it made a profit of 6.5 crores on a revenue of 546.5 crores there. If you look at the strength of the companies, it has a good clientele. That's one of the big strengths, because clientele like L&T, J. Kumar, Puranik, Vadva Group, Capacity, Afcon. These are some of the clients which this company caters to, and it has a presence in Maharashtra, Karnataka and Tamil Nadu. 3 key big markets where construction and infra activities are happening. That's there. Valuation, on a valuation front, FY26 EPS is around 8.6. That's assuming a 10% growth on the top line and a 7% margin, EBITDA margin they're going to do. EV of 620 crores and EV to EBITDA of nearly 10.1 times, which is there. And for FY27, this EV by EBITDA is 8.9 times for them. Also, look at the weakness, because that's important to see, because it's a platform company looking at the B2B business. There's a high working capital cycle which they have, so they constantly need high capital because the receivable days are very high for them. Credit cycle days is around 139, and that's one of the key concerns also, because what they are supplying to the clients are giving it back at more than 140, 150 days. So that money, they need to have the circulation of money, and they need additional working capital if they need to grow from here or scale from here there. 2 key brokerage recommendation, Devin Choksi has avoid on this IPO, and Bajaj Broking has subscribed for long term. So from a valuation perspective, it's a fair valuation as of now. The key thing is that in a pre-IPO, we had some marquee investors coming in the form of Mukul Agarwal from Param Capital. You had Singularity Ventures and Sundar Iyer, who subscribed to the pre-IPO portion at 222 rupees per share.
So Devin Choksi Research says avoid, others say look at it for a long-term bet. Thank you for that, Sajid. Having said that, the last IPO has Oswal Pumps, I think, closed yesterday with quite a solid subscription just on day 3. So, keep in mind on that as well. All right, Puneet joining in on more stocks that are buzzing this morning. Puneet, you're focusing on those who've got order wins.
Well, definitely, and I think Polycab is the first one. It's a huge order for the company, roughly 6,400 crores from BSNL. Now, this is part of the BharatNet project, which is to connect every village in the country with wires as well as wireless access going forward. Why is this order important? Because the second such order in the last 3 months. The previous order was of roughly 3,000 crores that the company received in March of 2025. So cumulatively, almost close to 10,000 crores of order wins in the cables and wire space from BSNL specifically. The key aspect is, of course, Citi also met with the management, and it's a lot of positive commentary coming in with the next 5-year plan starting from FY26. So stock reacting on that news today. The other couple of order wins, Railtel won a new order of 44 crores from Zoram Electronics. They've got the letter of interest from the company. The other third company is EMS. Now they have gotten a 184 crore order from the UP Jal Nigam board. That's another key order win. They were the lowest bidder there. And finally, DCX Systems, a very important order for the company, 28.59 crore. It's an export purchase order. While the company has not mentioned the client, they've said this is an overseas order as well as some orders from the domestic customers as well, but continuing for the defense pack, getting these orders. So specifically amongst the list, Polycab is one of the biggest ones because of the quantum as well as from BharatNet, but important order for DCX as well today.
Okay. All right, so that's the buzz that you're seeing on Polycab. All right, Ajay Srivastav joining us this morning, MD Dimension Corporate Finance Services. Ajay, we always love our conversations with you, and thank you so much
Good morning.
for joining in today. Very good morning to you. Chalo, let's start with what is kya hal chal chal raha hai, because really difficult to figure out what's happening in the markets right now. Domestically, we're looking fine, but what Trump will do next has become, I think, a global obsession.
Oh, yes. That man has just changed the world, the way the world looks at. And I think he's the first non-politician to come in. And it's been a great refreshing because he is tearing up the rule book run by the politicians or professional politicians who do nothing else. And I think we have a fair share in India as well.
Are you a
who
Trump
do nothing
fan?
else but play
Ajay,
politics.
Ajay, are you a
He's
Trump
a great
fan?
relief to the market.
Are you a Trump fan? And a fan of
Oh, my
everything
God.
he's
Oh,
been
my
doing?
God. I am an, yes. No. Not a fan, but I think it's a great become the president, gets persecuted, comes back again, shows resilience. You know, at age 79, 78, imagine electioneering in America, traveling to all the, sleeping in a new hotel every day. It takes you courage and resilience and perseverance. I think it's impressive, very impressive performance. And, you know, everybody has frailties, everybody has problems. But I think that one thing to note is you need a man of severe guts to say, I'm 2 years on the election run, I'm going to sleep in different hotel rooms at age 77, 78, and still come out fresh, wearing a suit and a tie every day. I think it's the greatest thing. It's the greatest antidote to that cargo pant culture of this world. They're formal, nice. They makes the world go around, and that's what you like about the guy. You know, come out in the suit and a tie and say, okay, here we do, man.
Ajay, what about the policies? I mean, looking good, looking fresh. What about the announcements?
No, I think he's done a great job for his country. He's supposed to look after his country, not the world, and that's the honest fact. He's done a great job for his country that at least put people on notice. You want American markets, you got to be reciprocally alive to that, allow the American goods to come in. And America has lost a lot of market. If you look at cars, America is nowhere in the cars in the world today. If you look at electronics, America is gone in the electronics world today. So, in a way, what we are seeing today is a reflection of what's happened in the last 25 years. You may disagree, agree with some of the policies, but the fact is, he's there to look after America, full stop. We don't like it. Nobody likes it because he's hurting us at the end of the day. And I'm an Indian. We are getting hurt as well. So to that extent, you don't like the policies. But the fact is, his job is to look after America. He's doing that for America.
Okay, let's talk about the Indian perspective. And yes, Trump is looking out for America, we're looking out for India, as we should. Now, in a world like that, what happens to the economy, what happens to certain sectors, and what happens to the equities? What do you think is the perspective on Indian equities right now, which seems very bothered with what's happening globally, but it has that underlying strength?
I think, we have developed now a third pocket of equity investors, which is the portfolio managers and AIF. So while we keep reporting mutual fund and FIs, now you see a diverse movement, or even on days when the FIs are selling, even the DIs are not buying, the market is showing resilience. And I think the third big pocket, which is coming up, the portfolio managers and AIF, is becoming a huge pillar for investment in the country, and money is still pouring in. So on a demand supply front, I think demand for equity is going up and will further go up if RBI pursues the path of interest rate reduction, because your returns on savings and fixed deposits are going to go down. You're going to look at alternate. So equity markets are resilient. They have got enormous demand potential. They face only one drawback, that you will see in the next 1 to 2 years, a lot of allocation going to metals. People have missed out the big metal rally which has taken place, gold and silver. Silver is still coming off for the tracks at this point. So I think you will see a large amount of allocation of capital to those two precious metals. But having said that, I think we have a resilient market. Just remember, Tamanna, that our market levels are same exactly at the time when the war broke out between Israel and Iran. That says a lot for the market. It can say also for the stupidity of the market that you're not recognizing the reality. Our valuations are up, oil prices are up. Globally, the markets are a little bit disarray, but our valuations remain flat where they are. So to that extent, you have to take pointers to say, take some profit off the table, just like all the institutional investors are doing, promoters are doing. Retail investors who are not taking profit from some of the stocks they hold, I think will tend to rule them in the next 12 to 18 months.
So no, just to recap that, you're saying retail investors who are not booking profits right now will regret it. How should you look at your portfolio and decide where to lighten the load?
See, people who are in the commodities, for instance, I think they're stuck with the commodities. I think basic non-ferrous, ferrous commodities, it's not moving anywhere in a hurry. Basic stocks, the old favorites used to be the cement stocks and steel stocks and all those things. They're not going to give you a return. So if you're not booked your profit out, you need to do it. A lot of infrastructure stocks, again, have run the role. Government is not going to spend more money, as you've seen very clearly. It's not willing to move to spend more money in infrastructure. So infrastructure-related theories and stocks are going to suffer. Railways is a great. It flatters once. It's like the flower which blooms once in 2 years. It flatters, then it deceives. It flatters, it deceives. So I think you will be cautious as to where the railway stocks are going. You'll be cautious where the consumers are going. With the P multiples of 100 plus. You got to be incredibly brave to be buying the stocks, and market can remain irrational. I can promise you that much. But the fact is, when you buy a retail stock which is selling, Kirana store selling at P's of 100, I think what are you buying, really speaking? I wonder what growth rate investors factor in when they buy a Kirana store or a bigger Kirana store stock for a P of 125.
Well, okay, Ajay, I don't know if I don't know if you're referring to the same one, but one of the, not Kirana stores, but a large retail format store just reiterated in an annual report that they will grow up revenue from FY23 to FY2032 by 10x. They reiterated that, and a simple back of the envelope math suggested that they therefore are saying that they might grow at 25% CAGR from FY25 to FY32. Now, is that a good enough growth number for, let's say, a trend to trade at the valuations that it is trading at?
Well, the answer is that yes, companies aspire for growth. I think you have to factor into say, are you the believer in that growth story? It has done a tremendous job. I'm not quoting the stock, but just quoting that past is never a feature in the future. The market is changing, the nature is changing, the way people are buying is changing. You used to walk to the department store, you don't do it anymore. You go blink it, right? At the end of the day, it's such a, is a Godrej Almira of retailing today. Literally, if everybody wanted to Godrej Almira, today you say, just blink it. At the end of the day, the formats are changing, retail is changing, the margin is not there in the business. So who's going to give them the margin in the business at the end of the day? The competition is intense at this point of time. So yes, you can factor in that it will happen. The question is, one, growth is never a trajectory. It happens in spurts and busts. Number two is look at the economy, 6.5% growth rate. For you to grow 25%, you got to invest serious amount of capital and grow the stores, and same store sales have to grow for you to make the valuation. Remember this, you're working on a base. Now, existing stores to grow 25% is impossible. It's just impossible, right? So you're going to develop so many more stores. Where are the localities, destinations, purchasing power, etc.? So you should temper it down. Management have a right to expect the moon, but you as an investor needs to know where your money is going to be made. It may still come true, but I think that's not a game where you're going to make that kind of multiples.
Okay, fair call, yeah, and that's a pertinent point. If whether you believe in what the companies can do or may not be able to deliver. Okay, Ajay, so I heard you say that investors who don't take money off the table might review over the next 12 to 18 months, which suggests that on highly valued stocks, you are not that constructive. Therefore, what are you buying? Are you buying value currently in the market? Are you screening your screen for stocks which will be trading at sub 20 times multiples and willing to grow 15-20%? How are you doing this? And what are those pockets?
Okay, Neeraj, we are not buying anything except the fact we bought everything that PE funds have taken controlling stake in. Okay. That's been our biggest theme in the last 1 year is follow the PE fund, because we know exactly the kind of due diligence they do, the level of follow-up they do, the level of incentive they give to the management. And we know for sure that most PE funds look at structuring a deal for 5 to 7 year takeout, which fits in perfectly for the investors. So you don't need to do your homework. You follow, and best part of India, Neeraj, is that in last couple of deals, you as retail investors, you could even get in at lower price than what the PE funds got in. That's the best part. It just takes away a due diligence mode, just takes away conflict of interest mode, just takes away the fact that man needs to exit in 5 to 7 years with his return, and he's promising his investors 25% dollar rate of return. Remember this, most PE funds are promising between 20 and 25%. So he's going to put his heart out to get your investment return done. So we have followed a simple model is very unglamorous, very uneducated, totally in North India called Jat Buddhi. He's done his work. Let's just follow him. 9, 10 out of 10, he's going to give the returns. And I can promise you, wherever PE funds are taking controlling stake and you can get in along at the same price, it's the best place to be, irrespective of where the market is.
Ajay, wondering where you're seeing opportunity right now, or pockets of opportunity right now. What are the cash positions you're holding, if any? And, what are you then finding interesting and waiting for that kind of turn of the cycle?
See, if you look at the data today which came out, Tamanna, which said that the advanced tax has barely grown by 4.5%. Numbers may change, numbers may go up if 2 more days data comes in. Okay, which tells you the trajectory of the earning in the market at this point of time. And when earnings, kind of go at 4.5% advanced tax, we are in for tough times at the end of the day. Therefore, there is no necessity to buy. What you said, what are the themes you want to buy? I don't want to buy anything much at this point. And where do I put the cash? It's a brilliant, we have got a large investment in a power REIT in this country, power transmission REIT. It's given a fantastic return over the 5-7 years. It's given dividend, increasing dividend. Its share price has gone up, unit price has gone up. So you don't have to park your cash away in a saving bank account. There are enough opportunities which give you equal return in the market. And so if you're getting 15-16% returns from these kind of a power transmission REITs, you are not badly off to keep the money there and wait and see what happens to the correction. Let's not forget, Tamanna, look at the stocks just 6 months back when the correction happened. They were 40 to 50% down in less than 3 weeks' time. And now they have climbed back the wall of worry. There will always be a correction. The question is, do you have liquidity to buy into the correction? That's the question you have to answer. Or did you ride the correction holding fully invested? Today is the time to buy other stuff and keep it. If and when it corrects, nobody's saying make it zero. If and when it corrects, you buy it, and you buy things like, let's take hospital themes, you buy things like medical care theme, medical devices theme. Engineering companies in India are extremely good companies, globally competitive. Auto ancillary companies are very good in India, supplying the world. We have a good amount of, so many new age companies have come up. If you're not bought it, you can buy them into it. So India has no shortage of choices to invest. The question is, have you got your entry price right?
Is the entry price right? Now, I mean, people who can time an entry price, I suppose, are in a different league, Ajay. But right now, from a long-term perspective, say a 3 to 5 year perspective, someone is looking at rebuilding or shoring up a portfolio. What are the key sectors that you're finding most attractive?
As I said, engineering is one of the key sectors in India. We are strong. Nobody can duplicate it. We are even better than China in most cases in engineering. Oh. So that's one sector I can tell you where we are really strong. And aligned to engineering is the auto ancillary segment. We are really strong. Our ecosystem is very good. Nobody can beat us in the world. Let me tell you, nobody can beat us in this world. So auto, two-wheeler auto segment in export market, auto ancillaries, engineering is one segment. We are unbeatable in the global markets. Number 2 is local healthcare, hospitals. Now, you can't recreate a hospital overnight. Whoever has got it is charging you the moon. And anybody who had unfortunately been to a hospital of late knows how much money he pays out compared to 3 years back. So that is one segment which is growing leaps and bounds, safe, Indian, domestic. Pharma, I know there is a cloud over the pharma in terms of the US, but I think Indian companies are smart. If you look at one Indian company, he just bought a biologics manufacturing facility in US. So they are alert to the fact that things will shift. And contrary to what people imagine, I can tell you, there is huge capacities in America and Europe in biologics manufacturing, in NCE manufacturing. So let's not kid ourselves that, if we don't produce, world will get shortage. There'll be no shortage. There's enough manufacturing capacity, maybe a little expensive. But Indian pharma companies are very smart, number one. Number 2, 50% is domestic and other markets, so it's not that bad. So pharma, healthcare, hospitals is a theme along with engineering you can play with and relax, because we are good in those 2 places and competitive in those 2 places. And we don't need tariff support from government in all those places.
Okay, that is important, where we don't need government support, and the tariff view is something that we have to navigate as well. Thank you so much, Ajay Srivastav. Thank you so much for joining us. Always a pleasure. Yeah, you too. You too. All right. So a lot developing in the markets, not so much, but geopolitically as well. And this statement from the Foreign Secretary, I thought was interesting, Neeraj, and he's put out a soundbite as well, where a Prime Minister's response to Operation Sindoor has been reiterated in a phone call with Donald Trump. So Prime Minister Modi has gotten onto a phone call with the US President, reiterated our position, said no intervention. We do not want that. And plus there was an invitation to the United States, which the Prime Minister said he will not accept because there is a prior commitment.
Yeah, and then both leaders have agreed to meet at a mutually convenient time in the near future. But I think this was a reiteration which was done by Prime Minister Modi. So, well, we'll bring up those sound bites as well a bit later on in the other shows. But for now, from Tamanna, me and the team that has put this show together, we thank you for tuning in. But keep in mind that is a wide angle of geopolitics alongside everything.
I just want to contextualize that, and let's see if we can pull up that part, Neeraj, because the important point on it is that Donald Trump is meeting the Pakistan Army chief today. So you have to look at all of these statements with that context as well. And there we have that address from Vikram Misri. Let's play it out.
प्रधानमंत्री मोदी ने राष्ट्रपति ट्रंप को स्पष्ट रूप से कहा कि इस पूरे घटनाक्रम के दौरान कभी भी किसी भी स्तर पर भारत अमेरिका ट्रेड डील या अमेरिका द्वारा भारत और पाकिस्तान के बीच मध्यस्थता जैसे विषयों पर बात नहीं हुई थी। सैन्य कार्रवाई रोकने की बात सीधे भारत और पाकिस्तान के बीच दोनों सेनाओं की एग्जिस्टिंग चैनल्स के माध्यम से हुई थी और पाकिस्तान के ही आग्रह पर हुई थी। प्रधानमंत्री मोदी ने जोर देकर कहा कि भारत ने न तो कभी मध्यस्थता स्वीकार की थी, न करता है और न ही कभी करेगा। इस विषय पर भारत में पूर्ण रूप से राजनीतिक एकमत है। राष्ट्रपति ट्रंप ने प्रधानमंत्री द्वारा विस्तार में बताई गई बातों को समझा और आतंकवाद के खिलाफ भारत की लड़ाई के प्रति समर्थन व्यक्त किया।
All right, that's all the time we have on India Market Open. We'll take a very short break, but stay tuned. Ask Profit up next.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make in our categories that we have been supplying to our defense forces some of the best platforms in the world.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and with me is Mahima Vachajani. And we were just talking before the start of the show. There are some stocks that we can't get you advice on. For everything else, there's Ask Profit. And so, from that perspective, you can get on the phone lines The number that you see at the bottom of your screen is where you can call us. You can send us a message on the number on the top of the screen. That's the WhatsApp number that both of us have access to. Let's take you through what's happening with the markets right now, and it's a bit of a quiet day. And this was anticipated after the romping rally that you saw earlier on in the trading week, and we're trading in a pretty narrow band. Of course, we're bang in the middle of the band that a lot of chartists are identifying as the key one to track for the Nifty 50 at this point, trading just below the 24,900 level. The broader markets, let's look at where they are right now, because you've seen quite a bit of chop and churn in the broader markets. That continues to be the case today as well. Just about flat for the mid-cap index and about gains of 0.2% or 0.1% for the small-cap index. So not too much to speak of really at the index levels. What is IT doing? Yesterday it was the star of the show, but today it's languishing down about 0.5% or so. What you're seeing action in though is the auto pack, because the entire Nifty auto was up over 1%. I wonder what it's doing right now. It is up about 200 points or thereabouts. Maruti Suzuki, Eicher, M&M all doing reasonably well in trade off the high point of the day. At one point, all three of them were trading with gains of over 2%. A couple of stocks not doing too well, Balkrishna Industries as well as Tube Investments among them. Talking about what the major contributors are on the Nifty 50 today, M&M on the top of the list. You have Bharti Airtel, Reliance Industries contributing to a certain amount, but just about 0.5% gains, nothing too much to speak of. And the heavyweight IT companies are actually languishing at the bottom. Infosys as well as TCS losing ground. Incidentally, we had an expert speak to us in the closing show, in the opening show today, and he was speaking about the fact that he's not holding IT. So the jury is out. He's actually sold IT over the course of the last 6 months.
80% of what is holding.
And so the jury is out. Are you using those opportunities to buy, or do you have conviction that things are going to improve over the course of FY26 or not?
In fact, even I was just looking at the return potential that the Bloomberg estimates suggest, and all of these major IT companies, your Wipro, your Infosys, HCL Tech, the return potential is anywhere between just 8 to 10%
so
for a year.
Not very much.
Yeah, not very much.
Better than FT returns right now.
Yes. But I think that post the tax, it's going to be the same as what FD is doing. So yeah. Keeping that in mind, but with that, let's also welcome in our guest for the day, Rajesh Agrawal, Head of Research at Ugro Capital, and Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, joining us now. Welcome to both of you, Rajesh and Vaishali, and a very good morning to you. I'll take up the first question, which is from Girish, who's writing in from Hyderabad, and he wants to know whether this is a good time to make an entry into Hindustan Zinc and Vedanta. If one is to select, which one is better? His portfolio is already 62 lakh rupees, and he has 3 lakhs of free cash to invest in. Rajesh, I'll come to you on this one. He's asking whether he should invest in either Hinzinc or Vedanta right now. What's the view like?
Good morning, Mahima. Good morning, Alex. Good morning, Vaishali. First of all, if you choose a metal stock, keep this in mind that metal pack as such is prone to a lot of volatility because of international conditions, moreover China policies, and also you would be prepared for that. And you must be having a time horizon of a longer time horizon, I would say maybe 12 to 18 months, then only try to buy anything into metal. As far as out of these two stocks is concerned, I think both are all the same. Hindustan Zinc is again a holding company of Vedanta. Vedanta is a holding company of Hindustan Zinc. But at this point of time, I think Hindustan Zinc would be a better play out of these two because of the kind of valuation it's trading at. And we see considerable upside in Hindustan Zinc, maybe a target of 520, 530 odd levels in the next 12 months. So out of these two, if you have to select, I would say go for Hindustan Zinc.
Hindustan Zinc in focus today, of course. Yesterday it was trading ex-dividend, and there's the offer for sale also. Smaller quantity is being offered than was anticipated, but still the stock is taking a bit of a knock in trade today. The offer price was a 7% discount to yesterday's closing price. So that's what is affecting the stock today. We've got our first caller, Pradeep from Bengaluru. Pradeep, very good morning to you. How can we help you today?
Good morning to everybody there. See, I am having 100 shares of Man Infra, bought at 94 rupees.
Okay.
Since I had purchased it because of the government stress on infrastructure and the company was doing well, it has given me profit. But for the last few months, it has not moved any appreciably. So I just wanted to know whether I should hold or whether I should book profit.
Pradeep, help me understand, when did you buy this stock?
This was purchased
Approximately. I just want to know, was it last year or the year before that or a few months back?
It was year before.
Oh, it was a year back. Okay, and so and when you bought it, you had the intention to hold for the long term?
Yeah. I am basically a long-term investor.
Yeah. Okay, so that's what I wanted to clarify. It's a 6,000 crore company, Man Infra Construction, and it is currently trading at 164. So it's a doubler practically, not nearly, but pretty substantial gains for you. Rajesh, on the fundamentals, therefore, he's wondering why the consolidation takes place. I think that's par for the course if he's made gains as he has over the course of the last year. What should he do right now?
See, at this point of time, I would say continue to hold. If you don't have any requirement of fund as such at this point of time, you can continue to hold till a target of 180 and 185 is reached. Company has good order book, they're doing well. And as you said, right, that the focus is on infra and a lot of infrastructure projects are coming up in the next few years, I would say, with the government's focus on that. Man Infra being one of them, but it's a smaller company, no doubt, but still they have got good order book and a target of 180, 185 is quite decent. As far as consolidation is played, you asked about consolidation. That's the beauty of the market. Sometimes even very good big stocks take a lot of time to give some decent return, and you are sitting on a very decent return. So keep holding. Have a target of 185 and continue to hold.
So with regards to where Man Infra stands, our next question is from Rohit Srivastava, who is writing in from Prayagraj, UP. His question is on Mazagon Dock Shipbuilders. He's bought 900 odd shares at 3150 a piece. So he's sitting on a significant profits of 1.2 lakh rupees. And he's saying that he can hold it for the next 6 odd months. Wants to know if he can continue to hold or book profits at the current level. Vaishali, I'll come to you on this one. What are the charts indicating for the next 6 odd months?
Very good morning, all of you. So yes, I think defense sector is the flavor right now. And yesterday also we saw that we were getting into new round of momentum in all the defense stocks. So talking about Mazagon Dock, the long-term trend is intact. But since he's sitting on good profit, I would say keep 3,000 as, 3,000 as stop loss. And I think for 6 months, expect a target of 3,800 to 4,000 levels.
That's a substantial upside even from this stage. Yeah. And what a pack it has been for investors, the defense pack. It's been rewarding to say the very least. And in fact, Vikas, who's calling us from Mangalore, has also decided to invest in the defense space. Vikas, very good morning. And you've made substantial profits, so kudos to you. What would you like to know about?
Yeah, is it overvalued or can I hold it for a year or more than that?
So, you know how they say beauty is in the eye of the beholder, value is in the eye of the investor. So it's a valid question that you're asking, Rajesh. To each their own, I guess. What do you think? Is it overvalued? Would you take money off the table?
See, if you talk of valuation at this point of time, the entire defense pack would look at overvalued, be it any company. But the thing is, the kind of order book they have, the kind of geopolitical tensions which we are witnessing from the last so many months has given boost to the defense stocks, and the government's focus on increasing defense expenditure, companies getting international orders. These are some of the positive points which we have in our defense pack as such. So yes, at this point of time,
Rajesh, in case I didn't mention, the name of the stock we're talking about is Apollo Microsystems, and he has bought at levels of 105. The stock is currently trading at close to 200. So therefore, the gains that he has are about 45,000 rupees.
Okay. So that's what I was trying to say. If you look at valuation at this point of time, the entire book would look overvalued. But I look at the order books and all. So looking at Apollo Macro as such, I would say switch from this to maybe a better name like a BEL or BEML, which have good order prospects. They have good existing order book. They're doing very well. So why not book some profit over here and switch to BEL or BEML? That way you will be in a defense pack and doing in a better company.
All right, so that's with regards to where the entire defense pack stands. Our next question is from Shubhangam Sarkar, who's writing in from Kolkata. I hope I'm pronouncing that name correctly. He's holding a few shares of Geo Financial and is thinking from a short-term perspective for this counter and wants to know if he can buy more at the current level or sell the current holding. He's not given us what his holding is exactly. But Vaishali, I'll come to you on this one. Should he continue to hold Geo Financial, add more, or sell at the moment?
I would say, well, if it's a short-term perspective, keep stop loss because the stock has run up right from 200 levels to making a high of 300. Currently, it is showing signs of retracement, but if it dips below 280, it could cause further weakness. So keep 280 as stop loss. And either ways, if it goes below 280, it is a weak stock. And if it moves above 310, then it's back on track for a further run-up. So that's the way to make a view for this stock.
So that's the perspective as to where charts are concerned for Geo Financial, and we have Dheeraj also who's calling in from Hyderabad and has the same query. In fact, he's got query on Geo Financial itself. Dheeraj, just wanted to know whether this solves your query, or do you want a fundamental view on this one?
Ma'am, I actually, Vaishali ma'am just cleared this query, so could I ask some other query?
Sure, you can go ahead and ask another query.
Ma'am, I'm holding 25 shares of Dixon Tech at 16,040 rupees, ma'am.
Okay.
So I can wait for next 1 year.
Okay.
So could I see an upside target of around 17,500 or 18,000? In this is my query, ma'am.
Okay, and you want a technical view on this one?
Some short-term trades also. Any queries from both the experts also I'm expecting.
Okay, all right. Okay, Dheeraj, I got your question. It's an interesting one. Dixon is currently trading at around 14,400 odd levels, and Vaishali wants to know if this could reach that 18,000 mark in the next 1 year. Do you think that's possible?
So, well, let's go step by step. Right now, there is no conviction, but it is in the process of improvement. When I'm looking at a weekly chart also, it's at a good support level. So I would say keep a support of 14,000 levels. And once we see the stock sustaining above 15,300, 15,500, then very likely this will go towards 17,000, 18,000. So that would be the view, 14,000 as final support. And once it crosses 15,300, we are aiming for higher targets.
Okay, all right. So that's the view on Dixon Tech, play in the EMS space. Cooled off just a tad bit after that red hot run that it saw just about 2 months back. Satyan has got the next question asking about Shivalik Rasayan. Okay, I'm going to try and pull this up. I'm not sure if we're going to be able to get a view. And as I'm pulling it up, it's only an 839 crore market capitalization company. 532 is where the ticker reads right now. I'm just wondering, Vaishali, if you have any view on this stock, if you can help him with it. He's bought at levels of 690 and he's wondering whether to hold for a while or switch to something else.
So there is no positive sign right now. Only consolation is that this stock is in deep oversold. And today's candle shows a little bit of ray of hope. So keep stop loss of 500. Wait for it to bounce towards 580, 600. We can have a relook. The final major resistance comes at 640. So keeping a stop loss of 500 is essential just for the aim of having a bounce back view.
All right. So bear in mind that not too much deep insight on this one because it's not actively traded. Its volumes are very, very less. And also it's a very tiny company, 800 crore thereabouts. All right, Pradeep is calling us from Vizag. Pradeep, very good morning to you. How can we help you today?
Yeah, very good morning and thank you for taking my query. I have 80 shares of CDSL.
Okay.
Average price of 1400.
Okay.
Shall I add more or shall I book profits?
What is the time frame that you have in mind, Pradeep?
Yeah, I have 3 to 6 months.
Okay, only 3 to 6 months. Okay. All right. So a couple of these capital market plays in focus, not least of which the BSE because of everything that's happened overnight or rather from last evening. And I'd be curious to find out what Rajesh has to say about that incidentally. But before we do get that view, CDSL, on the charts. Vaishali, 1,400 is the buy price. Should he buy more?
I would say so. Wait for a little bit of a dip. Ideal level would be near 1600 levels. Even on a weekly chart, when I'm looking, it is showing a good rounding pattern. So I think 1600 to 1500 is a very good support band. That is a level where one can accumulate. And I think look for higher targets for, if 6 months is the horizon, then I think 2000, 2200 should be the target.
Okay. Now, we're not in the business of predicting stock price moves, but we did have a bit of a bet going in the morning about what would happen with BSE after the change in the expiry day. And Tamanna was of the view that it would not have a big gash, and that has proven to be correct. Like I said, we're not in the business of predicting market moves. The question is, should you buy at this point, given the kind of change that you've seen? And Rajesh, the question is for you. The anticipation is that in the near term, it's going to affect derivative volumes, and there's going to be perhaps an implication for the market share as well. And so therefore, EPS estimates would have to be adjusted a little bit lower. Valuations are not cheap. It's trading at over 80 times trailing. So would you buy at this point, or would you hold if you are holding, or book profits?
See, Alex, first let me tell you that we have been recommending BSE since last 2-3 years when it was trading at around 500 rupees. And now after the bonus and all, it's trading at 2,600. That virtually means 7,800 of the 500. We are still bullish. We are still recommending our clients to buy. Even yesterday, we got frantic calls from a client who are holding what to do. We just said, hold on, because most of the market participants are ignoring the fundamentals of the company, rather focusing on just one thing from the last 2-3 months about the expiry day of the F&O contracts. Whether it will be Tuesday or Thursday, that was the point of discussion from last so many days. But the fundamentals are very strong. If you look at the company is doing well. The numbers this quarter were very exciting, I would say, where NSE showed a degrowth, BSE showed a growth of in the bottom line and margins and everything. They have the biggest mutual fund platform, that's Star Mutual Fund. They have presence in Gift City, that's the first mover advantage. They have cash positive, they're giving good dividends, no dearth of cash with them, no corporate governance issue. And the best part is the Sensex futures, which have been introduced, have been doing very well. And talking about volumes in the options market, they had 0% market share around a year back, and now they are sitting at 15-18% market share. Yes, there might be some amount of turbulence in the short term, but for a longer term horizon, I think if there is any further fall in this stock, maybe around 2,500 odd levels would be a very good level to buy.
Okay, so that's with regards to where BSE stands, and quite a comprehensive view on that. Thanks for that, Rajesh. Our next question is from Mayank Saraf, who's writing in from Delhi. He's holding 2,000 odd shares, bought at 750 a piece of Kalyani Steel, and wants to know if he can add more from a 3 to 4 year perspective. What he's saying is that since the company is already also entering in the aerospace and defense, do you think this is the right counter to make an entry and average out? He's already sitting on profits of 2.8 lakh rupees. Rajesh, do you think that's the right thing to do?
No, I feel one should continue to hold. The company is doing very well. The numbers have been good. The management commentary has been exciting. We feel if somebody holds for 12 to 18 months, I won't be surprised if this move into 4-figure. Continue to hold.
Hold is the view that's coming in on Kalyani Steel from Rajesh. All right. Our next caller, Rajesh, is calling in from Mysore. Rajesh, a very good morning to you. How can we help you today?
Hi, ma'am. Good morning, ma'am. Namaskaram, madam.
Namaskaram, Rajesh.
Ma'am, right time to buy Adani Power correct level, ma'am. In short term, in 9 months, 5 lakhs investment, ma'am.
Okay, and is this a major chunk of your portfolio? I mean, just want to get a sense because 5 lakh is a big amount.
Ma'am, big amount, ma'am. Correctly, new purchase, ma'am.
Okay, so what I'm trying to ask is that is 5 lakh a major part of your portfolio, or is your portfolio big enough that you can invest 5 lakh in just one counter? Okay, no worries. Rajesh, I think the line is dropped there. I'll take this up with Vaishali. Vaishali, 5 lakh is a significant amount to invest in one particular counter, but he wants a view as to whether he can invest that entire amount for the next 9 months in Adani Power, or would you suggest him to diversify?
Definitely say diversify because, Adani Power no doubt is at a good support levels, but there are many other stocks in this category which are also having a good strong fundamental backup like transformer rectifiers, Hind rectifiers, Tata Power. So I would say get into a basket of power stocks.
Okay, basket of power stocks is something to look at. By the way, standard disclaimer, what you just heard about is Adani Power, it's part of the Adani Group, and so is NDTV, of which NDTV Profit is a part. Moschip is the next counter that we're talking about, and Advocate Abhay Pratap is writing in. He says he goes by Neeraj, which is a very interesting, very interesting update. Okay, but let's talk about his purchase. He's bought at levels of 251, and he's saying that he's in a significant loss. Yes, he is indeed losing about 36,000 rupees or thereabouts. He can hold for a year. What's the view, Vaishali, on the charts?
Which stock are we talking about?
We're talking about Moschip.
So Moschip, the stock has been doing quite well, and right now it is just in a consolidation phase. So I would say that, if it has to correct, I think 160 is the final support. So depending on your time horizon, keep 160 as a range and 200 as a resistance. So this is the range that we are looking at, and follow the trend accordingly.
Okay, follow the trend accordingly. Deepak is calling us from Pune. Namaskar, Deepak. How can we help you today?
Good morning, everyone.
Good morning.
So, I have 20,000 stocks of, shares of Yes Bank at 21.12.
Okay.
And it's not looking promising for the past couple of weeks. So, and it's gone down to about 18.9 levels yesterday, what I saw. So, should I sell or should I add more and average out?
Okay.
And what are the short-term prospects? Probably 2-3 months.
Got it. So, am I right in assuming, Deepak, that you bought it for a quick pop? It's a trading strategy?
Yes, I was looking at about 3 months.
Okay, looking at a short-term time frame. Okay, so then Vaishali, I'm coming back to you on the charts. Loss of 20,000 odd because it's a very significant quantity. 20,000 shares bought at levels of 21. What would you do with this?
Well, there's really nothing much happening, but now that he has bought, keep 19 rupees as a stop loss. And wait for it to bounce, because if it doesn't, if 19 rupees breaks, then you could see further sell-off. I would always say that, when you're buying a big quantity or something, always get into the frontline stocks as compared to these.
Yeah, absolutely. The tendency and the temptation is to take very large positions because it becomes affordable. But, for example, I'm not saying you should go out and do it. Bajaj Finance has just become much more affordable, and you can buy a significant number of shares just like you would any other very small counter. All right, we have to slip into a very quick break. We've got more time on the other side to take your questions, so keep them ready.
That's huge. That is a biggie. It's on.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true. And today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research.
Welcome back. You're watching NDTV Profit, and this of course is Ask Profit, but the next show that starts at 11:30 is Know Your Company. And in case you're hearing about it for the first time, let me tell you what it's about. It is a research-driven show that gives you insight, deep insight on one particular company. And incidentally, the stock that was chosen today is a stock that is in focus. Pull up Zydus Wellness. This is a stock that is up as much as 7%. The latest update is that Parag Parikh FlexiCap fund has acquired a significant chunk, as much as 7% stake in this company. And the stock is reacting to that as well. Now, there are several metrics that you should understand about this company. It is in the consumption space. It is in the nutraceutical space, which Mahima tracks very closely. But what was interesting to me was the fact that valuations and it's a very key consideration for something like a Parag Parikh.
Correct.
It's trading at 35 times 1 year forward, considering an 11% EPS growth over the last 5 years.
Correct.
Which is, even at this point, despite a 6-7% increase, not expensive.
Absolutely.
But beyond that, there's also rural penetration, revenue growth, all of those boxes are getting checked.
Yeah, absolutely. So Zydus Wellness is more of a rural penetrated company, and which is working in favor of them, because last 6 odd quarters we've seen rural take off, urban has not, and that is why we're seeing major FMCG companies not doing very well, versus that of Zydus Wellness, which is actually growing in double digits in terms of volume. So it's a very interesting FMCG company to look out for in terms of valuations.
Yeah, on the multiples, right? You're talking about
exactly.
FMCG companies that are at 70
Anywhere
plus.
between, yeah, 70 plus.
So therefore, from that perspective, it's an interesting one. Now, by the way, if you haven't watched KYC ever, you will know, or let me tell you, that there is a rating that the team gives based on various metrics out of 8. And depending on how high it ranks, there has been an instance in the past where stocks have reacted because people go out and buy if there's a good rating. But this is all based on fundamentals. Let me very quickly take a view. Rajesh, a quick view on Zydus Wellness. Of course, this is one mutual fund buying. It's just that they're high profile in that sense, right? A lot of people view them as value investors. Would you suggest entering at this level?
We have been recommending this stock for the last 2-3 quarters, I would say. We came out with a IC on this. This strong company, especially from the OTC side of business, that's doing very well. They made some acquisitions, and in the last 2-3 quarters, we have seen the margins have expanded. So even after this kind of run-up, we feel that there is a lot of upside left in this stock. Maybe a return of 15-18% is quite possible in the next 1 year. So we have recommended this to our clients, and we would say that any dip should be taken as an opportunity to accumulate.
So that's the view with regards to Zydus Wellness, and we're also going to be in conversation with the CEO of Zydus Wellness, who's Tarun Arora, on the Know Your Company show itself. So do tune in at 11:30 as well. All right, our next caller for the day then, Kaushik is calling in from Hyderabad. Kaushik, a very good morning to you. How can we help you today?
Hi, a very good morning to everyone. So I hold Cummins India stock.
Okay.
I hold 10 shares at a price of 33.88.
Okay.
So I would like to know if I can hold them or sell them.
Okay. And this is from what term perspective? When you bought Cummins India, was it the fundamental? Okay, short term. All right. Got your question, Kaushik. I'll take this up with Vaishali. Vaishali, what are the charts indicating for Cummins India?
So I would say actually all capital goods, whether it's Cummins, ABB, they are showing signs of improvement. So chartically point of view, Cummins is already in the process of higher bottom formation, which shows that yes, it's getting into a trend. So I would say continue holding, and I don't think that stock should be held with a stipulated time period in mind. These stocks should be held on for a long term, because I think even for a positional trade from 3,200, of course, not to miss out the whipsaws in between, this can very likely go towards 4,000 plus levels. So in my opinion, this is a hold.
Hold is the view coming in on Cummins where charts are concerned. I hope that answers your query. Kaushik, next question then is from Sanjay, who's writing in from Pune. He's holding 60 odd shares of HAL over the past 2 years, and he's bought this in SIP format at an average price of 1780, and he's saying that he can hold this for the next 3 to 4 odd years. Should he book his profits right now, or should he continue to hold is his question. He's sitting on profits of nearly 2 lakh rupees now. Rajesh, what would you suggest?
Continue to hold and continue your SIP too.
All right.
Company is doing well, good order book with a kind of focus on defense, not only for domestic orders, but also international businesses coming in. I think this company is going to do well. Yes, there might be some hiccups here and there because of execution and all, but on a longer term time frame, it's a good company. Continue to hold.
Continue to hold HAL and continue with the SIP as well, as the view coming from Rajesh. All right, our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. I believe you have a question on Emcure Pharma today.
Yeah. Good morning to you. And my question is to Mr. Rajesh Agarwal.
Okay.
I bought 300 shares of Emcure at 1,357.80 in January 25. So it has crossed to 1,400. I could not sell. Now it's not doing much. Equally, I have Premal Pharma around the 198.70, about 1,000 shares. Can I switch from Emcure to Premal Pharma, or exit both and look for elsewhere?
Okay, got your question, Murli. I'll take this up with Rajesh. Rajesh, do you think that's the right thing to do? Shift from Emcure to Piramal Pharma, or any other counter that you like in the pharma space?
See, continue with Emcure. That's a good company, recently listed. So not much of a data available, but still I think with the kind of data, whatever it is available, we have seen the company has prospects to do well. Maybe a 15-18% CAGR return on the revenue side and bottom line, it quite possible in the coming years. I have a target of around 1,600 odd rupees in the next 1 year. Continue to hold.
To hold, despite the fact that it's up about 44% over the last 3 months, the upside potential still exists for Emcure Pharmaceuticals. All right, Murli, I hope that answers your question, and you've done your research as well. Keep calling us. We tend to learn also when you do. We've got Lanka Durga Prasad, who's sent us a message from Rajamundri and asking about Canara Bank, bought 1,300 shares at a price of 105.6 rupees per share and looking for a long-term view. In the green right now, is there a view on the fundamentals that you have, Rajesh? Is this the top pick in the banking space according to you?
See, the entire PSU banking space is looking very exciting because of the fact that balance sheets have been cleaned up, interest rate cut has been there, CRR cut has been there, the liquidity has been improved. It's just a matter of time when credit uptake starts taking place. So NIMs would be taken care of. Now, coming to individual banks, I think Canara Bank is one of the good banks which one can hold. Other banks, if I talk about in the large cap space, it's SBI, PSU side. And in the small cap space is Bank of Maharashtra, which has been doing extremely well in the last several quarters on every parameters base, deposits base, advances, NIMs, asset quality. They have raised some money through QIP, and maybe when government is going to dilute some stake because of the shareholding norms. But still, Bank of Maharashtra is one of the best bank in the PSU side, I would say.
Okay. All right. Govind is calling us from Hyderabad next. And Govind, very good morning to you. How can we help you today?
Yeah, good morning, Alex, sir. Good morning to all of you, sir.
Good morning.
Sir, I have brought Natco Pharma 600 shares at the price of 999 rupees for past 1 year I am holding, sir.
Okay.
Can I book losses and then shift to the Laurus Lab, sir? Is it right time to enter?
Okay, I just want to clarify one thing, Govind. Is this a long-term investment that you're planning, or is it a short-term view that you're looking at?
Actually, at least I can hold at least another 1 year, sir. I can hold.
At least another 1 year. Okay, from that perspective, then let me ask about the fundamentals, because there's a pretty substantial loss that he is going to have to book, Rajesh, if he does book out of Natco Pharma, and he's looking at Laurus specifically. Of course, the Pharma pack as a whole took a bit of a jitter yesterday when this conversation about tariffs in the US came about. And of course, every time that happens, there's a bit of a jolt. So till that uncertainty happens, I guess there's going to be a bit of an issue. What would you advise him to do?
See, Alex, this is a difficult one because both the companies are very good and both are in our buy list from a very long period of time. Choosing one would be a difficult task. Coming one by one, Natco is doing very well in the oncology space. This quarter numbers were a little disappointing, I would say, but one should look at these companies for a long-term horizon because of their approvals and all. So Natco can be a good long-term buy. And as far as Laurus is concerned, they are doing very well in the CDMO space, and their contribution of CDMO in the entire revenue space has increased. This quarter numbers were very exciting. Margins have improved. They have reported profits. And going forward, we believe that this company can show a good return, maybe 18-20% return in the next 1 year or so. So what I would say, continue with your Natco for a long-term horizon. And if you have spare money, invest in Laurus.
Okay, invest in Laurus is the view coming in from Rajesh. Our next question is also for you, Rajesh. Shakib from Guwahati is writing in. He wants to know a good stock to look at from an attractive valuation perspective that he can make an entry into right now from a longer term perspective and of course growth perspective. Which stock would you recommend him to invest in?
See, Maima, there are a lot of stocks. In every market, there are a lot of stocks to invest if you have a look. But at this point of time, in large cap space, I can recommend Reliance and Larsen and ITC. These would be the three stocks in the large cap space. And the mid cap space, I can recommend ITC Hotels. The other one be IRCTC, FIM Industries. And the small cap space, which Bank of Maharashtra, which we discussed just now, and Park Hotels. That's AP Surendra.
Okay, so those are the picks that Rajesh has given. I hope that answers your query, Shakib. Our next caller, Vishal, is calling in from Chandigarh. Vishal, a very good morning to you. How can we help you today?
Oh, very good morning to you, ma'am. I hold shares of Vatek Vabag.
Okay.
275 shares at the cost of 1595.
Okay.
Now, this company is into water and wastewater treatment. The government's focus on this theme and good quarterly results. I just want to know whether it's a good pick for 3 years.
Okay, got your question, Vishal. I'll take this up with Rajesh again then. Rajesh, Vatek Vabag, what's the view like?
Very strong company. The gentleman said right, it's a water treatment and all. Good order book. In fact, it's one of the Indian multinationals, I would say, which have presence not only in India but abroad too. And doing very well with the government's focus of Namami Ganga and all those things. The company would do well in coming years. So yes, it's a good buy. One can continue to hold if somebody is holding, and if somebody is thinking of buying, one can buy.
Okay. All right. We've got IndusInd Bank that we're talking about next. And incidentally, there was Nomura that put a buy rating on the stock. The stock is up as much as 4% in trade today. Thanks, Namrata, for that. Namrata is speaking in my ear and reminded me about Nomura. But we've got a question, Manoj from Mumbai, who's asking about this. He's bought at levels of 950. The stock is currently trading at 840 or thereabouts. And he's wondering what to do. What's the future? Of course, there's a lot that is happening with this counter. So, Rajesh, it's a tough question to answer. But if you bought at levels of 950, what do? Do you hold on?
It's a tough one. You said it right. It's a high risk bet. If you look at pure fundamentals, forgetting about everything which is going to happen or which might happen, the valuations are extremely cheap, trading at less than 1 time price to book. Promoters are taking all their steps to rectify whatever has happened. But the thing is, when the first time the derivative laws came out, we thought that it was one-off. Then again, things started coming out. You never know what will come out further. So if you are ready to take that kind of risk, one can continue to hold. But otherwise, if you're not that risk averse, I would say why not switch to a better bank like Kotak or Axis or even SDFC Bank, which is the best one, I would say, in the entire private sector space.
All right, so that's with regards to where banks are concerned. Our next caller, Vino, is calling in from Kochi. Vino, a very good morning to you. How can we help you today?
Good day. Thank you. Good day to everyone there. And my question is on National Aluminium. I hold about 700 plus shares at an average of 185 rupees.
Okay.
Plus. I believe this has a potential to go up to 209, 10 levels in a quick span, seeing the resilience it has shown in the last few days. I have another additional capital which has been about 1.5 to 1.8 lakhs of amount. I think I am planning to load up on Nalco again. Will that be a wise decision? Is it a right decision? If not, my next choice is again Bank of Maharashtra again, which I hold at an average of 54 rupees, about 250. So I am just thinking which one to load up on, or if my thought is right.
Okay, I got your question. We know I'll take this up with Vaishali. Vaishali, do you think charts are attractive enough right now for a Nalco or something like a Bank of Maharashtra?
Why not go for Nalco also, because long-term chart looks so good and it has been just consolidating at these levels. So I would say yes, continue holding and look for your higher targets.
Look for even higher targets. We've got Professor Dibendu Ray, who's writing in and asking about Deepak Fertilizer shares. He's looking to invest as much as 50,000 rupees at this current price for a period of 2 years. I'm not sure if this stock also moved up when the likes of Bayer and a few of the other fertilizer insecticide companies were moving up. I mean, it has, in fact, moved up as much as 15 to 16% over the course of the last month. And the onset of the rains had to do with some of that. At least that was the anticipation, the improvement in agricultural yield. Of course, it's too early to talk about that. You would have to pay attention to the spatial distribution of the monsoon. So, Rajesh, the question, therefore, is on valuation and potential earnings from this point. Would you deploy this at this price?
See, I think Deepak is a decent company to invest for a long-term horizon. The company has been doing very well in the past. Last 2-3 quarters, the numbers were not that exciting, but I think the prospects look good. They have good capacity. They have expanded their capacity too. And with almost normal monsoon predicted by IMD and the government's focus on rural development and all, I think the entire fertilizer space is going to do well. We have our picks into this. One of them is Deepak and the other one is Coromandel. So one can have a look at both of them. Somebody holding Deepak can continue to hold.
Continue to hold is the view. Yogesh is calling us from Jaipur. Hi Yogesh, your question is on ITC and in all probability I have the answer even before you ask Rajesh, but still we will take your question. What do you have to ask?
Thank you for hearing me. Actually, I want to know that I have a ITC for 1,000 for 180 price.
Yeah.
So this time I want to buy or not. What about the ITC restaurant also?
ITC hotels. Okay, ITC hotels. So
yeah,
you bought at levels of 180, which is an amazing buy price, Yogesh. When did you buy?
Yeah, maybe 21 or 22.
2021, 22. So you've essentially you've more than doubled. You've gained quite considerably on the dividend front as well, and you're wondering whether to deploy more. So
see, Alex, I have 2,000. I just sold 500 something. Then I stay here 1,000.
Wow. Okay. So you booked some profits as well, and you want to stay here. And you knowing. So what you want to know right now is to buy more ITC or buy ITC hotels at this point. That's the question you have, right?
I want to. ITC hotel is a very lucrative for me this time.
Maybe. Got it. Okay. So Rajesh,
maybe it is 180 1 month before, but now no doubt.
Right. Got it. Okay. So Rajesh, the question is for you then. Would you buy ITC hotels at this point and continue to hold ITC?
In fact, Alex, given a choice, I would buy both.
Okay.
The 180 levels, I hope you remember, that was the level we had started recommending, 150, 180 those days. And still we have a buy call on this. First, let me take one by one. ITC is doing very well. Not only seeded volumes have increased. FMCG is doing well. They are moving into dairy too. Cash positive, cash-rich balance sheet, debt-free, giving good dividends. Prospects are very good. Coming to ITC hotels, they are going to expand their capacity. They have officially announced to double their capacity by 2030. All the hotels are doing well. The capex which they are planning is going to be very light because they are going for managed hotels going forward. Strong brands. And at 49,000 odd market cap, I think the valuations are extremely cheap. So both of them are in a buy list. Since you are already holding ITC, I believe you must have got some of ITC hotels during the demerger. You can add to that.
Yeah, and managed hotels, what Rajesh just mentioned, in case you're unfamiliar with the hospitality space, relates to a trend that we've seen over the last several quarters of hotel companies deciding to have a franchise model where they don't own the hotels, but they have a significant chain that they have to build out over the course of the next several years. So that's what he was referring to. It is operationally more efficient, does not require them to put down as much capex as they would otherwise have to. All right, we've got the next question on HUL, and Namit Kumar is asking for a view for the next 15 days, very short-term time frame. Vaishali, on the charts, does it look attractive?
Well, actually, whole of FMCG counter looks attractive. And talking about HUL, well, nothing much happening, still well within the range. So if he has to trade for the short period, I think keep 2300 as, or rather 2250 as stop loss and look for 2400 as target.
All right, so that's with regards to where HUL stands from a charting perspective. Our next caller, Vishal, is calling in from Kolkata. Vishal, a very good morning to you. How can we help you today?
Very good morning. See, I'm having 30 shares of Uno-Minda.
Okay.
Bought at 557.
Okay.
I am a long-term investor with, say, a vision of another 2 to 3 years.
Okay.
Now, I just wanted to, since I made significant profits, I wanted to know whether I should hold on or whether I should book the profits.
Okay, got your question, Vishal. I'll take this up with Rajesh. Rajesh, do you think he should book his profits? He's sitting on a profit of 15,000 rupees right now. Uno Minda is the counter.
The company has been doing exceedingly well, but the valuation at this juncture, I would say one would be prudent to book some amount of profit, if not full, at this point of time, and maybe re-enter when the stock falls for any reasons to around 900, 800 odd levels. At this point of time, valuations are at their optimal level. Book profit.
Book profit is a view. Hope that answers your question. Mohan is calling us from Hyderabad. Mohan, very good morning to you. How can we help you today?
Hello.
Hi, Mohan. I can hear you. Please go ahead.
Yeah, thank you for taking my call. I would like to purchase Bajaj Finance. It is quoting X bonus and X split.
Yes.
Yeah, I want to purchase 500 shares. Can I buy it in a SIP model, or can I buy it now or wait for the price coming down?
Yeah.
So, or any other good company you would suggest me?
And do you own any other stocks, Mohan, at this point? Do you have?
I own.
Yeah, go ahead.
Genesis International I own.
Uh-huh.
Genesis International, and mass financial, MAS, mass financial.
Okay. Got it. So you're adding to your list of stocks. Rajesh, the question is for you. SIP mode for a Bajaj Finance. Do you think that it's expensive, or do you think it can be acquired?
It's a buy from a side, and SIP would be a very good strategy to go ahead with a stock like Bajaj Finance. And the numbers have been very exciting. This quarter numbers were very good. AUM expanded, NIM expanded. And with this kind of stock split and bonus happening, the stock has come back to 3-digit odd levels where I think retail participation will go up. There might be some amount of correction going forward because of the kind of run-up come bonus and come split which we have seen. So there might be some correction to around 880 odd level. That would be a very good point to enter in a lump sum. But for SIP, I think one can start SIP and continue to hold for maybe a longer period of time. It can give good return.
With regards to where Bajaj Finance stands, our next question is from Shreyas, who's writing in from Bengaluru. He's purchased 490 odd shares at 102 a piece and wants a long-term view on this. Rajesh, a quick view on NHPC. Should he continue to hold?
Continue to hold. Good capacity, doing very well. Hydro is doing very well. Continue to hold.
Okay. Continue to hold. It is time now to hit the rapid fire round, and Vaishali and Rajesh, you know exactly what this means. We'll toss as many questions at you as possible. I think we've already addressed Hindustan Zinc, but I'll still take it. It's a view on the short term. Bought at levels of 530. Prasanna wants to know, should they hold on? They can't hold for very long. Vaishali? Couldn't hear you. Could you repeat that?
At this level, one can add.
Okay, Nikhat from Bengaluru has bought BEL 50 shares at 406. Wants to know if you can hold or sell. Rajesh, your view?
It's a buy from a side. Hold.
Okay, Jindal saw bought at levels of 248. Can it be held, or should you buy more? Shravani wants to know. Vaishali?
I would say add more.
Okay, Happiest Minds is the next question. Sudhakar is holding 39 odd shares, bought at 841 a piece. Wants a long-term view. Rajesh, your view?
Hold.
GNFC bought at levels of 660. Soumya wants to know, should you continue to hold or exit or add more at the current level? Rajesh?
Hold.
Okay, Bank of India. Praveen Kumar has bought 261 shares at 129 a piece and wants to know if you can hold or sell at the current moment. Vaishali, your view?
I would say sell.
Okay, IEX, coupling tensions, if you can call it that. We've got a viewer who's bought at levels of 221, currently incurring a loss. Should you hold, Rajesh?
Hold.
All right, the next question is on Hindustan Zinc. Okay, we've taken this already. The next one is VST Industries. Ramesh is holding 470 odd shares, bought at 385 a piece. Your view on this, where charts are concerned, Vaishali?
Hold.
AU Small Finance Bank bought at levels of 609, accumulated over a year. Would you sell or hold for a period of 6 months? Vaishali?
I would say book for now.
Okay, Page Industries. Tony wants to know if he can make an entry in this particular counter or not. Rajesh, your view?
Avoid.
Oof. Gillette India bought during IPO, holding 200 shares from 1985. Would you hold? Parijat wants to know. Rajesh?
Add.
Add. Okay. All right. On that note, that brings us to the end of this edition of Ask Profit. Vaishali as well as Rajesh, thanks so much for joining us today and for answering all the questions that you did. From Mahima and myself and the team that put this show together, it's been an absolute pleasure bringing it to you. Do stay tuned. As we pointed out, Know Your Company is up next and we're discussing Zydus Wellness. This is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Imports become the exception rather than the norm, And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Mahima Vachajani, and today we're going to be speaking with as well as analyzing an interesting company, because that stock has just gone up 6% today on the back of Parag Parikh FlexiCap buying 7% in the company. It's a 12,000 crore market cap company, and that's why, in fact, both Mahima and me are quite excited with regard to analyzing this one today, because one, it's FMCG and therefore Mahima is excited, but second, I'm excited because Parag Parikh has just bought 7%, so works well. Okay, so that's how the setup is. But let me talk about what I want to know. And yes, Parag Parikh has bought 7%, but that does not mean in any fashion that you should too, and that's why we've tried to analyze this today the best we can. Let me first start off by understanding what's happening. One is, you've seen raw material cost pressures, Mahima, due to which we've seen margin compression in recent years. Can that unwind? And management has guided for better margins going forward, but what are the levers and how much comfort is there is what I would want to understand. And again, we'll contextualize it by showing you the last 3 years numbers as well and how the numbers have evolved. That will give you better perspective. But that's one piece I want to understand. The second one is, therefore, what the margin trajectory will be. They've said 2 to 3 years. They've said around 17 to 18% margins. Margins currently sit at 14%. Is it linear? Is it going to be an up and down? Is it going to be a gradual increase, and what gives them that confidence? We'll understand all of that. Also, can they hold on to market share? Most products, they have an impressive market share. You would have heard of a Nycil powder, the prickly heat powder. You would have heard of Glucon-D. They have large market shares in some of these products. So can they hold on to that large market share? Because once your market share crosses a certain threshold, it becomes difficult to maintain that. True. Really. And every new entrant will start chipping on to that market share. We've seen that in PSU banks as well, all those years ago, with HDFC doing that for over a decade. Now let's talk about the rural versus urban interplay. You've started to see a pickup in rural, and management commentary also suggests that. Does that mean lower margins for them as rural picks up? That's one piece. Second, what does that do to growth? So both of those levers is interesting. So growth expectations in the medium term. We've seen FMCG players demonstrate very sluggish growth. Mahima has been super disappointed for 2-3 quarters in a row. Want to see whether this one has something different in store. But Mahima, why don't you start off by describing everything about the company?
Right. So just to start with and give a perspective as to what the company does exactly, Zydus Wellness basically began its journey as India's leading consumer wellness company. It integrated basically the consumer company in basically the OTC market as well. It launched India's first zero-calorie sweetener, that is sugar-free, in 1988. Everybody knows the sugar-free brand per se. That so Zydus Wellness is the pioneer of starting sugar-free as a brand.
Production team should have Katrina Kaif here because I'm not so sure as to why they have this background. Guys, if you all are listening, this is not okay. But anyway,
okay,
so sugar-free.
And considering the kind of distribution network that they have, you know, the reason as to why Zydus Wellness has done better than most of these FMCG companies is because they are very well penetrated in the rural markets, and they're also set to further penetrate in the rural markets. They've got roughly 1950 plus distribution points, plus they have 6 lakh plus direct reach points as well. They're present in more than 2.8 million stores now. So that includes your large format stores, your quick commerce, your grocery retail stores. That amounts to a big number, and especially in rural areas. In terms of how their manufacturing capacities, at present they've got 4 manufacturing facilities that is spread across Gujarat, Uttar Pradesh as well as Sikkim. In terms of how the business segments are divided, they're divided into 2 parts, that is your food and nutrition and personal care. Food and nutrition includes your Glucon-D, your Complan, your Nutralite, Sugar-Free, Amlite, and your personal care includes brands like your Nycil, Everyouth, etc. So these are basically the products, but Harsh, give us some perspective as to how the market share pans right now.
Yeah, so let's pull the previous, there you go. So no, so that's on the market rank. Yes, this is the market share. Just look at the market share of some of these. 59% is the Glucon-D market share in that product category. Nycil is nearly 34% market share. Some deep brands with some very good recall, and generally in FMCG that's what you want, right? You want large brands with very, very deep recall. If you really had to think of a powder, there are very few powders available, and you would go to the one which you have always gone to. And if Nycil is that powder for you, and was the powder for me at least, of choice, and therefore you would the recall would always be to go to that brand which you've always used. Complan is the one pain point, as you can see, in terms of market share, just 4%. You'd want something, a bit of a fillip with regard to that number in terms of Complan. But outside of that, you look at Everyouth facial cleansing. Everyouth scrub has a 49% market share in the scrub market, and you also have Everyouth peel off, which has a 77% market share. So some very, very strong brands. And I want to quickly also highlight a couple of other brands. One is Sugar-Free, which again has a very strong brand presence. And along with it, there's Amlite, which also has a very strong brand presence. And then there is Nutralite. If you recall, Nutralite within the butter segment, within the premium butter segment, has again very good brand recall. For those who use Amul, of course, that's big competition for Nutralite, but Nutralite is the other one.
Yeah, and in fact, they've very well penetrated in the restaurant business and your hotel business. That's where their major chunk of revenue for Nutralite comes from.
Yeah,
so that's
the hotel, catering and restaurant, that Horeca segment, they've done very well in. And then you have RightBite, which they've acquired, which is Max Protein. Now again, Max Protein has such a strong presence. Nearly every chemist shop, every Kirana store has a Max Protein lying there in front of you. So great recall in terms of brand, and this one is poised for growth. That's one. And second, it's also got margin upside to it. They're currently doing single-digit margin on Max Protein. So it's in the growth phase. So that's one product you want to keep your eye out on as well. But those are all the brands that it owns. So a large brand presence for 12,000 crore is what I'm trying to highlight for you. Now, in terms of market rank, this is obviously as per company estimates, which is reflecting on your screen. It also has international presence. It has presence in the Middle East. Growth trajectory is good, targeting 8 to 10% of revenue in the next 4 to 5 years from international. And sugar-free franchise and Complan constitutes around 85% of the overall international business currently. So there's plenty of tailwind for other businesses to pick up. But let's start off with the key metrics and let's see how the company has done in the last 3 years. Let's start off by analyzing which metrics we look at for this company. We'll start off with the income statement. We'll look at the balance sheet, cash flow. We'll look at return ratios as well, shareholding, street cred, street coverage, and valuations. We'll look at all of those 8. I'll toss it to Mahima, income statement.
Right. So for income statement, in the past few odd years, in terms of the revenue, the CAGR growth has been 10%. But considering that it's an FMCG company, we've seen that all of these big FMCG, major FMCG players have equally not done very well when it comes to the sales CAGR. I mean, if you pick up something like a HUL or a Nestle or a Britannia, you'll see that the CAGR growth has been anywhere between that 4 to 5 or 6 odd %. Versus that, overall Zydus Wellness has done well in terms of comparison to peers, but it still stands at a 10% CAGR growth. In terms of EBITDA growth, that has been just 3 odd %, so that is at par with how other FMCG companies have done. Margins have improved a tad bit in FY25 to that 14% mark, but there was a point of time when they were at that 17 odd %, but management has guided that in a couple of years they'll get to that 17% odd mark. And net profit 3-year CAGR has been around 4 odd %, which is also very similar to how other FMCG companies are doing. So just because it is not a very impressive growth, we've given this a thumbs down for now. But in terms of the overall segment growth, personal care has grown around 6.5% CAGR growth. 16.5% CAGR growth, and food and nutrition has seen a CAGR growth of around 8 odd %. It's interesting because food and nutrition for FY25 especially has not done well for most of these FMCG companies. I mean, you take something like an HUL, your Nestle, your Britannia, all of these companies have in fact seen a degrowth. In terms of EPS trends,
any reason why that is so?
I think it's just the demand that's not picking up. People are not spending on food because that is counted as a discretionary spending. So hopefully, I think Q1 and Q2 will see a better growth in the food and nutrition segment.
And with rural pickup, does this segment?
Not really. That's actually an urban segment that plays well when it comes to food and nutrition because they are the ones who can spend more on healthy or better eating. All right. In terms of EPS trend, it's been a steady set of growth when it comes to the overall EPS growth. Dividend payout is also, decent here because if you look at the overall trajectory, it's been anywhere between that 10 to 12 odd % every year for Zydus Wellness. This year also they've declared a dividend payout ratio of around 11 odd %. So all of this is with regards to where income statements stand, but just because it's not as impressive as it can be, we've just given it a thumbs down.
Yeah, so margin recovery is something we'll await, but at the moment margins don't look as good, right? Yeah. The decline in margins is quite steep from 17 to 14, sub 14%. So maybe that, and I just want to probably take a minute to explain dividend payout. Let's look at the dividend payout numbers. And thereafter, there you go. So that's the percentage, and that's the percentage, and remember those percentages, on the EPS. So you want to keep your eye out that this is not on market price, but it's actually on EPS. Let's pull up the EPS numbers as well, and that gives you a sense of what that dividend distribution number would look like, around 4 to 5 rupees a share roughly. But now let's quickly look at the balance sheet, and I'll keep this real quick. Very low debt, all of which is short term, around 100 odd crore, now 12,000 crore market cap, and therefore no concern there. Look at the cash balance, also quite decent, 75 odd crore of cash and 100 crore of short term debt. No concern with regard to that. Your other equity is growing nicely because you have your reserves and surplus, which is burgeoning, and therefore no concern there as well. It's trading at roughly 2 times price to book, and therefore not looking as expensive from a price to book perspective either. Cash flow, Mahima.
Right. So cash flow, we were discussing this earlier as well, and it's a good set of numbers where cash flow from operation has seen a good trajectory of growth as such. Even the overall cash flow to PAT, the ratio that we've seen has been on an increasing trend. It stands at almost 100% in FY25. Net cash flow, however, negative, but since Harsh and I were discussing earlier as well that because the overall operating cash flow to PAT ratio is quite impressive, the negative cash flows don't matter. So that's the reason as to why we've given a thumbs up to cash flow.
Yeah, but what therefore matters is your return ratios. Correct. Because what happens is your cash flow gets reinvested into the business, and what you want is your return ratios to be good, because if the cash flow gets reinvested into the business on high return ratios, it's incrementally good for a shareholder, which is likely you, and therefore you want a high ROC when you have all of that cash flow getting reinvested into the business. But doesn't seem like that. Look at the way in which cash flows have moved, or rather return ratios have moved, just about 6% or between the 5 to 6.5% threshold. I'd like to correct the FY21 number. That's not 3%. It's probably 6.3%. I'll come back to that. But broadly, it's between that 5 to 6.5% number. So I'm going to quickly get to that. But broadly, not looking good on the return ratios count. Shareholding.
It's a well-held company. It's a fairly well-held company. The promoter holding has gone up from that 66% mark in March 22 to around 69% mark in March 25. FII's holding have remained stable at the 3% mark. DI holding has slightly decreased from the 22% mark to a 19% mark. Public shareholding has remained stable at that 7% mark, and overall number of shareholders have also remained stable. But of course, the big news today is Parag Parikh getting into Zydus Wellness. An interesting fact out there that they were already invested in this counter around 2019. They did exit this counter around that time and moved this counter to their tax saving fund. But again, yesterday they bought around over a 7% stake in Zydus Wellness. So that's certainly a thumbs up, considering all factors, good, well-held company plus PPFS buying the counter.
Yeah, absolutely. I want to quickly go back to ROEs. The ROE number is 3% for FY21 indeed, as per Bloomberg estimates. So that number stands. I'm going to quickly look at how street cred has evolved. 6% 1 month, of course, excluding today's move. Negative 3% 6 months, negative 2% year to date, 5% 1 year. Not looking good across the board. And you also have a 5-year return of just 53%. That's obviously because of the financial numbers which haven't added up. The last 3-year numbers we showed you, and therefore you've seen the kind of street reaction over the last 5 years, not looking impressive, and therefore someone who's holding is definitely under some bit of pressure, and therefore street cred is a thumbs down. Valuations, Mahima?
Well, valuations is a thumbs up because, if you compare it to other FMCG companies, Zydus Wellness is trading at better PE multiples, although not cheap at that levels also, but still, as compared to something like an HUL and Nestle, which is trading at anywhere between 60 to 75 times, Zydus Wellness is trading at 35 times, and it will further improve to 24 times in 2027 as per Bloomberg estimates. That compared to a Jyoti Labs, because it's a proper competitor of Zydus Wellness and within the same market capitalization as well. Still, in terms of the forward PE, Zydus Wellness PE seems to be more attractive than that of a Jyoti Labs, and which is why we've given a thumbs up where valuations are concerned.
This has changed because today we've seen a 6% stock move, and therefore please keep that in mind as well. Some of these numbers are as of start of day today. Last off, analyst recommendations and what the street how the street is viewing it. 5 buy calls, 1 hold call, 16% upside, maybe 10% now after the kind of move that we've seen. We've given this a thumbs up, of course, but nonetheless something to keep in mind because that upside has shrunk very, very sharply today. Let me quickly go through all of the metrics and give you the final rating. You're looking at income statement, which is thumbs down, balance sheet, which was fairly healthy, thumbs up, cash flow thumbs up, return ratios thumbs down, shareholding thumbs up, street cred, valuation, street coverage, that's how it sums it up, and 5 out of 8 on our KYC ratings. Let's go across. We had a conversation with Tarun Arora, who's the CEO at Zydus Wellness, to talk to us about how he expects the future to pan out. Listen in. Your margins have recovered from that low of FY24. Give us perspective. There's inflation in the system, of course. How is prices of both edible oil as well as dextrose monohydrate shaping up for you? Because that's kind of causing some bit of a drag. How do you hedge for that, and how much of that has been passed on in terms of price hikes?
So first of all, thanks for having me on the show. And I think Zydus Wellness has had a very good FY25, coming back on couple of years of a lot of fairly high inflationary times that we were facing across multiple part of our portfolio. So I think as things settle down, as we had a very good summer season and some of our categories really picked up, we've been able to overcome the inflationary pressures across certain categories, certain commodities. Oil has been fairly high. You rightly pointed out. Oil has been something which was looking better about a year earlier, and then it just shot up. It further got complicated when the taxes went up and the international prices also remained high. Of late, it's been a little bit more benign, more stable, and therefore we are quite hopeful that we will be able to continue to navigate it. Most of the costs we aspire, the way we look at it, we are able to pass it on to the consumers in a calibrated way. Some of it we try to absorb by better cost management. So I think it's a mix of the portfolio so that we are able to deliver consistency on gross margin. Similarly, on dextrose monohydrate, which is basically based on corn prices, which have over last 3 to 4 years have been consistently moving up. We've been able to manage those costs through, again, better cost management on one side. On the other, we've been able to pass those prices because we are a market leader, and there is a pricing power that brands like Glucon-D and Nycil have, and therefore the dextrose prices have largely been more than covered in our gross margin. So overall, our story from a margin perspective remains positive. There will be certain challenges which we may face because of summers not being good. So it may have a product mix on the portfolio, but brand to brand, we are looking at how do we ensure that we are able to manage our gross margins and continue to build it in a positive direction for our stakeholders.
Right. Mr. I just wanted to understand that in terms of your EBITDA margins per se, they've started to recover. They were at 17% in, let's say, FY22. They did go down to around 13%, but FY25 they did increase to that 14% mark. Just wanted to get a sense that from that 14% mark, what is the kind of trajectory that you're seeing for your margins? Let's say 2 years down the line, FY27, do you think you'll be able to come back to the 17% margin levels?
Absolutely. Our journey, I think we've talked about in various forums, including our investors, is that we want to get back to our 17-18% EBITDA margins over the next couple of years. There are 2 or 3 paths that we believe that will help us get there. First of them is that gross margin expansion. So we believe that between FY21 and FY23, largely led by a significant impact on various commodities, milk, oil, practically everything went up, and most of the FMCGs we saw gross margins came under pressure, and we were no exception to that. We've been able to consolidate and improve our gross margins, and there is still scope for building another 1 to 2% gross margins in next couple of years. Furthermore, if we continue to drive our growths ahead of our costs, I do see a scope for building an opportunity around operating leverage, which should help us improve our EBITDA margins and take it to closer to 18.
Mr. Arora, will it be a linear improvement? 2 to 3% odd from here, every year 1%? Is that the way one can look at it, or will it be non-linear? That's the first part of my question. Second, you seem to be confident that margins will recover. What gives you that? Are you hedging certain raw material price concerns in a certain fashion? Is that what kind of gives you the comfort, or how is it that you're so comfortable about this?
So the way I look at it is that if I go back to about 3-4 years when our EBITDA margins were higher, I think product to product, we've been able to largely cover up for the gross margin miss that we had because of the commodity pressures. And typically, most of the FMCGs, most of us will tend to respond to the cost because we are also conscious of high inflation impacts demand. So in my opinion, we've been able to price ourselves up enough to cover most of our costs. And therefore, I do believe that there is, as the product mix gets better, as we keep moving forward, the gross margins have that opportunity to move up 1 to 2%. So that's where I'm coming from. Also, most of our actions are focused on demand improvement, demand enhancement ahead of the industry. And therefore, if the growths really sustain that we want to, we should be able to get operating leverage. Of course, I have not accounted for any disruptions that happen, which are beyond us, but those are something which you can't keep building. And there are risks every day. Today, there are more risks than a decade back because the kind of disruptions, geopolitics and stuff that we are facing today, you just can't prepare for it. So you deal with it every day. I mean, 2 weeks back, somebody would have said, what is your view on costs? And I would have said crude is all sorted. So therefore the oil prices will stay stable and we are sorted. Now suddenly the crude has shot up. So those are things that you cannot build in. But from a medium term, we think that our strategy of volume-led growths, a strong pricing power, good capability to procure at a consistent level will all come together to deliver this. Beyond that, what happens from the environment point of view is something which we'll deal with as we face it day to day.
Fair enough, Mr. Arora. Just want to get your sense in terms of the demand outlook, because from what I understand is that you are more penetrated in rural areas, and that is something that is actually working for you, because none of the players in the the consumption space have shown double-digit growth in terms of volumes, which you in fact have. So just want to get a sense as to how the strategy is working out for you. What's the next leg of growth strategy like? Will you be concentrating more on rural areas, because now we're expecting urban also to pick up in the second half of FY26, considering the tax cuts, the rate cuts that we have in play, the 8th pay commission. What is the overall demand strategy like, and what's the outlook like?
So in my opinion, I kind of agree with you that the opportunity is both in rural and urban. Rural, of course, has been several quarters been improving over the earlier year. Urban is also seemingly getting better. Better monsoons, government support will help move it forward. And we are believing that at an overall industry level, there could be at least 100 to 200 basis points improvement in demand. Though category by category, it may be different. For us, if I really step back and say, where are we going to be doing? I think we've got badly impacted by a very poor summer season, early monsoon, because we were quite optimistic on how this, growth momentum will stay. But the current, summers have obviously impacted our growth. But if I, isolate this as a one-quarter phenomena, I do believe that most of our actions are built towards a consistent double-digit journey. On rural, we are quite positive, and we continue to increase our investments as well as our distribution. As per Nielsen, while our business is about 25 to 30% rural, our distribution is 50-50 as per Nielsen. Almost out of close to 3 million outlets that's we are available in, Zydus Wellness products are available in, half of them are rural. We continue to build forward also in this financial year. We'll further increase our small town and rural reach by increasing distribution. On urban side, while we are rejigging our distribution, because the demand is also shifting substantially on newer platforms like quick commerce, etc. So while we've done rather well on that, we've got almost over last couple of reported quarters, we've almost got close to a triple-digit growths on a small base, because this is still building up. We believe that urban demand will behave very differently than rural. So rural will continue to build our general trade-led deeper distribution, more towns, wider reach. In urban, as the demand picks up, we are better equipped with new formats, new innovations, and omni-channel approach to cater to this demand.
Now, we're out of time on this one, but I also asked him on revenue growth, and this is the key metric, right? Can they continue to grow revenue? They said double-digit revenue growth, and let's have the KYC rating as well. But double-digit revenue growth is what he spoke about for the next 2 to 3 years at the very least, and therefore, even if a 10% growth is to be built in, you'll have the numbers likely because he's given us the margin outlook, he's given us the top line outlook. The company doesn't pay any taxes. That's the other thing you want to look out for. But completely out of time on this edition. Taxes will get paid FY28 onwards. Completely out of time on this edition of KYC. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Nifty trades below 24,800 while Sensex was 500 points off day's high. IT and metals drag, select consumption stocks also on the back foot. Meanwhile, pharma stocks tumbled sharply as US President Donald Trump says pharma tariffs are coming very soon. Nifty Pharma index plunges nearly 2%. And its advantage NSE as SEBI approves FNO expiry day for Tuesday. BSE gets Thursday. Will volumes fall for the BSE? DGCA clears 24 Boeing 787 Dreamliners in Indian fleets, finds no major safety issues as Air India cancels 66 flights between June 12th to 17th amid enhanced inspections. Hi there, you're watching Markets at 12 with me, Shreyanti Singh. First things first, let's take a look at what the markets are doing before we tell you everything about the sectors as well as the stocks that are buzzing away in trade. You do have Nifty as well as Sensex off day's high. So when you take a look at the list of top losers, select few consumption stocks, the likes of HUL, Nestle, those are making it to that list, down anywhere between 1.5% to about 2% thereabout. When you take a look at some of those IT counters as well, TCS is on the back foot, Infosys is not doing all that much. In terms of the move coming in, quite the downtick coming in, 1% downtick for TCS as well, and select few counters, the likes of HDFC Life, Kotak Bank as well as L&T also on the back foot. What is doing well for the Nifty within that pack is IndusInd Bank. That one is up 3.5% thereabout. Eicher Motors, Trent, Maruti Suzuki, as well as M&M. Those are your top gainers from within the Nifty 50 pack. But tell you what, the Aris Infra IPO opens for subscription today, offering investors a chance to also back a rapidly growing B2B construction materials procurement platform with a strong and diverse clientele. The company, in fact, is focusing on significant debt reduction as well as working capital enhancement, which is expected to further improve profitability as well as financial health. We have Sajid joining us with all of those important details.
It's a platform company which is coming out with an IPO, and IPO opens today. Aris Infra Solutions. The IPO is opening on 18th and closes on 20th. Price band between 210 to 222 rupees. The company is raising nearly 500 crores, of which around 225 crores has already been raised from anchor investors. And the market value of the company is little over 1180 crores there. For investors who are investing, minimum lot size would be around 67 shares for them. If you look at the business, as I said, it's a B2B platform company which provides construction materials to many construction companies like L&T and others, which is there. The proceeds are going to be used to repay debt. There will be a debt repayment of 204 crores. They will be funding their working capital of nearly 177 crores, and there's an investment they are making into their subsidiary of 48 crores. The company has been loss-making for the last 3 financial years. In the 9-month period of FY25, it made a profit of 6.5 crores on a revenue of 546.5 crores there. If you look at the strength of the companies, it has a good clientele. That's one of the big strengths, because clientele like L&T, J. Kumar, Puranik, Vadva Group, Capacity, Afcon. These are some of the clients which this company caters to, and it has a presence in Maharashtra, Karnataka and Tamil Nadu. 3 key big markets where construction and infra activities are happening. That's there. Valuation, on a valuation front, FY26 EPS is around 8.6. That's assuming a 10% growth on the top line and a 7% margin, EBITDA margin they're going to do. EV of 620 crores and EV to EBITDA of nearly 10.1 times, which is there. And for FY27, this EV by EBITDA is 8.9 times for them. Also, look at the weakness, because that's important to see, because it's a platform company looking at the B2B business. There's a high working capital cycle which they have, so they constantly need high capital because the receivable days are very high for them. Credit cycle days is around 139, and that's one of the key concerns also, because what they are supplying to the clients are giving it back at more than 140, 150 days. So that money, they need to have the circulation of money, and they need additional working capital if they need to grow from here or scale from here there. 2 key brokerage recommendations Devin Choksi has avoided on this IPO, and Bajaj Broking has subscribed for long term. So from a valuation perspective, it's a fair valuation as of now. The key thing is that in a pre-IPO, we had some marquee investors coming in the form of Mukul Agarwal from Param Capital. You had Singularity Ventures and Sundar Iyer, who subscribed to the pre-IPO portion at 222 rupees per share.
All right, then looks like the valuations are fine as of now. And when you take a look at the brokerage verdict as well, that is a little bit mixed at this point, but it's the clientele that is the strength when it comes to Aris Infra. Tell you what, let's take the conversation forward, get you a sense of whether you should be subscribing to this IPO or not. Astha Jain, who's a senior research analyst at Haim Securities, is joining us. Astha, very good afternoon to you. First things first, I wanted to ask you, what are your first thoughts, in fact, when it comes to this particular IPO? Do you think this is worth subscribing? What do you make of this one?
Hi, good afternoon. So talking about this IPO, we are giving it a subscribe rating, but just for long-term purpose. In case if anyone has a short-term view, then our idea is better to get it listed and then make entry into this counter. So if anyone has a long-term perspective, then only subscribe. Otherwise, we are of the view then that there is no need to subscribe for the short-term perspective. Now, why? First of all, yes, it is a B2B technology-enabled company, and their main focus is to provide, construction material, taking from the vendors to the ultimately infrastructure developers, and it is totally a digitized process. So what we find, there are 2-3 basic points which we are not very much comfortable with, and that is why we are just saying that if Horizon is long term, then only subscribe. Otherwise, don't go for this IPO. And the reason behind it is that, first of all, valuations are very high. We really need to see how they're going to sustain their profitability, which they have shown or posted in the 9 months ended FY25. Because what we have seen in the last 3 financial years, there were losses not only on the operating front, but also on the bottom line front. So only in the 9 months, FY25, they have turned to be positive. So we really need to see whether it is sustainable or not going ahead. Second, what we believe that there is a, barriers to entry are very low. So this is not a kind of business where, there are high barriers to entry or high entry barriers are there. So that is also making this business, not very much attractive if I see the major points about this business. So this is the second point which we are not very much comfortable with. And thirdly, what we are seeing that the competitive intensity, though in the listed space, it is the only company which is right now coming for the listing. But we believe that the kind of business model they are having, the competitive intensity can become higher going ahead. So, and fourthly, as Sajid has also mentioned, the working capital, intensity is high in this business. So looking after all these parameters, what we are finding is that it's better.
Asta, I wanted to also come back to you. Right. Those are some very valid points that you've made. In fact, there's a lot of moving parts when it comes to this particular IPO. There's a lot to consider when you consider subscribing to this one. So largely what you're suggesting is that a long-term view is very prudent to have. But I also wanted to get a sense as far as the clientele and the presence goes for this particular company. Because when you take a look at some of their clientele, you have L&T, J. Kumar, as well as Afcons making it to that list. So that's good, solid clientele there. And that is one of their key strengths as well. So what do you make of that as well as their presence?
Yes, they have got a very good clientele from the real and the infra developer space. And that is a major point for this company. But again, what we believe, the kind of business model they are having, because it is one of the company of its kind in this space. So that might be the reason that they have got a very strong clientele. But since we believe that the entry barriers are very, low in this industry. So I think that is the major point, that going ahead also they can witness the competitive intensity. So this market client is definitely an edge for the company, but looking after the other parameters, and especially if I look after the valuation, I have valued it on the price to earning multiple, so it is coming at more than 200 times in this kind of macro environment, when we all know that the geopolitical tensions are at the high level. So I mean, going for this kind of IPO where the valuations are high, I think it does not make sense in the shorter term. So that is why our view is, if only one has a long-term perspective, then only investors in this IPO. Otherwise, stay away from this IPO, let it listed first, and then make entry into this company.
All right, I also wanted to get a quick sense of what you think about their weaknesses as well, because on that particular list, you do have their high working capital cycle that is featuring on that list, because there's a credit cycle of 139 days that you're looking at when it comes to this particular company. So what do you make of that as well? Is that one of your reasons why you're thinking of this as a long-term bet then?
Yes, because capital intensity is high, so we are not very much comfortable with that part. And long term, only one point here is that they have started showing profits from 9 months ended. So we really want to see whether they will be able to sustain, because again, the margins are on the lower side. Even when they turned out to be a positive on the bottom line front, their margins are just 2%. I'm talking about net profit margin and the EBITDA margin of 6%. So margins are not that very much attractive, being it's a technology company. So that is also making us, somewhat skeptical about the, listing gain or the listing premium which it can enjoy. So on that day, if the macros work in the favor of the company, it might list at the premium. We are not saying that it will not, but I think that can be a risky bet to go with, and that is why we are recommending just for the long term. If anyone has a perspective, then go for it. Otherwise, let it get list first, and then make entry into this IPO.
All right, thanks Astha for that verdict coming in. So long-term bet, and that is the verdict coming in from Astha there. But Astha, just one quick thing before we let you go. I also wanted to get a sense of what do you think about the primary market space? Do you see it heating up at this point in time? What are you making of that particular space as well then?
Yes, it is heating up, because what we are seeing that there are various IPOs which are lined up to come in, and this geopolitical concerns are one of the major thing which we believe that going ahead, if it will get settled, then definitely we can see flurry of IPOs going ahead. And this is not happening only in the main board listings or main board IPO. Even on the SME space also, we are saying that there are various IPOs which are coming around. So yes, capital market and especially primary market is again gaining some heat on that part. But we really need to see the macros as well. So if macro goes in favor, definitely coming 2 to 3 months will again be busy for primary markets.
All right, then thank you so much, Astha, for joining us and helping us, in fact, understand what to make of this particular IPO. Thank you so much, and a very good afternoon to you. All right, then moving on, let's also shine a light on gold reserve trends, get you a sense of what this, the World Gold Council, in fact, is saying in their June 2025 report. So when you take a look at what they're saying in terms of the key takeaways, they do see the central bank gold accumulation higher in the last 3 years versus the previous decade. So when I'm talking about the last 3 years, 1,000 ton per year is the number that you're looking at for each of these years. Over the last decade, you did have an average of 400 to 500 tons per year, for some quick perspective there. So that is the kind of gold accumulation that you're seeing. When you take a look at the key takeaways, then let's take a look at the expectations, because you do have those expectations given all of the respondents they've in fact responded very favorably. When it comes to buying, they're seeing continued buying as well over the next 12 months, expecting also central banks and individual gold reserves to increase over the next 12 months. So that is something that the respondents came back to the World Gold Council with. Other than that, let's also take a very quick look at the factors that have been aiding this particular move. So when you take a look at what is leading to this sort of accumulation, you have safe haven demand in terms of the performance during times of crisis. Gold, of course, is a safe haven asset, and that is something that you're seeing feature on top of that list. Other than that, there's also a shift in global economic power that you're looking at. And there's also a move towards portfolio diversification that some of the respondents had talked about. Other than that, gold is emerging as a strategic asset. And there's also interest rates that you're going to be keeping an eye on very closely, as well as de-dollarization that is emerging as a trend. So how will tariffs then be making gold appealing? That is also something that the respondents talked to the World Gold Council about. In fact, they're going to be incentivizing central banks to diversify the reserve holdings. Diversification, in fact, is going to be, in turn, bolstering gold's appeal. So that's something that you're looking at. But the bottom line largely is that demand for gold is likely to remain healthy in the foreseeable future. And that's the verdict coming in from the World Gold Council in their June 2025 report. So that's largely about the gold reserves. But moving on then, it's advantage NSE, as the expiry day for NSE has in fact been moved to Tuesday, while SEBI has agreed to the BSE's proposal for expiry day on Thursday. We have Charu's joining in with all of those details.
So a very power-packed rejig of sorts for the exchanges, where the National Stock Exchange has gotten the approval to use Tuesday as its expiry, whereas the oldest bourse, which is the Bombay Stock Exchange, it is going to be using Thursday as its expiry. Meanwhile, the newer entrant, which is the Metropolitan Stock Exchange of India, it too is going to share its expiry day, that is Tuesday, with the NSE. Now, this comes in the wake of new expiry day norms from the Market Regulator, Securities and Exchange Board of India, where they had decided that only 2 weekly expiries will be allowed, and the exchanges will have to pick either Tuesday or Thursday, and they cannot change their expiries without having prior nod or approval from the regulator. Now, let's see how it further rolls out, but this was something that was intimated to the exchanges through a mail yesterday.
All All right, then thanks, Charu, for getting us all of those important details. But moving on then, in fact, we also caught up with Sundaraman Ramamurthy, who's the CEO of BSE, as well as Sriram Krishnan, Chief Business Development Officer at the NSE, on what they make of this particular announcement. Let's go across and listen in to the word coming in.
As you would recall, when this single contract weekly expiry came, the exchanges were asked to choose for an expiry day. At the time, there was a public announcement of NSE that they are going in for Thursday. So NSE chose Thursday, and so BSE took Tuesday. We were working with Tuesday. We were very happy with Tuesday as expiry. We had no concerns about it. But since NSE has requested for Tuesday now, in the overall interest of the market, we have taken Thursday.
After the Monday expiry, which we had proposed, was put on hold in line with the request from SEBI. So I think the market participants, after the Monday expiry being put on hold, came back to us and said, Tuesday would be the next best thing. That's what's outlined. That was what was outlined in the consultation paper as well. And so we had applied for Tuesday expiry as our preference, which is in fact approved now by SEBI. So we're very happy to have received the approval and very grateful for the same.
All right, then moving on, tell you what, let's take a look at some of these counters that are buzzing away in trade. So Polycab India, that's the one to look at, RailTel, as well as DCX India. Some of those counters, in fact, are moving on the back of order wins. We do have Puneet who's standing by with a snapshot of these.
Well, thank you for that. So Polycab is definitely one of the main companies here. A 6,447 crore order win coming in from BSNL. Now, it's the second such over the last 3 months, and the quantum of the order is very huge, hence the stocks reacting on that news as well. Now, the agreement is for design, supply, construction, as well as installation under the BharatNet project, and the order is for a project specifically in Karnataka, Goa, as well as Puducherry's telecom circle. Now, in the previous time, the company actually had an order win of roughly about 3,000 crores, and that was specifically for the Bihar circle. So it is participating in these orders and getting selected as well. It will help the revenue growth going forward as well. So keep an eye out on this going forward, because multiple orders under the BharatNet have been announced, and a lot of listed companies like other than Polycab has also won orders. So could be L1 in other orders as well. The other couple of them, RailTel Corporation, roughly 44 crore order win. They have received a letter and intent from Zoram Electronics, and the third one's EMS. Now, this one's they've been declared a lowest bidder essentially of 184 crore order from the UP Jal Nigam. And the last one is a defense company, DCX Systems specifically, received a 28.5 crore order. Now, this also includes orders for exports as well as from the domestic purchases. So these 4 stocks reacting on the back of news flow, but the big order for Polycab is one of the key highlights from this segment.
Well, absolutely. One of the key highlights, that's the order for Polycab that we're talking about from BSNL as well as, so you do have RailTel as well as DCX, a whole host of those counters buzzing away on the back of order wins. But moving on then, let's get you some verdict coming in as far as some sectors are concerned. And let's get you the word coming in from Aditya Khemka, who's talking about how this is not the time to be bearish on the pharma sector. Let's go across and listen in to what he had to say about the growth roadmap for the sector.
So see, you cannot miss healthcare as a theme in India simply because we are just 3.5% of our GDP is on healthcare versus United States at 17, Singapore at 9, and Russia at 10. So clearly, there's a long runway for healthcare consumption in India, and that's the theme we should be playing at this point. And if you have exposure to exporters today, it just might be prudent to switch the position because the exporters really are exposed to a lot of earning downgrades, tariff risks, and the valuations aren't really discounting those things today.
All right, then that's the word coming in as far as the pharma sector is concerned. But moving on then, let's get you some important updates as far as Hindustan Zinc is concerned, because that particular stock is ailing in trade, down quite a lot. In fact, we've seen Vedanta, in fact, slashing that 1.6% stake in this company for 3,018 crores. And you do have the shares, in fact, being offered at a 7% discount via OFS. But will it be sparking market jitters? Vansh, in fact, is standing by with some more details.
Yeah, so the stock is down 6% as the Vedanta has sold 1.8% stake in Hindustan Zinc via offer for sale. They have sold nearly 7.67 crore shares of the Hindustan Zinc, representing a 1.8% of their total outstanding shares at a floor price of 460 rupees per share and representing an offer size of 3,500 odd crores. And also Vedanta to have a 90-day lockup for the remaining stake sale. And let's look at the previous offer for sales in Hindustan Zinc. In November 2024, government has already sold 1.8% at 505 per share, and in August 2024, Vedanta has sold 1.5% stake in the company at 486 per share. So this all is backed by the Hindustan Zinc has announced their capex plans yesterday. They are announcing a capex expansion plans, which is a step towards their 2x capacity growth. They have announced a 12,000 crore capex, which is to be spread across FY26 to FY28. The expansion is to be funded by internal debt. They will incur the capex for the zinc metal complex, which will add to the additional capacity of 250,000 tons, which will take the total capacity to 13,79,000 tons. So let's see what the brokerages have to say for this. Motilal Oswal has remained neutral on the stock with a target price of 486. The silver output is at 687 tons for FY25, which is guided at 700 tons in FY26. They also expect that a 10% rise in silver prices can boost the EBITDA for Hindustan Zinc by approximately 550 to 575 crores. Also, Nuvama has maintained reduced rating on the stock with a target price of 400 rupees. They believe that the new capex plan provides volume growth visibility for the company, and the overall capex is to be largely met through internal accruals, and the target and the company is expected to generate strong free cash flows through FY27 estimates. So the stock is buzzing in trade. This is what the overall picture looks like.
Well, absolutely, Vansh. The stock definitely is buzzing away in trade, a knock of 5.8% coming in as far as that particular counter is concerned. But moving on then, DGCA has conducted a review of Air India's Dreamliner fleet. In fact, no major safety issues were found in this particular fleet, and SESA is joining in with their directions then.
India's aviation safety watchdog, or the DGCA, has given almost a clean sheet to Air India's Boeing 787 Dreamliner fleet following a thorough inspection conducted days after the deadly Ahmedabad crash. Now, of this 33 aircraft, 24 have cleared inspections so far. These aircraft were found to be fully compliant with safety standards, with no major concerns detected according to the DGCA. The 6 remaining aircraft are either undergoing checks or slated for inspection, while 2 aircraft are currently grounded in Delhi. However, they will be checked before returning to service. Now, while the aircraft are deemed safe, the DGCA has flagged maintenance concerns, particularly regarding spare parts availability and coordination between engineering, ground handling and operations team. The Air India has been advised to strengthen these areas to avoid any flight delays. The DGCA has also reviewed the airline's recent operations amid the cancellation of 66 Boeing 787 flights following the crash. The regulator emphasized the need for improved real-time defect reporting, timely passenger and crew communication, as well as effective use of alternate routes available during the airspace closure in order to manage disruptions. That's broadly the key takeaways from the DGCA's first major meeting with Air India and Air India Express officials since the plane crash last week that claimed at least 270 lives, prompting increased scrutiny of Air India's entire fleet of Dreamliners. Now, these Boeing 787 remains a key part of, Air India's international expansion, connecting major hubs across Europe and North America. Now, as flight volumes surge, ensuring the aircraft to remain operationally sound will be critical to the airline's turnaround strategy under the Tata Group.
All right, and with that, it's a wrap on this edition of Markets at 12. Thank you so much for tuning in. But as we bid you goodbye, take a look at some key commentary coming in from Chief Economic Advisor V. Anantha Nageshwaran when it comes to India and its attractiveness to foreign direct investors.
India has become over the last 10 years a more attractive investment destination. That is evident in the share of gross FDI numbers coming in. And in fact, even the profitable exits we have been able to create opportunities for old investors is a sign of confidence in the Indian economy, because it's very important for investors to be able to invest and also take their money out whenever they want to take it out, and India has facilitated that. Now, in this environment, therefore, to be able to achieve an average growth rate of 6.5% is a very creditable achievement, and that looks like it has a very achievable prospect for India. Of course, we are trying, we are working hard, and we are interested in ensuring that we push this growth rate up to 7 and above. That's desirable. There is no question about that. But the global environment is not what it was before the 2008 financial crisis. Since then, things have become progressively harder. So in this environment, maintaining even a steady state of 6.5% growth rate while striving to push it higher is the kind of growth approach to economic growth that the Indian government is adopting. The global environment today, whether it is political, economic or security, has become considerably more complicated and more challenging for growth. So not just for India, but for several countries, almost for the entire world economy, you can say downside risks are higher than potential for upside surprises. So that's the reality. But under these circumstances, I think India does indeed, given this backdrop, India does indeed shine as a relative bright spot.
That's huge. That is a biggie. It's out of
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down. Cut through the noise and set the context for you. Hear from top policy makers and thought leaders from the world of business and beyond. The big question really is, are companies using dark patterns to take you for a ride? The big question we're asking today, is the US heading towards a recession? The big question is, are we sacrificing our health at the cost of convenience? The questions you care about, asked and answered. The big question.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. I'm Hiral Datia. With me is Puneet Javeri, and you're watching Profit Buzzers. Good afternoon, Puneet. An interesting day of trade. I mean, in terms of markets, you're seeing that mild bit of a downtick that has started to come in again as we speak right now. And this is not only in the benchmark indices, your broader markets are also mirroring a similar situation. There you go, a downtick of around 0.3% in terms of Nifty 50, and we are below that 24,800 mark already. Let's pull up Bank Nifty and then we will look at all the sectoral indices as well. If we can just have that heat map post that. Bank Nifty still figuring out whether to get into the red or the green, but on the borderline at levels of around 55,750 is what you're seeing. Nifty Media and Metals, these are the two segments which are a drag. Metals, again, oil and gas also trading under pressure to the tune of around 0.7%. IT and defense also down in trade. In fact, the defense sector was the top gaining sector yesterday. That is seeing some bit of profit booking as we speak. What's holding up is the auto index, and which is interesting as to all your auto majors are seeing a good run up today. Private banks are doing pretty well. Consumer durable, so your consumption pack is something which is in focus overall. Let's quickly look at individual counters. If you can just get a contributor or the heat map in terms of Nifty 50, because that will tell you which are the stocks which are growing. Because IndusInd is hogging the limelight in terms of the top gainer, but it's your ICICI, Infosys, L&T and HDFC Bank which are on the downtick. L&T, in fact, you did have a brokerage house which has started and given out its preview on L&T and some bit of concerns probably there. Bharti Airtel, M&M, IndusInd, Trent are the ones which are contributing as well. In fact, Trent has its investor day today in the evening, so there will be some bit of commentary that would be coming out from a Trent as well. So watch out for that counter pretty closely. But clearly the advanced decline ratio also, if you see in terms of Nifty 50, skewed towards the declines, and that's what we're looking at. So far, you have almost 1,400 declines coming in versus a 841 advanced number on NSE stats. Broader markets also pretty much mirroring what's happening in the benchmark indices.
Well, definitely, and we've seen a lot of companies react to news flows as well as some in terms of last leg of I think a couple of earnings which we had today as well. But largely, it's been a very flat day to say the least for both the mid cap as well as for the small cap 250. Let's also look at the BSE 500 very quickly. While the bulk of the news flow dominated from yesterday was what's happened with NSE and BSE choosing the expiry day in terms of stocks. We've seen some like Zydus Wellness has actually come off from the day's high of almost 9%. Right now hovering at 4.9%, but the other ones, Avenue Supermart reacting positively of entering Uttar Pradesh. That's a big update coming from the company because it does operate in the cluster approach. So essentially, it is signaling to the market that it is looking to increase growth as well as store additions in that geography. We've also seen stocks like Hindustan Zinc react as well on news flow. Apart from that, something like a Happiest Minds is the other one. Stock was up almost 9 to 10%. But largely right now down 3% since yesterday's very strong move as well. But amidst the rising geopolitical tensions, Iran-Israel conflict, as well as what's happening with Trump's pharma tariffs, where should one place their bets essentially? We spoke to Mr. Ajay Srivastava, who's the MD at Dimension Corporate Financial Services earlier today. He says that he's bullish and he remains bullish essentially on the metal space. Listen to what he had to say.
Equity markets are resilient. They have got enormous demand potential. They face only one drawback that you will see in the next 1 to 2 years. A lot of allocation going to metals. People have missed out the big metal rally which has taken place, gold and silver. Silver is still coming off for the tracks at this point. So I think you will see a large amount of allocation of capital to those two precious metals. But having said that, I think we have a resilient market. Just remember that our market levels are same exactly at the time when the war broke out between Israel and Iran. That says a lot for the market. It can say also for the stupidity of the market that you're not recognizing the reality. Our valuations are up, oil prices are up. Globally, the markets are a little bit disarray, but our valuations remain flat where they are. So to that extent, you have to take pointers to say, take some profit off the table, just like all the institutional investors are doing, promoters are doing. Retail investors who are not taking profit from some of the stocks they hold, I think will tend to rule them in the next 12 to 18 months.
Bullish call coming in terms of metals, and that space has been trading under pressure today. So probably an opportunity for investors to look at taking into consideration the downtick that we're seeing. But moving on, staying with the metal space, you have Hindustan Zinc that is in focus. You have Vedanta, who's gone ahead and cut stake in the company, and this is somewhere close to around 3,000 odd crores. Also, Hindustan Zinc has announced a capex plan for 12,000 odd crores, which will be executed over the next 3 years. My colleague Vansh is standing by to tell us more about the OFS, the stake sale, and what brokerages make out of it. Vansh, over to you.
So the stock is down 6% in trade today as Vedanta has sold 1.8% stake in Hindustan Zinc via offer for sale. They have sold nearly 7.67 crore shares, totaling to about 1.8% of the total outstanding shares. The floor price for the sale is 460 rupees, and the offer size would be approximately about 3,500 odd crores. So Vedanta will also have a 90-day lockup period on the remaining stake for the sale. And post this sale, the stake of Vedanta in Hindustan Zinc will come down to 61.62% from 63.42% in March 2025. So also let's look at the previous offer for sales in Hindustan Zinc. The government sold 1.6% stake in the company at 506 rupees per share in November 2024. And Vedanta sold 1.51% stake in the company in August 2024 at a price of 486 rupees per share. Recently, yesterday Hindustan Zinc introduced their capex plans. They have, it was the first step towards their 2x capacity growth. They have announced a 12,000 crore capex spread across FY26 to FY28. The expansion will be funded by internal accruals, and it is for the zinc metal complex, which will enhance the capacity by 250,000 tons. And post expansion, the total capacity for the zinc metal complex will be at 13,79,000 tons. Let's also see what the brokerages have to say for Hindustan Zinc. Motilal Oswal has remained neutral on the stock with a target price of 486 rupees per share. The silver output is at 687 tons in FY25, which is guided at 700 tons for FY26. They believe that a 10% rise in silver price would have an impact of 550 rupees crores on the EBITDA of Hindustan Zinc. Also, the Nuvama has maintained the reduced rating on the stock with a target price of 400 rupees. They believe that the new capex plan provides volume visibility for the company, and the overall capex will be largely made through internal accruals. So these are the reasons that the stock is buzzing in trade today.
Right. Thanks, Vansh, for getting us the details. In fact, we also spoke to Arun Misra, CEO and whole-time director at Hindustan Zinc with regards to how the dividend policy will pan out from here on and what it would mean for a Hindustan Zinc if the government has to exit as well. Let's quickly listen into that bite of the conversation.
No, so as of now, this particular expansion would have about a 14% IRR. It is much better than our borrowing rate because they are a AAA rated company. So this is better, and we will also, this will even be better if we consider a little bit of debt and do then equity IRR will be far better than even 14%. No, so it's not a big issue for us as far as free cash flow is concerned. We will try to manage within our annual capex outlay that we have, and a little bit of extra cash requirement is there at that particular year that we may fall back upon debt if required, to keep our cash flows safe.
Well, that was the management of Hindustan Zinc, but another key stock in focus is IndusInd Bank. Now, the share is up more than 3% today. And the brokerage from Nomura has upgraded the stock to a buy versus neutral earlier. It's also hiked the target price to roughly about 1,050 per share from roughly 700 earlier. Harsh now joining in to give us more details on this. Harsh.
Well, it's a big upgrade, frankly, Puneet. So from 700 to 1,050, that's a largest upgrade. They've also upgraded to a buy. They're saying that largely there's been pain, of course, but a lot of it has already been built in. The company is navigating the storm, charting a revival. In that sense, they've compared this to an RBL and a yes. They've distinguished between those cases. They're saying that RBL, yes, had asset quality issues, had liquidity issues, had to dilute capital. There were capital adequacy issues as well. No such issues, at least at this point where IndusInd is concerned. And valuations also in relative terms undemanding at 0.9 times 1 year forward price to book. That's where they get their constructive stance from. 1,050 being the target price. They're seeing a 25% upside. Of course, 5% of that already taken out today. So that's of course the take on IndusInd.
Right, so that's with regards to IndusInd. In fact, we now have Sajid also who's joining us with Harsh to discuss more in terms of what's happening with the BSE NSE. Key questions over here are what happens with regards to BSE taking it being a listed player. The stock is not really reacting to the way Street expected it. So has BSE been able to defend the turf? And how will it make a difference to BSE, taking into consideration it's a Thursday expiry for BSE and a Tuesday expiry for BSE? How are you looking at it?
We both have a contrarian view for that. Actually,
and that was the reason we got you on the table right now.
My view on the BSE part of it, yes, it is a sentimental negative for BSE because BSE was gaining market share on a Tuesday. That's primarily because on a Friday it had a market share of 20-21%, on Monday another 20-21%, and going into a Tuesday expiry it had a market share of roughly around 45-46%. Now that is going to be swapped because NSE will now have a Tuesday expiry, which basically means NSE gets 3 days of trading, which is there, and is able to get much better share of the trading volumes or the premium turnover which is there. But having said that, there are two factors that needs to be taken into account. One, that while there may be a short-term blip which is coming in over a period of time from now to September, we don't know how the market share is going to pan out. And if you see last October to now, the gradual increase of BSE's market share on Fridays, Monday and Tuesday, when it shifts on September 1st, there is likely that there will be a retention of that market for BSE, and that's it's a calculated guess. It may be I may be wrong, or I may go wrong on that part of it, but we saw a similar thing happening in October, November when a lot of SEBI restrictions came in, and we said BSE and NSE will both lose market share and BSE will be worse hit than NSE. But that was not the case. BSE's premium turnover rose, and as a result of that, premium turnover market share has gone up during that period of time. So my sense is that that's the reason why Street is little cautious. There was no knee-jerk reaction that came in for BSE when we spoke.
So the monthly expiry angle is absolutely interesting to watch out for, and I think the subsequent data after September will tell you that. But Harsh, you've been looking at a lot of brokerage reports and you have a completely opposite view in terms of what Sajid is saying. How are you looking at it basis the informed views that you have so far?
Yeah, so I'm going to first talk about the brokerages, because the brokerages are in favor of what Sajid sir is saying. What most brokerages seem to be suggesting is, so let me start off with the Jefferies. They believe that the volumes will be impacted a tad and there is scope to mitigate that impact. They're expecting a 5 to 10% impact on volumes. They're saying that BSE's ability to build liquidity in long-term contracts can offset the impact coming through as a result of this, and they've trimmed EPS by just 1 to 2%, but the target price being 2,900, not too far from where we are currently. Let's look at UBS as well. Very similar commentary. Change in expiry mathematically can impact around 15% of volumes on loss of one trading day for BSE. That's largely how even I would look at it. And I'll pull up that table which I have sent, and that will give us perspective. Also, Goldman Sachs, they've cut target price 2430 from 2490. They're saying that BSE could lose 3 percentage points of market share, and BSE's FY26 EPS has been cut by 2%, but FY27-28 retained. Those are the views from all of the analysts. I'll just quickly point out that one table, if we can pull that one up, in terms of Tuesday versus Friday in market share, and that will just come up on your screen. Now, if you were just to analyze that, and this is where some of my pessimism comes in, if you just were to analyze that, there is a reason why a Tuesday expiry is favorable, and that is because you get to build on Friday, where there's a 23% market share which BSE enjoys, 27% on Monday and 42% on Tuesday. You look at the shift, if that were to happen on a Thursday, you will likely see just 10% market share on Tuesday, Wednesday will have 26, and Thursday will have 40. If I were to just deduct the 15% delta as a result of the Friday versus Tuesday move, which is T-2 technically, just that will kind of indicate that BSE will likely lose some amount, if not too much, at least some. And if that were to happen, as per Ambit, this is, average daily turnover market share loss by 15% will impact BSE's EPS by 10%, which is large for a stock trading at 82 times trailing 12 months. That's all that I'm trying to kind of
what I'm trying to say is that okay, the valuations are very rich for BSE as we speak.
BSE valuation versus the IPO NSE valuation in the grey market. If you have to compare the two,
I think both of them have similar valuation.
BSE is rich as compared to the way
slightly more expensive.
Because the way NSE IPO has been flaring in the unlisted space right now, it's unbelievable, right?
No, but
so if you have to take both into consideration, how would you look at it?
So the thing is that when the IPO comes in from NSE maybe 6 months or 9 months down the line, and the valuation continues to be similar, means today it's about 2,500 rupees or share or so. If it goes to 3,000 or something, which is another 25% from here for NSE, we are looking at 8 to 10 lakh crore market cap company coming on the exchanges. So, are you going to buy something which is 60, 70 times forward earnings? The question is that the investor has to answer that question, right? Because it's not in the private market. In the private market, what we have always seen is that the sales are happening at 30 to 40% premium to the fair market price, which is happening. And that's something which would be disappointing for many of the investors who are going in the private sector.
So are any brokerages saying that there is value in buying a BSE at the current market price?
No. So that's the simple answer. Except the Jefferies, which has a target price of 2,900, all the target prices are below the current market price. So I'm just kind of again putting it out there.
Yeah,
that,
but there is just to put one thing in place. There is a change in the dynamics which is happening in the last 2 weeks as well. If you look at the daily premium turnovers, they have come down both for BSE and NSE, and that's primarily because there is a regulatory oversight on the delta trading which is happening on the options which is happening. As a result of which options premium turnovers have fallen by 25 to 30% across every exchange, BSE and NSE combined. So if this is continues and there is going to be more tightening which is going to come in, the dynamics changes. What Harsh is talking about, the kind of volume shift which is going to happen, that dynamics also change because of the kind of free trade which is to happen through this trading desk across brokerages or across a lot of investors across the board. Simple as that.
So I think lots of views coming in on this one. But thank you, Sajid. Thank you, Harsh, for being here and sharing your views. But the clear thing is, I think we'll have to wait it out for September as well. And once it comes into practice, what the volumes are telling you. And as Harsh was mentioning, brokerages are not really gung-ho with regards to purchasing a BSE as well at the current market price. Not too much in the offing, but the stock is absolutely resilient with cuts of nearly only 1%, Puneet, coming in there.
Well, definitely, and I think what Harsh highlighted, the brokerages, while Jefferies has come out with a view, largely maintaining prices below the current market price. We also saw downgrade coming in from something like a Motilal Oswal as well. But let's also pull up one more stock, Optimus Electronics. We don't generally talk about this a lot. It's essentially an EMS player. Roughly about 5,000 to 6,000 crores in terms of market cap. So looking to add that. But the reason why we are discussing this today is because they've actually announced a new partnership with OnePlus today. That's largely what they've mentioned is for their IoT products. Now, essentially for people who don't know, EMS is you make products for other companies, and that's very pertinent. It's essentially in the electronic space as well. So specifically in this particular contract win, Optimus has gotten their order from OnePlus, and this is part of OnePlus' larger project called Starlight to localize in the same country that they're operating in. So we could see some more orders come from as well. What will be the role of Optimus is to essentially provide dedicated support required for this particular project, as well as localize these products, reduce cost for something like a OnePlus as well. Now, under the IoT products, what are some of the products is essentially the wireless neck bands or the earphones essentially which you would use, which are wireless. Those are some of the kind of products that Optimus will be manufacturing. They've also recently partnered with something like a Realme, which is another Chinese phone manufacturer, for a similar IoT manufacturing partnership as well. So they're looking to increase their share of business from this new vertical. They've also mentioned roughly about 25% revenue growth in FY26 as well. So stock has definitely picked up since this announcement came somewhere between 12 to 12:30 and reacting very positively as well. But let's go across to one of our guests today, for Navdeen Dawani, who's the Group Senior VP and Head Commodity Research at MOFSL. Navneet, a very good afternoon to you as well, and we want to take forward the conversation largely and talk about silver as well, Hiral, and I think that's one of the key part of this conversation as well.
Yes, so silver is something that is in focus. In fact, it hit a high in terms of MCX. Navneet is joining in. Navneet, good afternoon and welcome to the show. Navneet, my first question coming to you is the levels at which silver is trading right now. What is your key in, why this kind of an uptick? And two, is this sustainable versus what's happening with gold as well?
Well, good afternoon. And we've seen that silver has been a laggard as far as the precious metal complex is concerned. We've seen gold outperforming silver by a very huge margin over the last couple of years. And this is just kind of a catch-up rally to what gold has done. Typically, silver is a precious metal, but largely over the last few years, we've seen it behaving like an industrial metal. So unless the industrial roadmap is very clear, unless there is massive demand coming in from China and rest of the world, silver doesn't tend to perform. And this is what we've seen in the last 5-7 years as well. So all this while we are seeing a recovery mode in China, which is the largest consumer of this metal. But until now, we've not seen a massive amount of buying coming in from China the way it has been for gold and other commodities. And that is what is keeping the prices under pressure. Over the last few days, we have seen that there is a catch-up rally between gold and silver, where the ratio was skewed to as low as about 100, and now the catch-up has brought to about 106, 95, 96 levels. We typically tend to see that silver has been a very volatile commodity. It consolidates for months, and then when it moves, it typically moves in a fashion of 15 days to 20 days and gives you an average return of about 20-22%. Which is typically what we are seeing, that it moved from about $32 to now currently standing at about $36 and looking stronger towards $40 also eventually.
Mr. Damani, a very good afternoon again. So specifically, we've seen gold price rally very aggressively in this year, in 2025 specifically. Starting of the year, both of those were very close to each other in terms of price movements.
Well, I'm sorry, I cannot hear your question.
Hi, am I audible to you now, Mr. Damani? Hi, am I audible to you now? So we'll try to reconnect with Mr. Damani on that aspect, but essentially what I was trying to get to is because both, and if you can put the chart up also very quickly on screen, both gold and silver prices had moved in a lot in tandem until January of 2025. Since then, we've seen some correction there on the silver prices as well, but that's also largely led by the strong price movement in gold because of geopolitical crisis. We've seen, we're currently in 3 wars right now globally, and gold as a safe haven generally has that kind of power in this particular time frame to move very aggressively in terms of price movements. So let's go across to Navneet again. Navneet, am I audible to you now? Just wanted to check once.
Yeah, you're better. Yeah, I can hear you clearly.
Correct. So I just wanted to ask you a question essentially on the price movements, because until January we had both gold and silver prices move largely in tandem, but since then because of worsening geopolitical crisis, gold prices have shot up severely. You mentioned right now that silver generally moves in groups essentially, that you see a very sharp movement in a very short time. Do you see that as well coming into, we're now in June, do you see that it will catch up to the sharp rally that has been seen in gold over the last 6 months?
Well, I'll take a step back and see that since 2021 to 2025, gold has given you about 105% kind of a return. Whereas if you see silver is just merely about 50-55% up. So there is a lot of potential for silver to catch up vis-a-vis the rally which you've seen in gold. But mind you, gold has rallied primarily because of the ongoing wars that you mentioned, that we have sitting on 3 ongoing wars. Some of them have completed their 3rd anniversary as well, and they don't seem to be ending very soon. So it looks like geopolitical crisis, central bank buying, and fluctuation in the dollar is going to keep gold prices steady for some time now. But silver, on the other hand, is seeing revival in demand from China and from the Indian pocket. We've seen a massive import coming in on the domestic front of about 5,000 tons in the year 2024. So demand has been there. People are getting a little cautious about buying gold at about 1 crore rupees per kg, and there's a shift of demand coming in from gold to silver as far as investment is concerned. Also, typically the use is increasing in silver primarily from industrial uses, 5G technology, from investment demand. Jewelry is coming up in a big way in terms of silver demand. Bars and coin sales have improved drastically. As far as 5G technology and these EV charging stations are concerned, there also a lot of pent-up demand for silver is also catching up. And this is the 5th successive year where ICSG, where the Silver Institute projects that it is going to be a deficit for silver. So this is a kind of catch-up move which has been missing for the last couple of years, and I think that this rally has got some more feet to catch up.
Right. So Navneet, from here on, if you have to recommend someone as an investment to buy silver or gold, which metal would it be, and what would your target be on both?
Well, we've been positive on gold for some time now, and most of the targets are kind of getting exhausted around 3,400, 3,450. We will be exhausting our gold buy target, and from there we expect that the returns will be very minuscule unless the war escalates beyond somebody's imagination. If that has to happen, then maybe 3,700, 3,800 would also come open, but that is not what we are envisaging at this point in time. However, for silver, we were the first to call about 1 lakh rupees target for gold, and now we've revised it upward toward 1,25,000 also in the next 12 months. We are already sitting around 108, 1,010 levels, and we expect that another 15-20% upside from current levels also could be deliverable. On the international front, we are just around $37, and this technical breakout could take it towards $40, $41 also in the very short to medium term target. So I expect that silver could be a better bet as far as investors are concerned. If somebody is having a FOMO, then maybe some bit of gold and some bit of silver could be part of your portfolio. But if you've largely paid out of the gold rally, it's time to switch towards silver.
It's time to shift to silver from a gold. Though, you know, the World Gold Council, the graphics that you were seeing are coming in from there, where they are seeing gold as a safe haven yet. And a good upside could be coming in there as well. Thank you, Navneet, so much for joining us on the show and sharing those views. But we'll quickly slip into a short break. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold
ICICI for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and
Nifty trades near day's lows while Sensex lost over 250 points. IT and the metal sector dragged while select consumption stocks are on the back foot.
Hindustan Zinc tanks more than 5% despite a 12,000 crore capex push. It's the OFS by Vedanta that has put pressure on the counter.
Avenue Supermarts buzzing in trade after Uttar Pradesh expansion. Morgan Stanley also highlights growth potential for the stock.
Zydus Wellness buzzing in trade after Parag Parikh scooped up a stake sale from True North Capital. In fact, NDTV Profit exclusively spoke to the company as well.
PM Modi denies US mediation in ceasefire talks, highlights Foreign Secretary Vikram Misri as he addresses media to talk about the Modi-Trump phone call. Welcome back to Profit Buzzers. Let's take forward and view on a few stocks. The first one is Divi's Labs. It's in focus following a settlement between Novartis, MSN Pharma regarding the heart failure drug Entresto. Let's bring in Varsha to give us more context of what this means for the company. Varsha.
Yeah, thank you for that. So as you rightly said, Novartis, which is a global pharmaceutical company, and MSN Pharma have settled a patent for heart drug Entresto. Now, the point is this settlement could lead to upgrades in Divi's Lab FY26 and FY27 financial forecast. Entresto patent expires in November 2026, and the related exclusivity for Entresto ends in May 2027. Now, the whole point is why Divi's Lab is in focus, because Divi's Lab supplies API for drug Entresto to Novartis, and Entresto contributes almost 8% to Divi's Lab total revenue. So now, considering a favorable outcome for Novartis will essentially lead to higher sales of Entresto, which essentially will be a positive impact on Divi's Lab. Now, just to give a context, Entresto is a $7.8 billion drug for Novartis. Novartis was facing, dual threat, that is government price negotiation and generic entry. Novartis even sued MSN Pharmaceutical for patent infringement, pushing for quick decisions. A US court had rejected earlier Novartis bid to block MSN generic Entresto, and Novartis is aggressively, defending its market share. So positive outcome from the court for this company will eventually lead to growth prospects for Divi's Lab.
Well, thanks for that, Varsha. But one should not come out of the pharma sector. That's also the word coming in from Aditya Khemka, who is the fund manager at InCred Asset Management. Listen in to know if there's long runway for healthcare in India or not.
So see, you cannot miss healthcare as a theme in India simply because we are just 3.5% of our GDP is on healthcare versus United States at 17, Singapore at 9, and Russia at 10. So clearly, there's a long runway for healthcare consumption in India, and that's the theme we should be playing at this point. And if you have exposure to exporters today, it just might be prudent to switch the position, because the exporters really are exposed to a lot of earning downgrades, tariff risks, and the valuations aren't really discounting those things today.
Well, that was the staff fund manager for the pharma space specifically, but we have now been joining in by guest Mr. Brijesh Shale, who's the head technical and derivatives retail research at IDBI Cap. Also being joined in by Gaurang Shah, who's the head investment strategist at Geojet Financial Services. Gaurang, a very good afternoon to you. Thanks so much for joining in. Let me come to you first on Divi's Lab. This was a key overhang for the stock. It also got corrected when we got to know about this case a few months ago. How do you view Divi's Lab in this particular context?
Well, thank you so much for having me on the show. Good afternoon to the viewers of NDTV Profit and to everyone. Before I comment on Divi's, the recommendations are a part of our research team. Our company, Geojet, or myself, we do not have any investment interest or any financial interest, nor there is any conflict of interest. However, we give similar recommendations to our clients, so they might be having the positions. To answer your question on Divi's Lab, our team has a whole recommendation on Divi's Lab. And Puneet, whenever a legal matter is settled outside, I think the positivities will emerge on both counterparties, depending upon what is at stake. So I think, and as it was elaborated by your colleague Varsha, I think now, given the kind of contribution that this particular API puts into Divi's Lab's balance sheet, and of course the overall scenario, it should be counterproductive in terms of fundamentals, long-term point of view. And like I mentioned, our team has a whole recommendation from on a long-term basis on Divi's Laboratories.
Brajesh. Got that, Gaurang. Brajesh, let me come to you as well. A very good afternoon. How does the charts suggest for Divi's? Because we've seen a very strong move from roughly about 3,300 odd levels just a few months ago. Is there more legs to rally for this stock?
Yeah, afternoon. So basically, it's the weekly structure for the Divi's is quite positive, and lately during the month of May, we have seen a strong breakout. And expect the range from where the Divi's was trading from the 5,500 to 6,200. So basically, this 600, 700 points is likely to be the range breakout on the higher side. So somewhere closer to 7,000 mark. So somewhere close to 7,000 mark, I think the stock can see a further move. So I think it has got a very strong base. So 6,200 would be the support, and closer to 7,000 would be the technical view for the Divi's lab.
Right, so that's with regards to where pharma majors are concerned. But moving on, let's look at the consumption pack. I mean, you have consumption which has been in focus since April. Zydus Wellness, we did see a block that happened on a Zydus Wellness where PPFAS actually went and mopped up that 7.5% stake. Stock is up around 5.5%. NDTV Profit exclusively spoke to the company as well. Let's quickly listen in to a slurp of that conversation.
We want to get back to our 17-18% EBITDA margins over the next couple of years. There are 2 or 3 paths that we believe that will help us get there. First of them is that gross margin expansion. So we believe that between FY21 and FY23, largely led by a significant impact on various commodities, milk, oil, practically everything went up, and most of the FMCGs we saw gross margins came under pressure, and we were no exception to that. We've been able to consolidate and improve our gross margins, and there is still scope for building another 1 to 2% gross margins in next couple of years. Furthermore, if we continue to drive our growths ahead of our costs, I do see a scope for building an opportunity around operating leverage, which should help us improve our EBITDA margins and take it to closer to 18.
Okay, so that's the management of Zydus, but staying with the consumptions pack, you have Trent, which is in focus as well, and this is on the back of the brokerage reports that have come in. In fact, today there is an analyst meet as well. Mahima is standing by with the details. Mahima, what are brokerages indicating? And the stock is up 1.5%.
Right, basically the brokerages are still positive on something like a trend, and this view that has come out recently is from the kind of annual report that the company has posted last week. Now Citi has maintained a buy with a target price of 7,600 for the counter. What they're saying is that the 200 store expansion per year is likely doable, ensuring quality experience as well as economics and location. New stores will reach very high throughput maturity, and this will happen within the next 12 to 24 odd months of opening. In terms of the overall same-store sales growth, they're saying majority of the same-store sales growth for Trent is volume driven, and Trent does not take any price hikes, and they've said that they will not take any further significant price hikes as well going forward. Value retail is not a zero-sum game, and there will be multiple winners here in the retail space is something that Citi believes. And lastly, they're saying that Trent barely has consolidated or closed any of their stores due to the overall good set of store economics that it has, and this will be something that will augur growth going forward for Trent as well, and they're focusing on tier 2, tier 3 cities as well. Morgan Stanley on the other hand is also in fact maintained overweight with a target price of 6,359. They're saying that management is confident of achieving the ambition that they had laid down in 2023. They aim to grow 10x bigger in the near distant future while balancing profitability. They're expecting the company to achieve 10x of its revenue in FY32 as compared to where it stood in FY23. The focus remains on quality of store plus increasing the store density, and this will happen in the proximity of markets as well. And company is expanding into underpenetrated markets and increasing its footprint in tier 2, tier 3 cities as well. Plus Trent was also sitting on a free cash flow and a net cash positive position in FY25, which augurs well for the company. So these are the reasons as to why Morgan Stanley is bullish on something like a Trent.
Right, so that's with regards to Trent. Mahima, stay with us. Also, with regards to where Avenue Supermart goes, they are looking at expansion in UP. If you could tell us more about the expansion and if any brokerages have a view on the same.
Right, so they already hold some stores in UP, but now they're opening more large format stores in UP. That starts with it's yesterday's announcement where it opened a large format store in Agra, Ratan Mall, and the total number of stores right now for Avenue Supermart stands at around 421. This is the first major store opening in the state of Uttar Pradesh, which is one of the most populous state. Plus, DMart always has played the ownership game. They've never gone for lease or asset-light modeling, and it also follows a cluster-based approach for store expansion. Now, on this particular grounds, MS has come out with a note. They've maintained underweight with a target price of 3260. But what they're saying is that they're viewing this opening of store in UP as a positive step. They would closely track the company's pace of expansion in the state, and they will also see the opportunities that they're currently exploring in UP, and then further consider if there is a re-rating required for the counter or not. So this is the overall view as to what's happening with Avenue Supermarts, and of course what's the brokerage take on it.
Right, so that's with regards to where Avenue Supermarts goes. Thank you, Mahima, for that one. In fact, Brijesh, let me come to you. Trent, Avenue Supermart, Zydus, Wellness, 3 stocks. What are charts indicating?
So to start with the Zydus, the structure is positive, and I think this momentum can keep continuing. So 2300, 2350 can be the possible upside for the Zydus. So anybody is having a position should ride the momentum, and on the way down 1800 is the immediate support where I think the stop loss should be placed. So I think slowly and steadily it would move higher. So 2350 would be the target for the Zydus. Coming to trend, I'm not too much of positive because the medium to long term structure is not that great. There has been continuously selling pressure and profit booking which has been observed in trend. And now if I look at the weekly time frame, the level of this 6150 may act as a resistance zone. So there can be a possibly very small move on the higher side, but this level of 6100, 6150 will act as a resistance. Only when if there is very strong breakout or maybe the volume, there is a trigger change, then we might review the position. But on an immediate basis, I think on the higher side, it will see some resistance. So it's a cautious view for the trend. Coming to DMart, so DMart, yes, there's a very good buying which has been observed for the last couple of weeks. And lately the sell-off came from the level of 4500. But then a structure, the way the oscillators and the averages are moving, this defines that there can be a slightly push on the higher side, and the immediate resistance of 4500 will be taken out. So the structure is slowly turning positive. So I think from the medium term perspective, this can be looked from the long bet, and slowly and steadily 4800, 4900 can be the upside target for the DMart.
Okay. Gaurang, coming to you. 3 stocks that we spoke about. Which would your top pick be?
Well, so we have coverage on our fundamental team. Hiril has coverage on Avenue Supermarts, and we have a buy rating. And I think it is good to see this healthy commentary from the management, because if you reflect upon the last financial year's Q2 and Q3, then they were below expectation what the estimates were, and there was not a strong commentary with respect to the expansion of stores. But this time around, I think the management has placed in a business strategy appropriately at ground level, and I think the expansion should start adding to the top line and bottom line. So we have a buy recommendation on Avenue Supermart from our research team from a long-term point of view.
Okay, so that's with regards to where Avenue Supermart goes. But very quickly, let's just look at the early monsoon that has actually kept AC sales on a back burner. You have Blue Star, who's gone ahead and cut production. Voltas, who's seeing a 20 to 25% dip. But you have a UBS and MK, which are pretty much bullish. You have the stocks which are trading at the day's lowest levels as we speak. In fact, let's listen into what the management of EPAC also had to quickly say on this one.
As a country, India doesn't manufacture a lot of copper. I mean, especially there's copper called inner groove tubes and the tubes which go inside an AC. Those are not currently manufactured in the country, and we are a net importer. And that we have an FTA with Asian countries, Thailand, Malaysia, Vietnam. So since 2013, the industry has been importing at a zero duty all these coppers from all these Asian countries. Now, there has been a show cause notice sent to almost 2,000 plus importers, which includes almost everybody in the trade, all the brands, all the manufacturers of air conditioners, refrigerators, and traders. So everybody has received a show cause notice. So the department has been asking us to justify the valuation norms as per the FTA agreement, which as an individual importer, nobody I think has the capability to go to a third country and get it validated. So we believe as an industry, we believe it's more of a government it's a government to government kind of a transaction, wherein the country of origin certificate is issued by the Asian, by the country. So everybody has received the notice, and we are trying to take a stand together as an industry here.
Gaurang, let me come to you on this, because we've seen the early monsoon come in, but it's impacted the AC sales definitely. How are you viewing all these stocks within the consumer durable space, Voltas, Blue Star, as well as something which like in the EMS space as well, something like an EPAC, something like an Amber as well? What do you expect? Because we are coming off a very strong base in the same time last year as well, over 50%. So the volume dip. In that context, how do you view this update?
So Puneet, the current setback on the consumer durables, especially the ACs, is because of shorter summer and the arrival of early monsoon. Point number one. Point number two, I think ACs are now not only equipments which we use in summer. I think throughout the year, given the kind of rising temperature and the global warming, things are going to change as we go into the future. Point number three is that what we believe is that there is going to be a higher demand coming in from the semi-urban and rural India for these kind of appliances because of the aspirations going on to the next level. More importantly, good monsoons translate into good income for semi-urban and rural India, especially focused with agri activity. So we remain positive on Blue Star and Voltas both. Havells is the third one that we have a recommendation on. And on the EMS side, our research team has coverage on a company called PG Electroplast. I think extremely positive in terms of PLI scheme. It's a tailwind positive for the sector. But the only thing is that the EMS sector will take time to establish itself in terms of reporting numbers quarter on quarter. So one should have a longish time horizon in case if you decide on investing into EMS, especially PG Electroplast.
Brijesh, any of these stocks on the charts that you're positive on, something like a Blue Star, Voltas, or Amber, or something like an EPAC?
So basically, the Voltas during the start of the month, there was a very strong trade setup was there, and the stock is already beaten down. The trade setup was more with the derivatives data. So this 1300 strike price has seen a lot of unwinding during the start, but now somehow that level is acting as a resistance. My understanding is that sooner or later, if Voltas sustain about 1300 level, I think the data will change, and there can be more of a trading bet, and we can speak of 1350, 1380. So that opportunity is there in the Voltas. Maybe if that doesn't span out in this expiry, I'm pretty confident that maybe sooner or later, maybe in the next expiry, we might see those kind of a move. So specifically Voltas, more with the derivatives data, I think that move can be seen.
With regards to what's happening in the AC space, but what's interesting is DLF has gone ahead and actually almost sold worth 11,000 odd crores, if I'm not mistaken, after Privana North projected recorded a 11,000 crore rupees sale. And I think if that's the kind of sale you're looking at, I think ACs will be in demand as well, though we're talking about a production cut. But Anushi is standing by to get us more on it.
Right, so it's a big update that we are seeing from DLF. Now, the DLF has recorded about 11,000 crore of sales, as you just mentioned, in just 1 week. And with this, they have sold out with the DLF Privana North project. Of course, the land size of this was 17.7 acres, and this has surpassed the previous highs seen from DLF Privana's West, along with Privana South as well. Even, in fact, both of these phases are fully sold out as well. Now, in terms of how the operational trends have been, so if we looked at FY25, they recorded about a 44% of a growth in their pre-sales, and the number stood at 21,223 crore. Now, this is an interesting figure that we are looking at, considering that just with this one project, they have recorded about 11,000 crore sales in FY26 first quarter itself. Collections also, if we see, saw about a 36% of a growth, and operating cash flow surplus was up about 128%. Now, while the company did beat its guidance, FY25 guidance this year, for FY26, they're projecting launches worth about 17,000 crore. That's the kind of pipeline that we should be looking forward to. Along with this, they're expecting about a 22,000 crore of pre-sale. So of this, 50% is the number that we're already looking at that the company has achieved. In fact, if we see the pre-sales trend over the years, in FY25 also we saw a similar figure, that is 21,000 crore. So the question really is whether this FY26 guidance, which is given, is more on the conservative side. 24-23 also the figure was in the range of 14 to 15,000 crore as we saw. So this is the overall outlook that we are seeing. It's a strong update coming in from DLF, and that's its stock is in focus.
Thank you, Anushi, for getting us the details. In fact, my colleague Rishabh Bhatnagar spoke to Akash Ori of DLF. Let's quickly listen in to what he had to say.
Within the Privana brand, sir, now correct me if I'm wrong, there's about 25,000 crores worth of sales within the 3 Privana projects now. Are we going to see more and more come up within the Privana brand?
Yeah, Privana, you will see more. As I said, these are the 3 launches in the 116 acre. You will see more Privanas. Not very many, but you will see maybe a couple more. But that particular system is going to then work out in a way that that particular area is going to be the new, let's say, the new Gurgaon.
So that's with regards to DLF, which has scored a Privana hat-trick so far. Gaurang, how would you look at a DLF taking into consideration the update that we've got and any topics from the real estate space currently?
Well, I definitely concur with your view, Viran, that if you are buying a house for maybe a couple of crores, you are not going to restrict yourself by just buying one AC. I think you would love to have AC in each and every room, whether it is a 2 BHK, 3 BHK, 4 BHK with a sun desk, etc., etc. And it is quite an achievement. 11,000 crores sold out in 1 week in Gurugram and many more projects to come. So the real estate pack looks very interesting. Along with that, of course, there is a tailwind positive about interest rate cuts, which will enthuse people to possibly go and take a loan to buy their dream home or a house, which will reflect positive on registration as far as residential or commercial properties are concerned for the real estate sector. DLF, Godrej Properties, Shobha, Ugro Realty and Prestige Estates. These 4 or 5 names, Hiral, are some of the strongest plays in the real estate sector. Balance sheets are not very leveraged or very low as far as leverage is concerned. And most important thing is the completion run rate as far as project launch and completion is concerned. That is also above industry standards.
The Gaurang and that conversation we showed you with the management of DLF, that's just similar from the whole conversation with Akash Ori, who's the joint MD and Chief Business Officer at DLF. The full conversation coming up very, very shortly. Stay tuned to NDTV Profit for that as well. But another stock that's in focus is TVS Supply Chain. Now, stock's been a big mover today. Over the last month as well, the stock's almost up 12%. And that's after the auto company TVS Motor has boosted its stake. And because the company has been doing very well in terms of order book as well as financial performance. Let's bring in my colleague Jasmeet with more details on this. Jasmeet.
Well, yes, TVS Supply Chain is in the buzz and the stock is up 12% in this month. Let's understand what is the whole buzz about. Firstly, the TVS Motors have increased its stake in TVS Supply Chain, and let's understand how the stake has been increased. Very recently, yesterday, TVS Motors acquired 50 lakh shares, that's 1.13% stake. While out of that, 39 lakhs were via block deal at a price of 144 per share. While TVS Motors currently holds 5.76% stake in TVS Supply Chain with an average of 2.5 crore share. Well, let's understand how the history has been of this takeovers. Firstly, TVS Motor acquired 67 lakh shares back in February, and as of FY25, the stakes were at 4.37%, and currently it owns 5.76% stake. Now, well, the TVS Motor says the investment is just from the perspective of financial terms, and the overall revenue that TVS Supply Chain gets from the whole TVS group is less than 10%. While the second reason why the stock is buzzing is a positive outlook. Let's understand how the management views the outlook in FY26. Firstly, the company remains bullish on the long-term growth while it also continues its aggressive cost-cutting and structural change strategy. While the order book is of 5,250 crore, which is almost 52% of its FY25 revenue. Lastly, company has committed a 4% increase in PBT by FY27. So it'll be interesting to watch out how the whole buyback thing works out and how does the TVS motor shares move.
For that, Jasmeet, thanks for that. Brijesh, let me come to you first. On the charts, it's actually corrected from roughly about the 200 rupee level. Any kind of suggestions whether the chart showing any kind of positive momentum going into TVS supply chain?
Yeah, so basically, quickly from the trading perspective, there has been a positive divergence. So this speaks about some more of the bounce. So 160, 165 can be the opportunity in the TVS supply chain with the immediate base of 130 level. So that is the opportunity, 130, 160. That is a range which I can see over the next couple of months. So that should be the immediate view for the TVS supply chain.
Technical view coming in there. Gaurang, how are you looking at a TVS supply chain? And along with this, taking into consideration Israel, Iran, logistics as a sector, specifically the shipping side of it, is something which probably is seeing increase in freight rates, which becomes a positive for them. So if you have to tie this in together, what is your view?
So Hiral, no specific comments as far as TVS supply chains or logistic related container logistic related companies are concerned. One of the indicators of the health and the shape of things to come of shipping or container logistics sector is the Baltic index, which is at an all-time high, if I'm not mistaken, the last time that I saw, primarily because of the cost of shipping going up and the cost of insurance going up. And no specific comments over here.
Okay, so no specific comments coming in with regards to shipping companies for a Gaurang. But thank you, Gaurang. Thank you, Brijesh, so much for joining us on the show and sharing your views so far. But very quickly, an update that I would want to talk about with Puneet is with regards to the introduction of FASTag. And they're looking at an annual price of around 3,000 rupees from the 15th of August. Nitin Gadkari has said that this is on the basis of getting hassle-free travel from here on. The annual pass will be for 1 year or up to 200 trips and exclusively for non-commercial private vehicles. I think this is going to be really interesting for, travelers, commuters as well.
Well, definitely. I think and you have to fill it again with your UPI FASTag. So that's definitely one of the key aspects.
Yeah, and I think probably cheaper overall. And cheaper. I think everyone, and what is interesting is whether the C-Link will be accommodated in this or not, because everyone who's spending that 150 rupees per day is going to be really excited about it.
Yeah, definitely. And, that's the key update on FASTag as well. And we've also spoken to Mr. Gadkari, so we'll play that out during the day. But thanks so much for joining in for this edition of Profit Buzzers. Stay tuned to NDTV Profit for more. Profit Top Trades comes up next.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Varsha. Well, Varsha, if you look at the Nifty chart today, the Nifty 50 was trying to move above its resistance of 24,950, but it did not. And today we are hovering around this crucial support level of 24,800.
Yes, in fact, it's down almost 0.21%, but let's see who are the constituents when it comes to Nifty 50. On the loser side, though, you have Adani Ports, you have TCS, Nestle, Adani Enterprises, and HUL, which are losing when it comes to Nifty 50. But on the gainer side, though, you have IndusInd Bank, you have Trent, you have Maruti Suzuki, you have M&M and iSure, which are gaining when it comes to Nifty 50. But let's pull up sectors. How are sectors performing? Let's see what's the sectorial heat map saying us. Barring auto and bank, everything is under pressure. Even Nifty auto is up almost 0.5%, followed by Nifty bank, which is up 0.1%, while Nifty FMCG is down 0.5%. Nifty Pharma, if you see, was yesterday's losers. Even today it's down almost I would say a flat kind of number, but because Trump said that he's going to announce tariffs soon, that's why yesterday also we saw Nifty Pharma under pressure, while Nifty Realty is down 0.36%. But let's see what broader markets are doing. When it comes to Nifty mid cap 150, it's almost down 0.4%. You have Hindustan Zinc, which is under pressure as Vedanta sells almost 1.8% stake in the company. Via OFS, you have PV Fintech, Max Healthcare, CRISIL, which are dragging down when it comes to Nifty Midcap 150. On the gainer side, though, you have Escorts, you have Bandhan Bank, you have Paytm and AU Small Finance Bank, which are gaining on the Nifty Midcap 150. Let's pull up Nifty Small Cap 250 again. Mirroring the benchmark, it's down almost 0.19%. On the loser side, though, you have Sterlite, you have MMTC, Tata Tele, Concord Bio and Happiest Mind, which are losing on the small cap 250. On the gainer side, though, you have GM, Fodler, RBL, Ujjivan Bank and Minda Corp, which are gaining when it comes to Nifty mid cap, rather Nifty small cap 250. So overall, Somit, the markets are under pressure.
But yes, we started the day with the big news coming in for Divi's Lab, positive news as well, right?
Yeah, exactly. And so let's pull up that stock. So it's up almost 1.1%. Now Novartis, which is an global pharma company, so Novartis and MSN Pharma have settled their patent, that is 659 patent for drug Entresto. Now this drug treats heart failure, and this settlement could lead to upgrades in Divi's Lab for FY26 and 27 financial forecast. Now the point is, what's in for Divi's Lab? Why Divi's Lab is under is buzzing today? Because Divi's Lab supplies API for this drug Entresto to Novartis. Entresto contributes almost 8% to Divi's Lab total revenue, and so if you see this overall, why Novartis is so much fighting for this drug, because one is this is a patented drug, which is a $7.8 billion drug for Novartis, and it faces dual threat from government price negotiation and also generic entry. Even Novartis sued MSM Pharma for patent infringement, pushing for quick decision. US court had rejected Novartis bid to block MSN generic Entresto, and that's why it it went ahead for the more judgment, and that's the positive news coming, and they have settled the patent, and that's why a big push for Novartis and a big push for Divi's Lab, as it forms almost 8% to their overall revenue. But to discuss more about this, we have Prashant Tapse, who's Senior VP Research Analyst at Mehta Equities. Hello Prashant, welcome to the show and pleasure to have you. Just wanted your view on Divi's Lab, on the overall judgment that has come, and of course on the long-term point of view. What do you think about Divi's Laboratories?
Obviously, with respect to long term, I think the trajectory is very much strong. Fundamentally, things are doing great. But only concern is about the Trump tariff, which will keep this sector under pressure, but not Divi's again. The products which Divi's is into are very much into exclusive heart disease and very much high end products. So I think overall, with respect to valuation, again, still little bit expensive at this point of time. Today the stock is up only because of the news, but again, in the valuation parameters, I think it's trading at very expensive way right now. So I'm expecting some kind of consolidation in terms of quarterly earnings as well as price. So overall, for me, a long-term bet, yes, but short-term there will be some kind of hurdles.
Zydus Wellness is another stock that remains in focus on the back of the fact that PPFS has bought stake in this company from open market. The stock is trading 5% higher. We got the management today in our KYC show, and the management was explaining how the margin trend could reverse for the company. Listen to what they had to say.
We want to get back to our 17-18% EBITDA margins over the next couple of years. There are 2 or 3 paths that we believe that will help us get there. First of them is that gross margin expansion. So we believe that between FY21 and FY23, largely led by a significant impact on various commodities, milk, oil, practically everything went up, and most of the FMCGs we saw gross margins came under pressure, and we were no exception to that. We've been able to consolidate and improve our gross margins, and there is still scope for building another 1 to 2% gross margins in next couple of years. Furthermore, if we continue to drive our growths ahead of our costs, I do see a scope for building an opportunity around operating leverage, which should help us improve our EBITDA margins and take it to closer to 18.
Okay, Prashant, coming to you on this, have you tracked discounter Zydus Wellness, and do you believe that the margins could actually trend upwards for the company now going forward?
Yes, I'm very much positive on the consumer wellness sector, and Zydus Wellness is among the leader in the sector. So the products which they are into are mainly into sugar-free, ever-use, and this kind of wellness products. So I think going forward, the sector is going to grow faster than the other pharma companies which are directly into the sector. But I think because of these additional support from the health concerns of the people, I think such kind of products will have a higher growth, and expansion of margin is highly possible in this company, and that is why the stock is trading very much high today as well. In terms of valuation, I think very much comfortable to have a very positive view from the current levels also. With at least 1 or 2 years perspective, we can have a decent 15-20% kind of earning growth as well as on the profitability.
Right, thank you for that view. Well, TVS supply chain, let's pull up that chart also, surged almost 12% in the past month. Now this was fueled by TVS Motors' increased stake and also robust order book, boosting growth prospects for the company. Jasmeet joins us now with the latest details of this impressive momentum.
Well, right, TVS supply chain has been buzzing and is already up 12% over a month. Now let's understand why is this happening and the reasons behind it. The first reason is TVS Motor increases the stake in TVS supply chain. As of yesterday, TVS Motor acquired additional 50 lakh shares and increased the stake by 1.37%, and currently it's roughly holding 5.67%. Secondly, out of the acquisition yesterday which happened 50 lakhs, 39 lakhs were purchased via the block deal, and currently TVS Motor holds 5.76% stakes in the company. That's roughly 2.5 crore shares. While let's understand the history of stake purchases which TVS Motors has done. Back in February, TVS Motors has purchased 67 lakh shares. That's roughly 1.5%. While TVS Motors, this investment is only based on the financial investment point of view. Also, the TVS supply chain gets less than 10% of its revenue from the entire TVS group. while as of March 2025, the stakes were at 4.37%. Secondly, why the stock is buzzing is on the account of positive FY26 outlook. Order book is at 5,250 crore, which is almost 52% of the FY25 revenue, while the company remains bullish on the long-term goals and growth outlook. Thirdly, continue aggressive cost reduction changes that company is doing to reduce the cost. Thirdly, the company has committed to get a targeted 4% PBT as of FY27. These are the reasons why stock is buzzing. It will be interesting to watch out if there will be any further stake raise by TVS Motors in TVS supply chain.
Thank you so much, Jasmeet, for all the details. Well said. Prashant, even in con call also, TVS supply chain, so they said, the management clearly said that they are expecting a double-digit revenue growth, and also large deals are in pipeline. So, considering all these management guidance and everything, how are you looking at TVS supply chain?
Very positive. We are very much bullish since the IPO has come out. Supply chain management solution is the sector which I think going forward for next 1 or 2 years will be a great opportunity for investors to hold on. But again, TVS Group has a strong hold in South India, and they have good clientele base to manage this supply chain management. With respect to outlook, again, I think yes, they may even do better in coming quarters also. If you see quarter-on-quarter earnings, they have done very well in the Q4 earnings. They have reduced their costs, they have reduced their expenses, and they have increased their margins. Still they are in negative, but again their profitability has grown slowly and slowly. I think the guidance of 2027 coming back to its 4% PBT, it's highly possible, and I think that is the reason why the stock looks very attractive for me from the current levels.
Right. Next stock is in focus would be the new listing that will come in, that is the demerged entity of Siemens India. Siemens Energy will be listing tomorrow on the exchanges. What can we expect? What could be the listing price? Let's get in Anushi with more details on the same.
Well, thanks for that, Samit. So, interesting listing that we'll see coming in, which is Siemens Energy expected to list tomorrow, and a special pre-open session would be there between 9:15 to 9:45. Now, do note on April 7, when the record date was for the demerger taking place, the dummy price discovered was at a price of 2,478 per share. So, fresh discovery is something that we can expect to happen during the pre-open session. Now, if you look at the total equity share base, total equity shares, that's about 35.6 crore shares. So, taking this into account, what the price could be something that is yet to be determined. But firstly, about the initial treatment of the Siemens Energy, passive fund managers will continue to maintain Siemens Energy in BSE and NSE indices, and this would be at the constant price that we have seen till the listing takes place. The stock will be deleted from indices 3 days after trading, and exclusion can take place in terms of to be postponed by 2 days each if the stock does hit us upper circuit. But what does the company do? It focuses on providing integrated products and services across the energy value chain, which includes the grid technologies, industrial power gens, as well as gas services. Along with that, it carries out generation, transmission, and industrial projects. If we see the performance so far in FY25, which excludes the March period, so it's the first 5 months performance that we are looking at. We saw about a 55% growth in terms of the order backlog, while new orders stood at 5,100 crore, or 6.7% of a growth here. Revenue, however, saw a downtick of about 6%, while margins were at 22.6%. Now, onto the outlook forward, brokerages expect about 19 to 20% over the next 3 years. And this is to be driven by emerging growth centers like data centers. HVDC orders would also be another bracket that the company will focus on, considering large ticket order sizes from here. Jefferies also came out with a note on this, expecting that the listing will make the company the largest pure play power T&D equipment player. In fact, it is expected to have a market size of around $10 billion. This is followed by Hitachi and GE Vernova, which are the comparable peers that we are looking at. Along with that, over FY24 to 27 period, they are expecting a 40% CAGR on this T&D pipeline and operating leverage as well. So any number below the 3,000 rupee range that we are seeing will provide healthy upside considering forward. Jefferies expect the company to list between 2,995 to 3,700 and believe that the company can trade at the 60 times of multiple based on its March 27 forecast that we are looking at, which implies a target of over 3,350 per share. So this is the overall picture that we are seeing for Siemens Energy and why it will be in focus tomorrow.
Right, Prashant, coming to you on this one, would you be one of the buyers of Siemens Energy in trade tomorrow?
I think yes, the way high convincing energy infrastructure growth is going to be in India. Siemens, we have experienced the way how promoters have delivered growth in terms of business as well as rewarding the shareholders from last many years in India. So I think considering parental support, I think the Siemens Energy will also be a great opportunity for me and the investors to be a buyer tomorrow. I may not expect the stock to release more than 3,000 rupees, but I think anything below 3,000 would be a great opportunity for investors to start buying this tomorrow.
Thank you for that view. Well, moving on, Avenue Supermarts has expanded in the country's most populous state, that is Uttar Pradesh. Morgan Stanley maintains an underweight rating, but is quite bullish on the expansion. Mahima joins it with the key takeaways from the note.
Avenue Supermarts has announced expansion in UP market and has opened a new store in Ratan Mall, that is Agra. Now the total number of stores for Avenue Supermarts stands around 421. This is the first major store opening in the state of Uttar Pradesh, which is one of the most populous state. In terms of what MS is saying about this expansion, they've maintained underweight with a target price of 3260. They're saying that DMart follows an ownership model for its retail stores and follows a cluster-based approach for store expansion. They are viewing this store opening expansion in the UP as a positive step. They'll closely track this entire move of DMart and company's pace of expansion in the state, and they'll see as to how the company actually caters to the opportunity that they have in terms of opening large stores in UP. Now, in terms of what the management also said in the Q4 con call was that they're seeing better growth in tier 2 and tier 3 cities, so their focus will be in the tier 2, tier 3 cities, and they also mentioned that they're seeing relatively larger like-for-like growth in cities which have fewer stores. So their strategy for FY26 is surely going to be expanding in tier 2, tier 3 cities and cities where they have lesser stores, so that the like-for-like growth goes up. So this is the overall view as to how this is being viewed, this expansion of Avenue Supermarts in Uttar Pradesh is being viewed.
Right. Thank you so much, Mahima, for all the details. Well, Prashant, considering, so your view on Avenue Supermarts, considering the valuation that a company is trading at, and also we have seen in this quarter the margins were a little under pressure. So what would you advise to investors?
On the valuation side, yes, you rightly pointed out, it's very expensive at this point of time, trading at a 3-digit 100p, which is not justified the way how the margins are under pressure. First time in the history, the margins are almost near 8 in the near down below 8, near 6%. I think that would be a very much comfortable, not comfortable level for a company like Avenue Supermart. I think the online business model of new age companies like Zepto and other online delivery services are killing some kind of pressure on the margins. But overall, I think the way they are expanding into tier 2, tier 3, that would be the only trigger going forward for long-term investors to see how that will grow. But tier 1 and the metros like Mumbai, Delhi and Bangalore, I think the growth will be under very much flat and the margins will still remain under pressure. So overall, long-term outlook very positive, but with respect to valuations, currently I think there can be some kind of price corrections expected going forward in Q1 and Q2.
Right, thank you, Prashant. Thank you for joining us and giving us your perspective about the markets and the stocks that we discussed. Moving on, early monsoon chill AC sales, Blue Star cuts output, Voltas sees a 20 to 25% dip, but UBS and MK continue to stay bullish on Voltas. Mahima is joining us with all the details.
Right. So, as you rightly mentioned, early monsoons is definitely a bad news for summer AC sales. Now, Jefferies did come out with an interesting note yesterday saying that Q1 last year had a high summer base, because of which earnings of all of these companies, AC retailers as well as manufacturers of components of AC, will be impacted this year. They're estimating first Q1 FY26 unitary cooling products to decline in lower double digits for both Voltas as well as Blue Star, and they're cutting the 26 to 28 FY estimates of EPS by around 6%. The next trigger for these RAC volumes could be an inventory liquidation in Q3 ahead of the new BE norms, which will come on Jan 2026. Now, Jefferies has maintained a buy on Voltas, however, rated Blue Star with a hold. They're saying that risk to reward appears better in Voltas versus a Blue Star. We also spoke to the management of Blue Star, and he did indicate that there has been an impact on volume, which could be around 25%. They've also stalled their production in terms of the first 2 quarters, and they've said that the growth of full year will be at anywhere between 10 to 15% versus that of 20%, which was earlier expected. Yesterday, Voltas also did have an analyst meet where they indicated that industry-wide there has been a dip of 20 to 25% odd volumes in terms of RAC, and a pickup is expected in June. However, the channel inventory remains elevated, around 6 to 8 weeks is the channel inventory, and companies are also giving out freebies in order to boost their AC sales, and despite the subdued demand, these companies are refrained from taking any broad-based price cut.
Right, thank you so much, Mahima, for all the details. Well, as we come to end of the show, we bring you a special package. NDTV Profit was at DLF's Gold and Country Club at Gurugram in conversation with Akash Ohri, who's a joint MD and Chief Business Officer at DLF, talking about how the real estate major clocked in 11,000 crore rupees in Privana North bookings, their project pipeline, and the outlook for the sector going ahead. Take a look.
We're at the DLF Country Club in Gurugram. This is an address that is synonymous with luxury and elegance, and fittingly, I'm joined by Akash Ohri, Joint Managing Director and Chief Business Officer at DLF Home Developers. Thank you so much, Mr. Ohri, for taking time out. We're talking to you barely days after you've sold out another record project here in Gurgaon, Privana North, 11,000 crore in sales. I cannot wait for you to show me and give me a flavor of what it is that DLF actually offers and what makes you charge these premiums and sort of bring this real estate market out of its slump and back to its back on all fours. Why don't you show us, give us a tour and give us a flavor of what DLF brings to this real estate market?
Sure. Thank you. Thank you for having me on the show. And yeah, let's do it.
I've been living in Gurgaon for almost all of my life, and it's always been sort of a wish to come in here and see what the other side looks like, and it's a privilege now that you're here with me. Talk to us about Privana North. What sort of biomix are you seeing there? What is the sort of margins you're seeing in that project, and give us some timelines also.
So Privana, first of all, absolutely overwhelmed and very grateful for the support that we've got for the sellout. It is also a record of sorts because the scale of what has been done is never been done in this country. So over 11,000 crores of sales. Again, whether I want to get into in a week or 5 days and all those are immaterial right now. I think what is important is that the huge endorsement for a DLF brand. The product is definitely the hero this time. Glass facades, 3.4 meters ground to ceiling heights, large decks. It's an evolution, every time you get better, and the Privana environment today, or the ecology there now, it's become, it is now something that has got the attention for a lot of people,
Right.
And not only here, I'm extremely grateful for our support from our NRI customers, from the rest of India, and of course the Gurgaon NCR markets, which have wholeheartedly endorsed us.
What's the NRI demand you're seeing there?
Well, this time, our average NRI demands have hovered around between 25 to 27%. This time it's about 30.
Okay. Slightly higher.
Slightly higher.
Okay.
The price points this time are also higher. I mean, they're about 9.5 crores average, Penthouses are about 25 crores.
Okay. We are in DLF Phase 5. This is a sort of township that has evolved to be the center of Gurgaon, the Phase 5 part. Privana also we've seen now southwest and now north come up. Is that going to be the next sort of center of Gurgaon?
This is going to be a very unique proposition because of almost over 100 acres of contiguous land.
Okay.
And I firmly believe that DLF is in the business of making communities, developing townships, making sure the infrastructure is commensurate to what your living standard should be, and of course making homes and dreams for you which you cherish for the rest of your life.
Under the Privana flagship now, about 25,000 crores in sale. Are we going to see more come up under that same brand?
Yeah, there are going to be a couple of more.
Okay.
As I earlier said to you, that there are about 116 acres of contiguous land. So these are now this is the third launch, and that is going to be the new hub. That is going to be the new Gurgaon.
In terms of your broader project pipeline for FY26, are we expecting more from the Privana brand within this fiscal year?
No.
Okay.
Not Privana. Right now we've got Mumbai to
focus on in terms of FY26 as well.
FY26, that's Mumbai, and then of course, as per our guidance, we've got other projects coming up. So I think that's what is going to take most of our time. Dahlias 2.0 will be sometime in December.
Talk to us, Mr. Ori, also broadly about the luxury housing market as well. Over the next 3 to 5 years, what do you see it as developing?
See, what is happening right now is, and I've said this before, I'm going to say it again, residential real estate has become a priority.
Yep.
Priority for people because post-COVID, people realize that, look, home is something that they want to go back to, rejuvenate, enjoy, relax, and should there be a need to even be sitting at home for some time, that is something that they should enjoy doing. So what that has led to is that people have wanted better and bigger homes. Today they are wanting to or they prefer, as real estate in other asset classes also, or even priority wise, it's become the number one thing to do.
Okay.
So what has happened is price has become a secondary situation here. Earlier you would look at a product and you'd want to know what the price is. Right now you look at that product, you see the features, the attributes, and you want to be there.
Yep.
And therefore, if there is a price to it, then you work around getting that story going. So that is something which has changed this time.
How is sort of Gurgaon's infra aligning with the real estate prices, especially with you sort of dictating the luxury real estate and sort of residential market? Talk to us about how Gurgaon's infra is aligning with that.
So, the good part about what is happening in Gurgaon today, Gurgaon is becoming the preferred choice for real estate investments across the world and in India.
Yep.
It's no more an NCR only preferred market. The rest of India is also looking at Privana. Happy to tell you, the Privana North launch this time has almost 15% business from the rest of India. And about, almost 30%, as I said, from NRI. So what is happening is right now is, the other good part is that the government is planning Gurgaon for the future now.
Okay.
So there's good infrastructure projects, there are things that are happening in terms of how to decongest roads, how are you going to be managing water issues, and amongst other infra-related matters. So government is very seriously, putting all that together.
Right. Thank you so much, Mr. Ori.
Thank you.
It's
Thank you
always
for your
been
time.
a pleasure.
Likewise. Thank you.
Catching up with you. Congratulations on the Privana sellout, and best of luck for your future launches.
Thank you again.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India,
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. Let's look at how the index is shaping up today. A third of a percent lower on the Nifty 50 index. We're seeing some pressure again, second consecutive day. In terms of why this is so, we'll come to that. Let's look at the intraday chart as well, get a perspective on how it's moved all through the day. And so from the highs, we're just in fact off the day's lows. We hit the lows, recovered a bit, but just weakness is what is evident, at least on the index for the moment. Let's look at the Nifty 50 heat map, because that will give us the texture and the breadth as well. And that's where, again, it's been a bit of a pain point last couple of days. The breadth has been extremely difficult. So while there's no big loser per se, and even within the gainers, there's just one big gainer in IndusInd. But outside of that, you're just seeing the breadth is really taking or pulling the index lower. That's what we're seeing, and that's what's playing out. Even when we look at contributors, you'll see one or two contributing decently, but again, nothing major per se. And ICICI, TCS in the red. So outside of everything that happened yesterday, IT was the one pocket which did okay. Today we're not even seeing that. Let's pull up the sectoral heat map as well. Auto is that one space where there's a bit of it's a bit of a safe place at this point within markets. A third of a percent higher in auto. Private banks also largely flat. Consumer is flat. But outside of that, everything painted red. But again, nothing material pulled to the red. When you're seeing the Nifty IT down around 0.8%, metals 0.8% lower as well. PSU banks around 0.5% or thereabouts lower. So that's how it's playing out. The advanced decline, if you can pull that up for the entire day and see how that graph has played out, there you go. Very similar to yesterday, where midway through the day we reversed, and thereafter the breadth has just gotten weaker and weaker as the day has gone by, Neeraj.
Yes, indeed it has. So a bit of a yawning gap out here, and Harsh, thanks so much for that. But bit of a yawning gap, as Harsh put out, and therefore it's not a very pretty sign if you're looking at how the market-wide performance has been second day on a trot. So what are the key losers? And if you just look at the larger expanse of the losers on the NSE 500, you will see a GMM Fodler out there. You will, of course, the market width is negative, but you will see a Hindustan Zinc, a Sterlite, MMTC. So clearly shows that some of the Metal names and Anil Agarwal group related names are not doing all that well. This is BSE 500, of course. Anil Agarwal group is actually showing weakness because Hindustan Zinc is down. Vedanta is looking soft as well now. It was in the green, by the way. And Sterlite is down about 5.5%. So this bucket is not looking all that great. Some of the top movers include GMM Pfaudler 4.5% higher, RBL Bank about 4% higher, and there is strength in Triveni Turbine as well in the session today, about 2.5%. This too was actually much higher, but has come off. The lock-in period ended for Inventress, and that stock is down about 8.2%, so not looking all that great. And then just if you broaden out and look at some of the key performers which are moving up because brokerages are positive. Harsh highlighted IndusInd, I'll highlight it too, and we'll talk about IndusInd as the key stock of the day today. There's also Avenue Supermarts as well as Sansera Engineering, on which BNK has a note, and that stock with the target price of 1600, I believe, and this stock too is about 3.8% in trade. So a clutch of names moving around. But suffice to say that the argument can be made that it's yet another day which has been dull. Maybe waiting for the Fed decision to be out of the way, Harsh.
Yeah, could very well be. Thanks for that, Neeraj. Shivangi Sarda joining us, analyst, equity, derivatives and technical at MOFSL, to get us better perspective on what's happening. Good afternoon, Shivangi. What's your take? What's your reading on everything that's happening? Couple of days where we've seen the breadth negative, but no major big movers, at least on the index.
Yes, absolutely. Good afternoon, Harsh and Neeraj. Thank you for having me. So we've seen that, the index has somewhat seen support-based buying from the last 3 trading sessions. But over the last couple of days, we've seen that the declines have, overpowered in terms of profit booking in some of the heavyweight stocks, which have impacted the broader market. Now, very, rightly pointed out, it's a yawning gap. And we've seen that the index had seen a spike in the initial hour, which it gave up for the rest of the day. And it has been cascading downwards, till now. So overall, we've seen that there has been lackluster movement with profit booking. 24,700 still acts as a major make or break zone over here. So till the time it holds above the same, we could see some sort of range bound move. But of course, there is a lot of unwinding left at 25,000 marks, which is required by the call writers for the next leg of rally to commence. So 25,000 will be, the next hurdle that we're looking at. But till the time it holds above 24,700. If it fails to hold the same, then we could see more downside towards 24,442 marks. So this is the take on Nifty. We've seen that, of course, Bank Nifty, there's some of the smaller banking names which are showing resilience today, and which is why Bank Nifty is outperforming the broader market. And we've seen that the index has been consolidating in a very narrow band for the entire week. And of course, next week is the monthly expiry. So somewhere we'll be expecting a lot more volatility than this one. But this week has rather been, a very consolidative band. So we are looking at 55,500 as a major support over here. And the upside, the targets we're looking at is 56,250 on an immediate basis for Bank Nifty.
Okay. Shivangi, good afternoon. Albeit from a bull's perspective, maybe not the best of afternoons, but contained. In light of the view that you've just given us on the benchmark indices, Shivangi, what are the stocks that you're recommending?
So stock-specific action, we've seen that the banking, financial, and the NBFCs are, somewhere holding up even in such kind of a market scenario. Of course, there are geopolitical tensions around the broader market, but this is one space which is held up in the last 3 weeks. So first up is Muthoot Finance. Of course, the gold prices have also, a role in the price movement of this one. The stock has been trading in an upward sloping channel, and we've seen that, there has been a sharp recovery in the last 8 trading sessions. The volumes over the last 4 sessions have remarkably increased, with RSI also showing positive, divergence here. So recommending a buy here. Now, the next targets that we're looking at is For Muthoot Finance, the next targets that we're looking at is around about 27.30 and with a stop of 25.80 levels. And the second pick on my radar is MCX. We've seen that with the electricity derivatives approval, this stock is one which has touched lifetime high levels, and it has been consistently moving upwards from the last 14 trading weeks. Even on a month-on-month basis, we've seen that the stock is already up by around about 24 to 25% in this month so far already. So clearly, momentum and strength can be seen over here. And we've seen that, this, of course, it's the market leader in its own space, but the overall the consistent buying and surpassing its previous psychological level has been quite remarkable. High volumes are also adding up, and this is looking nice for the next few sessions. So recommending a buy here with a target of 8,300 and a stop of 7,800 level.
Okay. Now, Shivangi, today the retail businesses, right, are firmly in focus today. I mean, it's not often that you see an Avenue Supermarts move the way it has, but Trent too has a slew of positive brokerage views for itself. That stock has done well. Two large names, right? And in some sense, fairly liquid names, if you will, at least Trent. Would you take any kind of trading position here, either of them?
Absolutely, Neeraj. When I was scanning the stocks also, Trent was on my radar, but this stock has been seeing a lot of good momentum in the last 3 trading sessions. Good amount of open interest addition here as well. But this does tend to have, a rather slow and steady approach and not a very quick up move. So one can approach this stock for the next few trading sessions and not just intraday perspective. And this entire space, of course, there is a good tailwind due to some factors, but overall, it looks quite positive for 5,900 levels. 5,600 would be an important support to watch out.
Okay. Shivangi, one more question, please, because we've got a chemical company up next, chemical/pharma/ a combination of both, and they're a fairly interesting company to track. But any thoughts on anything in the chemical/pharma space?
Pharma was one such sector which was on radar earlier this week, and we've seen some of the stocks showing some strength. But again, these are high beta sectors, and they tend to kind of be very price sensitive. But of course, there are some of the chemical names that have shown strength. Which again is a little high beta, but of course there is some names which includes good momentum. Now a little aside from these, Deepak, fertilizer is one stock which is looking quite stable, and it has been moving from the last 8 trading sessions, although in a very consolidative band, but overall holding at the higher zones, which is acting positive for the stock. So this one can be kept on radar for a short move. Around about 1,600 is the next level that we could look out for, with a support of 1,520 level.
Okay. Shivangi, we'll let you go on that note. Thank you so much for taking the time out and being with us today. All right, since that bucket is in focus, a very interesting management. Usually we don't hear from Heikel that much, and therefore it's an absolute delight to welcome in Sameer Hiremath. He's the Managing Director and Chairman and Managing Director of Heikel. He joins us right now on the show. Mr. Hiremath, I hope I'm pronouncing your name correctly, sir. Mr. Hiremath, can you hear me?
Hello, I can't hear you.
Okay, I think we'll just try and get that patch. Now, viewers, just keep in mind that amongst other things, when Heikel did their con call in May, they spoke about how while the year gone by was a year of strategic recalibration and focused execution, they were hoping or they were believing that the pharma industry globally was positioned for renewed momentum and growth with a steady recovery all through 2025. And they mentioned, I think one of the things that came out of the call was also that crop protection continued to face significant headwinds, notably competitive pricing from China and strategic shifts amongst the innovator customers, and the management expected stabilization or stability by FY26 and 27 coming up. So I think those are some of the key things that came out from that call.
Yeah, and it'll be interesting because when you're looking at the numbers as well, we've seen very little movement on that top line number over the last 3 years as well. So really, is FY26 going to be that year in which you see a bit of an inflection? Will be interesting to see. And also, it's a company which has exposure within that CDMO basket.
Yes.
What does tariffs do? What does this mean from a business perspective within CDMO? Can margins improve materially? And they have 13 to 14 products as well. So, okay, Sameer Hiremat joining us, Vice Chairman, Managing Director at Hykel. Welcome, sir. I hope we're pronouncing your name right.
Perfect. Thank you.
Perfect. Okay. So, let me first start off by understanding what the FY26 broader outlook is looking like versus an FY25. Are there, what are the trends at the moment and what are the expectations you have?
Well, FY26, I think there's lots happened in the last few months at the geopolitical level, which all of us are aware of. But I think India, I just heard you talking about the tariffs issue. And, that's been a big question everybody's having. How will India pan out and how will Indian companies benefit from or get affected by that? I think India will stand out to be a winner this whole tariff game. And pharmaceutical companies specifically, who have been in business for a long time, stand to benefit with more and more outsourcing likely to come to India.
Okay. So that's with regard to, of course, exports. But how's the overall market evolving, both even on the crop side? Because that's where there's been a bit of a headwind. Do you see some of those headwinds easing, and therefore what's the kind of growth that you're expecting for FY26 in terms of top line?
Well, if you take the crop protection industry, as you know, has gone through a major downward cycle.
Yes.
Because of inventory corrections and whatever conversation we've had with our customers, that they all feel that the cycle is coming towards an end and the inventory destocking is almost done. Our demand is robust and coming back in certain markets. And I think the crop protection industry will start seeing growth in the next few quarters going forward.
Mr. Hiremat, I hope you can hear me. This is Neeraj here. Good afternoon. When I went through some of the excerpts of your con call, you are candid enough to talk about the fact that it has been challenging and there will be a steady recovery. And I believe you've mentioned that the peak performance that Hykel had put in will probably take 2-3 years to come in. But at the same breath, you also mentioned that the recovery could be well back-ended, as opposed to it being a linear recovery. So therefore, could FY26 as well be a year of consolidation before maybe breakout, if you can, or if you will, happens in FY27?
Yeah, so we have two segments, as you put up a chart just earlier, pharma and crop. Well, the crop industry will take a couple of more years to come back to the post-COVID type of levels. But the pharma business of ours will continue to grow, which I also spoke about in the investor call last month. So we expect the pharma industry to grow, for business for us to grow quite rapidly, going forward with our new launches in the CDMO space, and well as increased demand for our generic products, and which is expected to fuel our growth from a medium to short long term going forward.
Rapidly, you mean in FY26 itself, right? I presume.
Well, pharma will grow, yeah. It will grow faster than historical averages because the CDMO business is gaining traction and momentum.
Got it.
And we expect a lot of inquiries, a lot of products which we're already developing, which will get launched in the next coming years and coming quarters, yeah.
Okay. And I would want to dwell a bit upon the capacities as well in a bit, but just a follow-up here. Just yesterday, Donald Trump has said that pharma tariffs are coming soon. Now, my question is, I know it's unpredictable, but let's assume that there is some bit of a higher tariff regime that we embark upon or we face in a few weeks from now. Does it impact your business as well, or would it impact specific end exporter businesses from India?
Well, we are in the API business, as you know, and API capacity is not prevalent in the North American market, right? It's more on the formulation side. So I think even if tariffs come, it will differential, and India will stand to benefit Indian companies compared to being in another geography, which could be impacted with higher tariffs.
Mr. Hiremat, where we're coming from perhaps is, will that lead to any bit of margin compression, or will pricing power be with Indian companies?
Well, only time will tell, but we don't expect any significant impact on the business because everybody's waiting and watching about what the tariffs will be, how much they'll absorb, how much they'll pass on to the patients. So only time will tell.
And so wanting to also understand what's the scope for margin upside in FY26, if at all. You're suggesting that crop will still take maybe 2 to 3 quarters to recover. So likely towards the fag end FY26 or maybe FY27. Is there at all any possibility of margin upside this year round?
Yeah, again, we have to look at our company in two different businesses, two businesses that we have. The pharma business will definitely show a margin upside compared to last year. Crop, there is still a bit of a few more quarters to go. Towards the end of this year, early next year, we expect to start seeing momentum, revenues and margins start expanding.
Okay. Okay, Mr. Hiremat, now I dial back to the capacity question, right?
Yes.
One, just a clarity. I did ask you whether you believe that in the pharma space, does it start showing in the numbers in FY26 itself, to which you said a few quarters. So does it mean that the quarters come in post FY26, or does it happen in FY26 itself? Just that one clarity.
No, we expect that some improvement in the second half of the year. The NCs that we have are going to get launched and the margin expansion will start, but the real benefit will come in FY27-28.
Okay, I get the drift. Okay, now on capacities, almost every peer of yours who's in the CDMO space that we speak to, post-results or pre-results, is very constructive on the kind of growth run rate that comes in the near term and over the medium term, and the capacities that therefore they are putting in. So everybody's trying to become larger than what they were, right? My question to you is, how are you charting that course from what your current capacities are to what gets on stream in the next couple of years to maybe longer term plans, if you can dwell upon it for a moment?
Yeah, so we also, ours is we have to put in capacity. So we're investing a significant amount of capacity in the next 2 to 3 years. We've already got construction already started on new plants. We're commissioning some plants by end of this calendar year. Some new plants construction will also be starting by middle of this year, which we just got some approvals from some customers. So as we going forward, we'll be significantly increasing our capacity to cater to our demand from our customers and the new opportunities that we're getting, new businesses that we're acquiring.
Okay. Now, a couple of things. One of the things that we called you for was this API unit clearing the Brazil GMP, right? Now, how significant is this for you?
Well, Latin America is a market that we started looking at a few years ago. And now we've also seen that there's a lot of potential for all our APIs. And this inspection was a very successful inspection and audit that we had from the Latin American Brazilian authorities. Brazil is a very large market, and this also caters to the Latin American countries apart from Brazil. And for us, we believe it could be a significant part of our portfolio going forward the next 3 to 4 years.
No, sorry. So could you kind of tell us a bit about it in detail? What is the estimated market opportunity in Brazil for these approved APIs that you have, right? And what are the immediate plans for leveraging this approval?
Sure. So just to give you some numbers, my team is giving. Brazilian pharma market, according to the data I have, is about $20 billion. Okay. That's only Brazil. The products that we have got approvals for have an end market of over $1 billion. Now that's a formulated value. But even if you take the API value, these are all generics, mostly generic-driven market. It's pretty significant potential for generic products. So we've got a multiple range of products that we're launching in Brazil. Plus, we are also developing some products which we launch every year. So Brazil could be a pretty significant opportunity for us, and we expect a lot of approvals to come in from our new customers in Brazil and LATAM. And the market will only grow. I think we expect to have double-digit growth in Brazil on a CAGR basis over the next 3 to 5 years.
FY26, I presume, or starting FY27?
Starting FY26, we see some. It takes approvals have already started, sampling has already started.
Okay.
And this only adds momentum to the whole exercise.
Got it.
And how large, sir, for perspective, is the Brazil market for you in terms of revenue composition? How much does it contribute?
Currently, it's a very small part of our business. Is less than, it's in single-digit percentages as a total, but it could become significant, mid-teens to double digits, high teens in the next few years.
And sir, with regard to your revenue mix, CDMO versus other, how does that shift? Because that will also indicate to us as to where growth pockets are lying for you.
No, see, it's almost 50-50, maybe percentage here and there, up and down between CDMO and own products. Both are growing. Our own product strategy is to enter markets like LATAM and Brazil and other markets. And the CDMO space, our pipeline is pretty robust, which we spoke about in the investor call as well, which I think you alluded to earlier. So we have a robust pipeline of CDMO projects under phase 2 and phase 3, which are being launched. So we expect the moment split to maybe be in the similar range, maybe a little bit up and down, but both parts of the business will grow.
A couple of questions on the balance sheet, because you're also doing capex and 200 crore of that. How does the balance sheet therefore evolve in terms of debt? How does that kind of phase in?
Well, our debt equity ratio is coming down every year. It's quite comfortable.
Correct.
And we don't see any concerns with that. We've got enough cash flows to manage our capex, but our total debt profile is remaining well within control. We don't see any concerns on that.
Internal accruals, I'd assume.
Yes, that's right.
Okay.
One question on this the OAI status for the for your facility, right? Bangalore facility.
Right.
Now, what's the update there? As of May, there was no update, but is there any further update?
Well, we just got the status last few weeks ago from the US FDA. So we're working with them. So we're in dialogue with them to sort out the CAPAs, and we hope to get resolution quickly on that matter.
Yeah, but obviously, I mean, with these things, I'm guessing timelines are difficult to give. Or do you have a timeline in mind?
Yeah, it is, but I'm quite confident we hopefully be able to sort out this issue quite quickly.
Okay. Mr. Hiramat, just coming back to one final question from mine at least, and just trying to understand when, and there is obviously a bit of business confidence and a bit of hope here when you, in your con call, say that from where you were in FY25 on the numbers, to go to peak FY21 or 22 numbers, you probably take 2-3 years, right, on the bottom line. I'm guessing there's a bit of business confidence, a bit of hope here. What is that construct, therefore, on the operational metrics? Do you improve those significantly in the next 2-3 years as well? Because that's a metric that the market would love to track. Your margins in FY25 versus what you anticipate them to be in, like, say, FY27 or 28.
Yeah. I mean, EBITDA margins will definitely increase, in the next 2 to 3 years as we get operational leverage, and we also move towards more high margin products. Our CDMO basket, which is growing, is built with more high margin molecules. Our older legacy products is becoming a smaller percentage of our total growth. And the growth will also come from the own new generics, from new generation complex generics that we're launching in global markets. So we see the margin expanding because of that.
Will it be 20% plus, Mr. Hiramat?
Yeah, I think so. Quite a bit more than 20%.
Okay. Okay. And how quickly? Will it be FY26, 20% plus?
No, I think it'll take 2-3 years. I gave that guidance.
Sure. Anything on the animal health, sir? Is there some positive sign in terms of new client wins globally? Anything that you can give us on that count and how that is going to aid your overall metrics?
Well, animal health we're counting as part of our CDMO business, because that's all NCE CDMO work.
Fair.
And that's moving along as per plan. And in fact, we have onboarded several new clients based on the big contract that we signed a few years ago. And that's made a lot of positive momentum in the industry. And we are seeing a lot of opportunities in the animal health space as well. We're onboarding new customers. And that will be a significant part of our business in the next 3 to 4 years.
Okay. Sir, we'll let you go on that.
No, just one question. Sorry, just before we do everything else. Something that we ask every company, right? Cash flows are great and everything is, I'm sure, looking solid. Would you need to raise any kind of equity capital in the next 6 to 12 months to fund your expansions?
No, I don't think. I think we got significant.
Okay. Now we'll definitely let you go. But thank you, Mr. Hiramat. Thank you. Much appreciated your time.
Thanks a lot. Bye.
All right, that's the view from Heikel on the Brazil GMP
so many things
approval.
to unpack, right, Neeraj? In this one, there's just so many things, so many moving elements.
But the response to your question, Harsh, about margins significantly above 20% in the next 2-3 years. Now let's see if they live up to the billing, because the last 2-3 years, I think a lot of CDMO-linked companies have not been able to quite live up, right,
Yes.
to those kind of promises that they made due to the business cycle being adverse. So let's wait and watch. Okay.
And they've guided for a 12-ish% growth on the top line. So that kind of just contextualizing that.
But bottom line, numbers much swifter, right?
Of course, because of possible margin improvement.
Yeah, and all of that. So it could be interesting. Okay. So just a quick market check before we get to one of the most watched segments and something that everybody waits for, and which is what dealing rooms are saying. But just a quick word on the markets as well. About 0.4% lower. Days low. The market breadth hasn't quite improved. IT continues to remain sluggish today. 1% lower. And the broader end of the spectrum too has not quite done too well. But with that, it's the time to get in our colleague Somit Sarkar, who joins in with all the chatter from the dealing rooms. And viewers, if you had watched this segment yesterday, you would have known that Somit highlighted the possibility of Hindustan Zinc block deal. So Somit, great observation then, great finding then. What do you have for us today?
Well, a couple of stocks today in focus. Firstly, it's R Systems and Coforge. Now, dealers are expecting some sort of corporate development that could happen. Coforge might be interested to acquire the promoter stake in R Systems is what dealers are indicating. So keep an eye out for both these counters in trade. IKS, now this is a Jhunjhunwala-backed company. The share prices are down more than 7% in trade. The lock-in has opened. Yes, there will be a block deal tomorrow is what the dealers are expecting or indicating, and that's the reason the stock is down. Around 5 to 6% of the total equity could change hands in trade tomorrow is what has been indicated by dealers. Now, third stock on the list is Sky Gold. Now, multiple block deals happened in trade today worth around 383 crore rupees, and that's the major reason why the stock has hit a lower circuit in trade. The seller for this deal is still not known, but what dealers are indicating is that this is the last chunk that has come out in the market. There won't be any more block deals now going forward, and the buyers of block deal today were prominent domestic institutional investors which already hold a stake in the company and are upping their stake in the company via this block deal. Third on the list is a pair trade that large HNIs are doing, Infosys and TCS. They are buying Infosys and selling TCS. That's the pair trade done by large HNIs. And lastly, it's Titan and Torrent Power. Dealers are indicating that foreign institutional investors are buyer in both these counters in trade today. Torrent Power is down. They are buying it at lower level is what dealers are indicating. And dealers are also saying that a foreign MNC broking firm might initiate coverage on both these counters. So keep an eye out for Torrent Power and Titan as well.
Now, Somit, interesting. Coforge is no stranger to acquiring companies.
Right. And
one looks at our systems. If indeed something like this were to happen, remember, this is from dealing rooms per se, so please understand that. But 52% stake of a 5,000 crore market cap companies is not unthinkable for a company of Coforge size, 2,500 crores or 2,600 crores.
It's not a big acquisition, but then something that might actually fructify because recent acquisition has also started to give results for them. So they might look to go ahead with another acquisition is what the normal is the buzz.
Very, very interesting. Very interesting. Somit, thanks so much for putting all of those into perspective, and great one yet again yesterday on Hindustan Zinc. Well ahead of the street.
Thank you.
All right, that's Somit Sarkar. And Harsh, watch out for some M&A activity maybe in the tech space.
Yes, we'll have to wait and watch. There's plenty of activity happening, frankly, within deals, within large deals. But Inventorist Knowledge Solutions, this is the interesting one. Stock is down 7%, anticipation of potential block deal, 8% down now. So some pressure coming in on that one, and from the day's high, that is taking a bit of a beating. But as we slip into a very short break, let's listen in to the Managing Director of Dimension Corporate Finance Services, Ajay Srivastava, uninhibitedly expressing his appreciation for President Donald Trump. He said that Trump has done a great job for America at his age. He also shed some light on how Indian equities are positioned currently. Listening.
I think it takes a great become the president, gets persecuted, comes back again, shows resilience. At age 79, 78, imagine electioneering in America, traveling to all the sleeping in a new hotel every day. It takes you courage and resilience and perseverance. I think it's impressive, very impressive performance. And everybody has frailties, everybody has problems. But I think that one thing to note is you need a man of severe guts to say, I'm 2 years on the election run, I'm going to sleep in different hotel rooms at age 77, 78, and still come out fresh, wearing a suit and a tie every day. I think it's the greatest thing. It's the greatest antidote to that cargo pant culture of this world. They're formal, nice. It makes the world go around, and that's what you like about the guy. Come out in a suit and a tie and say, "Okay, here we do, man."
Ajay, what about the policies? I mean, looking good, looking fresh. What about the announcements?
No, I think he's done a great job for his country. He's supposed to look after his country, not the world, and that's the honest fact. He's done a great job for his country that at least put people on notice. You want American markets, you got to be reciprocally alive to that, allow the American goods to come in. And America has lost a lot of market. If you look at cars, America is nowhere in the cars in the world today. If you look at electronics, America is gone in the electronics world today. So, in a way, what we are seeing today is a reflection of what's happened in the last 25 years. You may disagree, agree with some of the policies, but the fact is, he's there to look after America, full stop. We don't like it. Nobody likes it because he's hurting us at the end of the day. And I'm an Indian. We are getting hurt as well. So to that extent, you don't like the policies. But the fact is, his job is to look after America. He's doing that for America.
Let's talk about the Indian perspective. And yes, Trump is looking out for America. We're looking out for India, as we should. Now, in a world like that, what happens to the economy? What happens to certain sectors? And what happens to the equities? What do you think is the perspective on Indian equities right now, which seems very bothered with what's happening globally, but it has that underlying strength?
I think, we have developed now a third pocket of equity investors, which is the portfolio managers and AIF. So while we keep reporting mutual fund and FIs, now you see a diverse movement, or even on days when the FIs are selling, even the DIs are not buying, the market is showing resilience. And I think the third big pocket which is coming up, the portfolio managers and AIF, is becoming a huge pillar for investment in the country, and money is still pouring in. So on a demand supply front, I think demand for equities is going up and will further go up if RBI pursues the path of interest rate reduction, because your returns on savings and fixed deposits are going to go down. You're going to look at alternate. So equity markets are resilient. They have got enormous demand potential. They face only one drawback, that you will see in the next 1 to 2 years, a lot of allocation going to metals. People have missed out the big metal rally which has taken place, gold and silver. Silver is still coming off for the tracks at this point. So I think you will see a large amount of allocation of capital to those two precious metals. But having said that, I think we have a resilient market.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, Real-time stock picks.
Do I buy Ola? Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live. Ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Welcome back. You're watching India Market Close, and it's one of those middling days, not too hot, not too cold. Well, in the red, definitely about 0.25% down on the Nifty, and that's how it's been through the day. The only spot of relief on the bank Nifty of all things. But range bound trade and not really holding on to gains. What's working is very few stories far in between, and some movers in this we were talking about Avenue Supermart earlier in the day. So you're seeing some retail stocks doing all right. We should pull up Trent and see what's there. So D-Mart is one of them which is doing fine. That's about 4% up because of its Agra foray. Trent is doing okay. IndusInd in focus because of good brokerage notes. So you have a smattering of stocks working here and there. But on the losing side also, look at a Hindustan Zinc because of that stake sale. Seeing quite a bit of pain moving through the day as well. Inventorist is another one, and you know, Harsh, as you were pointing out, it's a anchor lock and expiry that we're seeing pressure on as far as Inventorist is concerned, 8% down. But otherwise, not too much that you can spot in this afternoon session.
Yeah, I mean, there are of course some movers, but it's limited even on the index, especially in fact on the index, and more so even in broader markets. Let's bring on board, in fact, Kush Bora, founder kushbora.com, Avinash Gorakshekar, Profit Mart Securities, both of them joining us on the show today. Kush, let me come straight to you first. Very good afternoon. Talk to us about what you're seeing in terms of observations from the move both yesterday as well as today. Give us your take.
Hi, Harsh. Very good afternoon.
Good afternoon.
I'm seeing a lot of silver linings amidst all this red on the screen that we're witnessing. Now, yes, we've not held up, but if you see the last three sessions on the Nifty, on the bank Nifty, we've constantly hit that resistance zone of 24,950, 25,000, and then retraced from there. So I'm taking heart from that. Now, if you see, we're trying to hold on to that 20-day moving average. Amidst whatever is happening, there seems to be some buying interest that is keeping the market from breaking below the 24,750, 24,800 support zone. At the moment, the put option activity suggests the call option activity suggesting that the resistances are shifting lower from 25 to 24,900 to 24,800. However, if we just dial the clock back just about a week, last week, in fact, we were looking at 25,200, and suddenly, on the day of the expiry, the put writers were in a bit of a shock, and 24,800 was tested. Maybe this time around it could be the call writers, who might see some pain. ECR is already below 0.7. We are at 0.65. So I'm being a little cautious, but cautiously optimistic. Since the kind of oversold zone PCR is suggesting the kind of buying interest at least somewhere middle of the day we are looking at. So 24,500, 24,400 is anyway a strong support zone. If we do, however, dip today or tomorrow for whatever reason, I think the risk reward ratio will be very favorable, and I am looking for buying opportunities, in the middle of all the red that we are seeing on the screen today. Yesterday we spoke of Bank Nifty. It did give you that good move today, but again has given up gains. But I'll take that. So I'm looking for buying opportunities in the middle of everything that's happening right now.
Buying, Kush, good afternoon. Buying on Nifty, Bank Nifty. What about individual stocks? Any calls this afternoon?
Hi, Tamanna. Yes, despite the optimism and there is some bit of caution as well. So still going with a long and a short. Yesterday we had a short call on Kalyan Jewellers. The target one on that one has been hit, and nothing to suggest that that downward momentum is coming off. So for targets of 500 and 490 this time around, and a lowered stop loss of 520, Kalyan Jewellers continues as a short call. On the long side, I've got MCX. We did discuss how some of these capital market plays have heated up, saw correction, and now MCX is one of the first to actually recover and gain whatever lost ground there was, and it's now actually back to those all-time high levels. Good momentum, good volume action as well. 8150, 8350 seem like very reasonable targets on this one. On the upside, 7750 is where you place that stop loss.
Okay, so those are some of the top picks from Kush. Avinash, do you see retail as a sort of a space that you want to look at this afternoon and from the next couple of days, that kind of a view? I'm just talking about Trent and Avenue and what we've seen there. As a broader theme comes in of consumption improving, do you think that retail is a space you'd want to look at?
Yeah, I think, Tamanna, if you look at numbers from Trent and both DMart, I think the April to June quarter will definitely be a very strong quarter. We are expecting that, consumption has already started moving up. And I think across the kind of categories both Trent and DMart operate, you could see a stronger throughput and a volume growth for both these players. My sense is that this is the start of the financial year. So, it's going to be a very gradual, slow beginning. But definitely retail is one area where I think markets could possibly look at them more favorably, because looking at the kind of footprint both Trent and DMart are putting, clearly I think once the rural markets also improve, cash flows from these markets pick up, I think you're going to see a lot of buying coming in from these target segments also. So I think we'll have to wait and watch what kind of volume growth numbers comes in, what kind of margin improvement comes in, but there's a huge latent demand which has to be catered to. And I think both Trent and DMart, operate in different categories, but they are quite well positioned. I think, any dip in the market, my sense is, not at the current levels, but maybe a slightly dip in the market could be used to, accumulate positions in Trent and DMart. But yes, from a longer term perspective, current valuations are not anywhere cheap. So maybe, somebody who gets into these stocks has to take a view of at least next 12 to 18 months.
Okay, that's on retail. Now the other thing is IT, right? And it's done so well in the recent past. So we've caught up with the management of Happiest Minds, and Venkatraman Narayanan, who's the managing director of Happiest Minds, spoke to us. Here are a slice of that conversation. There's a lot of murmur around how while there was lack of maybe ordering activity or sentiment up till now, up till April, up till May maybe, things are at the margin changing. Companies are winning orders, even though these are short cycle deal wins, if you will, and that the sentiment will improve materially towards the second half. How are you gauging the landscape currently?
I would also echo with that sentiment, Niraj. See, what's happened is I've been always saying that you can't stay away from investments in IT for too long. Given all that's happened in the last, year, 12 to 18 months, there has been some bit of, I would say, pause on spend from the IT side. While it's starting to come back, it's not coming back the way it happened after COVID, but there is that a bit of release in budgets, and we are seeing, our pipelines are slowly getting full. Existing business, new business from existing customers is also showing a pickup in there's a traction that's happening. We are also starting to see new business, new discussions around that. The last 18 months, you had geopolitical issues, you had elections in the US, you had aspects of the uncertainty over generative AI or AI as a whole. So all of that is slowly, I won't say receding, but people are able to work and they've made peace with that, and they're trying to get back to business.
Okay. Okay, so is there a perceptible change right now, or are these early days and we might be trying to read a lot between the tea leaves, or is there a perceptible change and maybe it will start showing up in the way business comes in for the sector at large and maybe for you as well?
I think the sector at large, has been waiting for this turnaround. We are now, most of us are looking at a nice pickup in the second half of the year. Q1, Q2, pretty much you've been covering us and the industry for quite some time. The quarter is almost done, and Q2, whatever needs to be done is almost in flow right now. So you can't really change the events or the course of events of Q1 and Q2 to a great extent. So Q1 and Q2 is almost, we are on target or whatever we had set for ourselves. But talking about a pickup, the macro scenario, it's the second half of the year. Last Q3, Q4, we thought things would change and there would be some bit of opening of purses, so people would come back to the spend, to the table to discuss stalled projects that thanks to the border skirmish or whatever we can call about with what we had with Pakistan and the interest rate cut that happened at the federal level or in India, they were all, while expected, took time to materialize. Now they are all behind us, but now again, what's happening in East Asia. But while all of that, I'm giving as a, I'm not talking about them as a cover for how things will look forward when we look forward, but it's essentially looking better in the second half. That's a summary of it, Neeraj.
Which is very, so by second half you mean second half FY or second half calendar year?
No, we are talking about FI. So
FI, okay.
Q1, Q2, yeah.
Okay, so expectedly maybe from September or October onwards, things will start showing material difference.
That's what we are looking at. That's exactly what we are looking at.
Got it. Now, and while you will provide a revised timeline for that aspirational 1 billion target, and we'll wait for you to do it when you do. But while you mentioned that, and I didn't get a chance to talk to you during your numbers, but you mentioned about moving back operational metrics higher by 500 basis points over 2 years, right? FY 26, 27, you get back to 22% from 17.5, what have you. Now, is this already on road, the improvement despite the sluggish piece right now, or do you anticipate that with the second half momentum coming in is when your operational metrics will also start looking better?
Like I have said, as far as our performance was concerned, the drop from 21% to the 17.5, 17.8% that you rightly pointed out was primarily on account of the investments that we made in new business, the investments that we're making in GBS, and obviously some of the investments that we have now started making into the Artha banking platform. So these three combined, have to start paying off. Generative business services is now a year old. We are hoping to start breaking even this current year, and then it should start contributing positively to the bottom line. And given the way, you have billing rates in that business, the kind of work that we do in that business, it should be fairly profitable. The way we look at it, on the operating metric standpoint, we should be better than what we do with the traditional, digital services. As far as the new sales team is concerned, it's something which was put in place. It's beginning to start firing. You will start seeing there is a lead and lag effect for any salesperson or any sales team that you put in place, minimum of 6 to 9 months. That's also now slowly we are coming to the end of it, and we'll start seeing, performance coming in. And that's some of the confidence we have going into the second half of the year that the new sales engine will start fire. The third thing is Artha banking, which is a decent banking platform. We are making investments into it. It is today close to $7 to $8 million in revenues for us. If you have to take it to the next level and target higher numbers, you need to make that investment to make it digital ready, a little bit more integrated with the UPI and the likes, and a lot of things that need to be done to target the Indian banking sector, which is a key market place for us, market segment for us to target for future growth. So if you adjust for all of this, we should be fine with the 20-21% operating margin that we talked about earlier.
Got it. One last question. So, okay, well, that one last question was effectively about asking him if indeed the operational metrics, etc., will all move up, to which he had affirmed yes. But this is interesting. And Avinash, are you a buyer into any of the mid-sized IT names at all? I mean, Happiest Minds is a case in point because it has gone up yesterday, but there are others too which are moving up. Are you a buyer here or would you not?
No, I think Neeraj, we have been quite positive on companies like KPIT and Persistent. Our approach is that in the smaller companies, you could possibly see a better degree of earnings traction. And as the Happiest Minds management mentioned, I think we are quite optimistic for the sector from the second half. Our sense is that the first 2 quarters may not be great. I think some clarity will be visible once the US-India trade deal is also finalized. And obviously, some more larger client order wins come for these companies. So, markets could possibly see a little bit of traction for most of the large and the smaller size of IT companies once more orders gets announced. There's a lot of latent demand, but I think order materialization has been taking a long time. So I think post September, I think possibly the second half could be a lot better. And once order deals, new deals start trickling in, I think the market would start penciling in a better kind of earnings growth for the sector.
Okay, let's take a very short break and come back with more ideas, more stocks for the last half hour or so of trade and what's buzzing at this point. We'll be right back after the short break.
That's huge. That is a biggie. It's out of
गोल्ड ग्लास क्लियर ग्लास, कार हो या नियर, सब कुछ दिखे क्लियर।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
Well, stock of the day today, IndusInd Bank is the top gainer on the Nifty 50, and it's because Nomura has hiked the target price from 700 to 1,050 rupees. Can this essentially spur positive momentum on other analysts as well to likely hike target price is really what I will be thinking about and what most should consider as well. Well, the past few months have been turbulent is what Nomura is saying. Bank has undergone significant cleanup is what they are saying. They are comparing an IndusInd to an RBL or a Yes Bank, and they are saying that leadership exits there were largely due to asset quality concerns. That's what AQ really stands for. IndusInd's liquidity and capital position though is healthy in comparison to the former two, and there's a faster improvement in the profit in the medium term that Nomura is penciling in. They are in fact expecting FY 27-28 EPS increase of 14 to 16%. They've hiked their EPS estimates, and they're expecting ROA as well as ROE improvement going forward. The ROA they're expecting 0.8 to 1.1% FY 27 ROA, and they're looking at an ROE of 7 to 10%. It's done 0.4% in ROA in FY 25, just for context. Valuations at 0.9 times 1 year forward look inexpensive is how they are terming it. Risks being new leadership coming in fairly quickly and starting to act, and second is discrepancies in the book. If anything fresh comes up, that's a problem, or if leadership takes time to kickstart the process, that may also play a little bit of spoil sport. Talking about the overall analyst ratings, 10 buy calls, 14 hold calls, 22 sell calls, with a 12-month target price 752, which is a negative 12% return. So playing contrary here is Nomura. But let me go across. Kush, do you have a view with regard to IndusInd first?
Well, after the debacle, it was an avoid for the longest time. Now it's starting to, show some strength, but I wouldn't go out and buy just yet. Now for the fall, that started somewhere in the early part of 2024. It's at the retracement level of 23.6%. That comes at 865, not too far from where the bank is positioned or the stock price is positioned currently. So I'll wait for this resistance zone to be taken out and then perhaps initiate a long position, because from there on, the targets actually come to 1000 and about 1150. The risk reward ratio we understand is fairly favorable. And on the downside, you've got a support zone at 750. So from a risk reward standpoint, it is fairly favorable and not too far from the key resistance and supply zones. So wait for 865 to be taken out on a closing basis. Then perhaps you can consider a long trade on IndusInd Bank for a small amount and a much favorable risk reward ratio.
Just that question to Avinash as well. And fundamentally, the fact that the worst is over narrative has begun before we knew or before we know who is going to be the new leader in charge of turning the ship around. Does that tell you that there's more runway there to the IndusInd Bank story from this point?
No, I think, Tamanna, I think the selection of the CEO is very critical. I think if you get a leader who's very well accepted in the market and which has a very strong profile in turning around, bad situations into opportunities, then I think the stock would definitely get further re-rated, because initially, it's going to be the narrative which is going to play out now. We'll have to wait for numbers. And I think in case of numbers, IndusInd Bank has clearly disappointed investors very badly. I remember in December, the problem started. They said the next quarter is going to be a normal quarter, and the March quarter was a horrible quarter. So I think markets will also look at numbers and data points to prove the the narrative, which is very right or wrong. I would say that once the CEO is selected, some more clarity and some more positive sentimental factor will play on the stock. As of now, I think people who hold the stock can hold on. Somebody who's a risky investor and can take the bet now can definitely chip in currently, because most of the worst price is already there in the price, as you rightly said. But I think to get a real complete turnaround and a real risk reward opportunity, I think the process could take as long as say 12 to 18 months, because it's going to be a long process. Building market confidence and building the data points again on this base is going to be a big challenge.
Really is the question, that is the recovery story baked into the price, or is there more to go? Just another one, if you've been tracking, Avinash, is Inventoris. Of course, you've seen an anchor lock-in ending today, which is the reason that you have pressure on the stock. It's a relatively recent listing. Is this a company that you've been seeing, and would you say that there's potential to pick up right now?
Yeah, I think, these kind of, drops are normal. I think, Tamanna, I think, normally all of us know that whenever there's an anchor lock-in getting complete, or maybe there's a block deal or an OFS, I think stocks react not on the fundamentals, but more on the supply side kind of issues. So this is a company where I think, you got a lot of marquee investors, a lot of good institutional investors already invested. And if you are looking at the next 2 years, I think they have a very strong business model, a very strong revenue kind of built up. So my sense is that somebody who's looking at a good long-term portfolio kind of addition could obviously take advantage of the price drop now. I think not in the short term, but in the medium to long term, I think this could be a very good opportunity.
Okay, IRP is the other one that I just want to pull up, and curious to know what is happening there. And folks, you must have seen this tweet from the Union Minister Nitin Gadkari saying that now they are going to have an annual pass for FASTag, 3,000 rupees for the year or 200 trips, whichever comes first. And I was just looking at some of the reactions. The biggest question is, what will you count as one trip? If you're going on a route, say Mumbai-Pune, Mumbai-Bangalore, is every toll naka stop a trip?
Yeah, most certainly.
Then 200 trips is not that great. 3,000 bucks is, is it a good deal then?
I think it's a great deal. I think it's a great deal. I'm just doing the simple math that it comes to an average of 15 rupees per trip, right?
Yeah.
Any toll anywhere in the country is more than 15 bucks.
Yeah.
It's a no-brainer.
So just on
if you
those
travel
averages.
a lot, seems to be a no-brainer.
I'm just curious what happens to the toll collectors like an IRB. That's what I'm curious to know actually. Avinash, do you have a view with regard to this one? Sorry, just coming out of the blue, but is there a view that you have as to how this will work?
Well, I think 3,000 rupees is definitely worthwhile, because as Neeraj rightly pointed out that, the average, I think toll price what we pay is normally about 75-80 rupees. So, 15 rupees is a steal. But I think as far as the road contractors are concerned, I think they could see their margins obviously coming off, and that could be possibly one of the reasons why the stock is down. That could definitely mean both in absolute terms as well as in margin terms. I think the kind of margins which these companies make could possibly see a significant erosion. So I think it's good for the customer because this is definitely a very good proposal, and that is definitely going to increase this alignment, with customers.
Okay, so it's a negative news for toll collectors, and since only 1% down on IRB, maybe they're waiting to see what kind of momentum comes in, or what are the details of the deal, but it has been announced at this point. One stock that is buzzing in trade though is Zydus Wellness, and was our company that we featured on Know Your Company as well today on the channel. Stock is about 6.5% up. This is on the back of Parag Parikh scooping up 7.27% stake sale from the True North Group. Is Parag Parikh betting big on the company behind Sugar Free and Complan? Why is it? What's the bull case? And of course, importantly, what's the bear case? Mahima is joining us for more.
Right, so it's certainly a very interesting day for Zydus Wellness today, and as you rightly mentioned, the stock is buzzing in trade today because Parag Parikh has bought in around over 7% stake in the company. Now, in terms of how the bull versus bear case pans out for this counter, volume growth has been in double digits, which has not been the case for almost all the FMCG companies in FY25. This is because they have a significant amount of rural penetration, so smaller packs means higher volumes. In terms of bear case, the 3-year CAGR revenue growth has been at around 10%, EBITDA hardly at 3% and PAT at 4%. So the company has been growing, but not the growth has not been very surprising in terms of how 3 years have panned out. In terms of the next case, margins. Well, margins have been under pressure and have come down to that 14% mark, which were at around 17% mark in FY22. But the management has said that they will improve and come back to that 17 to 18% margins in the near future. That is a couple of years it will take, but it will come back to those margins. Next, in terms of cash flow from operations, well, overall, the operation from cash flow has been improving. It has gone to around 380 crores in FY25. But overall, net cash flow position still remains a negative, so that could be a slight overhang on the company, which stands around negative 30 crore. The next one is return ratios, which are not very impressive. Both ROC and ROE stand at around 6%, but valuations again, though 24 times to 2027 estimates as per Bloomberg is not very cheap, but still it's the best valuation amongst the entire FMCG pack and in the entire industry as well. So 24 times 2027 estimates for Zydus Wellness. Lastly, well, as I mentioned earlier as well, that Parag Parikh has bought in around 7.2% stake in the company. But if we see the stock performance of the company so far, the stock has hardly gained 5% in the past 1 year and 53% hardly in the past 5 years. So we'll have to see as to how the stock now performs post Parag Parikh entering in. Lastly, in terms of how analysts are viewing this company, well, right now, as per Bloomberg estimates, there are 5 buy calls on the counter, 1 hold, and the return potential suggested is roughly 16%. And lastly, just one point to mention here is also that the company has consistently maintained the dividend payout ratio as well. That is anywhere between 10 to 12%. So every year, company declares dividend anywhere between 5 to 6 rupees per share. So this is the overall view of how Zydus Wellness, of course, the bull versus bear case for Zydus Wellness, but we also had the management today on KYC show, listening to what he had to say about margin trajectory going ahead.
We want to get back to our 17-18% EBITDA margins over the next couple of years. There are 2 or 3 paths that we believe that will help us get there. First of them is that gross margin expansion. So we believe that between FY21 and FY23, largely led by a significant impact on various commodities, milk, oil, practically everything went up, and most of the FMCGs we saw gross margins came under pressure, and we were no exception to that. We've been able to consolidate and improve our gross margins, and there is still scope for building another 1 to 2% gross margins in next couple of years. Furthermore, if we continue to drive our growths ahead of our costs, I do see a scope for building an opportunity around operating leverage, which should help us improve our EBITDA margins and take it to closer to 18.
Well, thank you, Mahima, for that, and of course that perspective coming in from the management as well. Let's go across. Avinash, what's your take with regard to a Zydus Life?
No, I think, see, longer term, I think it's got a very good product portfolio, and I think clearly looking at the kind of numbers which they have presented till now, I think the markets would expect a better degree of earnings growth. Unless and until you get an earnings growth of at least 20-25% over the next 2 years, a multiple of say 27-28 times is not justified. So my sense is, Parag Parikh has obviously have made their own kind of view on the stock, but we would believe that let the April to June quarter come in. I think we could get a better, decent amount of idea about the traction, both in terms of top line, in terms of profitability. And dividends are not the only reason one buys any stock. So I think one would look at the earnings growth trajectory now, especially for 26 and 27, and thereafter I think one could take a call. But structurally we are positive, but not at the current price. We would prefer to buy the stock at lower levels.
So, Avinash, what levels will you look out for to buy this one?
No, I think anything around say 1900 or maybe 1950. Lower levels below 2000 odd levels would be ideal.
Push, your take?
Very interesting moves on this one. 2000 was a bit of a stiff resistance. It's broken past that on the back of good volumes. We all know why now. The next major resistance comes at 2175, 2200 mark. So if you have a position, you could continue to hold. And for those targets as well, if you want to enter a fresh, it can still be considered stop loss close to the 2000 mark, maybe just under it. And for levels of 2200 and higher, Zydus is still a buy. And positionally also looking good. It's just given that breakout above the 2000 mark, could well continue to 2200 levels.
Okay. So Zydus Wellness in focus. Let's also look at a few others that are buzzing, and Mahima is with us. Let's go through some of the stocks that she's tracking today. Let's start with Trent, another stock in focus because of brokerage calls. Citi, Morgan Stanley, both of them have a call today and are fairly bullish. Why is that, Mahima?
Right, so basically both of these brokerage notes have come out with a view on how annual report panned out for Trent, which they had last week posted. In terms of what Citi is saying, they've maintained a buy rating with a target price of 7,600. They're saying that the 200 store expansion per year is likely doable by Trent, and this is along with ensuring quality experience as well as economics and the location diversification. They're saying new stores will reach very high throughput and maturity within 12 to 24 months of opening. Majority of the same store sales growth for Trent is volume driven, so they will not be taking any kind of major price hikes in FY26 going forward. Value retail is not a zero sum game, and there will be multiple winners in the retail space is something that Citi believes. And they're also saying that overall Trent barely consolidates or closes store due to store economics, so that is a positive takeaway for Trent. Morgan Stanley on the other hand, in fact is on the same side as Citi is. They've maintained overweight with a target price of 6359. They're saying that management is confident of achieving the growth that it had penciled in 2023 as well. They're aiming to go 10x bigger in the near distant future. They're planning to grow their revenues to 10x in FY32 as compared to where they were in FY23. The focus remains on quality as well as store density in proximate markets, and companies expanding into under-penetrated markets to increase revenue growth and share in micro market as well, because the company has come out and said that they will now be expanding in tier 2, tier 3 cities and going aggressive there as well. Lastly, Trent was free cash flow and is net cash flow positive as well in FY25, so that augurs well for the company. So these are the reasons as to what makes brokerages bullish on Trent.
Stay on with us, Mahima, because Avenue Supermarts is the other one which is in focus. It's expanded into Uttar Pradesh. It's been received quite positively. In fact, Morgan Stanley, though, maintains an underweight but is bullish because of this expansion. Why is this such a key move?
So, Avenue Supermarts has had presence in UP, but this is the first large format store that it has opened in Agra Ratan Mall, and now this takes the total number of stores to 421. Basically, this is the first major store opening in the state of Uttar Pradesh, so it is perceived well by the street. And this being India's most populous state, it augurs well for growth of DMart as well. In terms of how DMart has been following their store expansion strategy, they've always focused on ownership rather than leasing or asset-light model, and they're also following a cluster-based approach for store expansion as well. Now, as you rightly mentioned, Morgan Stanley remains underweight with a target price of 3260, but what they're saying is that they're viewing this store opening in UP as a positive step, but where they'll wait and watch out for as to how store expansion in UP takes place, and they'll closely track it going ahead as well. So this is the overall view as to why Avenue Supermarts is buzzing in trade today.
So Trent and Avenue Supermarts are both buzzing today. Kush, between the two, which one would you prefer and which do you think has more steam left in it?
Trend for sure. There's been a good up move. There's a rising trend line support on this one. The risk reward ratio is favorable, with the next resistance coming in at 59.50, and once that is taken out, 6200 as well. The rising trend line support that I just mentioned close to the 55.50 mark. So good risk reward ratio on trend up move could well continue. Volumes are a little thin for my comfort, but in a market like this, a positive move is more than welcome. And the reason I picked Trent over Avenue Supermart is 4250 has been that level that DMart has not been able to take out since the start of May. Even today, if you see, the high is close to that level. So maybe give it one more day, see if it is actually able to move past 4250, close past that, see that supply hangover get done and dusted, and then move higher. So Avenue Supermart on wait and watch list, and the trend seems like a good buy from here.
Okay, then try and look at some stocks which are moving around in trade, and of course, from small to large, Mirza International, LMW, there are a few illiquid ones which are also moving around, but there are some moves that are happening in select names on the downside as well. So bear some of these things in mind. JHS Svengard, a bit of a move there. So some smaller names coming to the fore currently. Kush Boda, yesterday you called the one on Sterlite correctly, right? Wherein taking money off the table was a prudent idea, you mentioned. Any thoughts here on what to do now? It is down about 5 or 6% today. In fact, Hindustan Zinc, Sterlite, as well as Vedanta, all three are down.
So, Neeraj, I think I'll wait and watch on this one for some more time, because while the stock is correcting today, it's actually close to the low point of the day as we speak, which means perhaps the selling pressure is not done and dusted yet. Now it's got multiple support zones near the 101, 100 mark. If this profit booking rally does take it to that level and that is respected, I think this leg of up move that started might just continue. But given the kind of volatile streak that this stock has witnessed, and by that I mean since inception, especially since 2014, I am not sure if I want to stay invested in a stock like this. If it's a trading bet, I got a neat profit in a short while, I would perhaps take money off the table, stay out. So far too volatile for my comfort. From a very near-term perspective, 100 is the level that you want to watch for. If that is broken, this rally that had begun could perhaps fizzle out much sooner than expected.
Okay, some stocks. So Orient Cement, by the way, has a block deal and a very sharp downtick today. So it's down about 17%. It started off lower, staying lower. Subros started off lower and probably staying lower. So that's the other one you want to keep an eye out for. A couple of weak hands currently. Cement overall has a slightly wobbly day today. Avinash, are you a buyer in any cement name, or are you avoiding them?
No, I think clearly, Neeraj, from a longer term perspective, we are positive on both the large cap, companies, Ultratech and Ambuja Cements. In the smaller company names, we believe, companies like Heidelberg Cement looks to be quite promising. So I think, clearly in this kind of market, in the current scenario with monsoons having arrived, construction activity normally takes a back seat. So I think you could see a lot of action post September, that is second half of this financial year. And with the kind of infra growth and the kind of money spending by the government, private capex going up, my sense is that cement will be a very good story, in the second half of this financial year. So I think, probably one needs to take a slightly longer term call, but Ambuja Cement, Ultratech and Heidelberg, these could be good bets, for the next, say, 12 to 15 months.
Now, on to more stocks and updates. Divi's Lab, of course, is in focus. This morning, we broke with this piece of development that happened. And Varsha joins in to talk about how important could this be, because Varsha started off well, has cooled off completely, but tell us about the interest or importance.
Yeah, well, thank you for that. So the news is that Novartis and MSN Pharmaceutical have settled the 659 patent for the drug Entresto, which treats heart failure. Well, this is good news for DV's lab, because this settlement could lead to upgrades for DV's lab FY26 and FY27, because if the path is clear for Novartis, the path is clear for DV's lab, because DV's lab supplies API, that is the active pharma ingredient for this drug Entresto, which contributes 8% to DV's lab total revenue. Now for Novartis, if you see, the Entresto is $7.8 billion opportunity, and they have faced, drug threat, rather dual threat from government price negotiation and generic entry. So now no generic entry, which is good for Novartis and good for DV's lab. Even US court had rejected Novartis bid last month to block MSN generic Entresto, but now that has been cleared, and Novartis is aggressively defending its market share. Even, in fact, if we are sticking to this pharmaceutical, Aditya Khemka, who's the fund manager at Incred Asset Management, is of the view that one should not come out of pharma sector. Listen into the bite where he says that pharma sector is a long-term way for healthcare in India.
So see, you cannot miss healthcare as a theme in India simply because we are just 3.5% of our GDP is on healthcare versus United States at 17, Singapore at 9, and Russia at 10. So clearly, there's a long runway for healthcare consumption in India, and that's the theme we should be playing at this point. And if you have exposure to exporters today, it just might be prudent to switch the position, because the exporters really are exposed to a lot of earning downgrades, tariff risks, and the valuations aren't really discounting those things today.
Yep. Okay. So that's of course on some of the pharma names, guys. The other thing is, a lot of people talking about how the last few days we've seen a lot of stocks which were completely beaten down, bouncing back. Right? Z, a case in point. Forgotten stock has bounced back. There was a reason. Then Tamanna just pointed out the ADAG group stocks suddenly coming up and smelling like roses, and it's not just a 1 day, 2 day move. There's been a sustained move.
Infra, Reliance Power, so Reliance Power, I think on announcement few days ago, Reliance Infra on the Dassault deal to make the Falcon 2000. I don't know if I'd club them in the same situation as Z, because Z's story was a little different.
Yeah. No, but fundamentals separate, but the stocks which are beaten down.
So the comeback boys, basically. Not yet the kings. The comeback sort of, few of those are definitely being seen. But I think the other important thing, in fact, let me ask Avinash about it very quickly. Avinash, just on Reliance Power and Reliance Infra. Smart moves, Reliance Infra back in focus today, but would you look at any of these even as they're showing signs of a turnaround?
Playing out very well. Now, I think the markets want actually numbers to come out. I think, if you look at Reliance Infra or you look at Reliance Power is the most stable kind of player in a very stable business. So I think I would be more keen to be invested in Reliance Power, for the longer term. But as far as Reliance Infra is concerned, I don't think, they have got a large experience in the defense business. Of course, they've got orders, but how they execute them, what kind of numbers come in. If you compare Reliance Infra as a defense play with the other defense companies, I think it will take some time before markets digest the fact that this could be a very promising growing business for them. So I think let's wait for a couple of quarters in Reliance Infra, but Reliance Power, I think at these levels, if one were to take a couple of years view, then I think it seems to be quite well positioned.
Power also seeing quite a bit of a comeback. All right, important story that we're tracking this morning, an important exclusive clarification coming in on NDTV Profit. So government is introducing a FASTag based annual pass priced at 3,000 rupees. First, let's tell you what Transport Minister Nitin Gadkari has said about it.
3,000 रुपए में जो पास है साल भर का, उसकी अगर टोल पे किया जाएगा तो उसकी कीमत कम से कम 10,000 से ज़्यादा रुपए का टोल देना पड़ता था, वो केवल 3,000 रुपए में होगा। और ये जो वैलिडिटी है, एक साल में 200 ट्रिप वो क्रॉस कर सकते हैं। इसके साथ साथ एक ट्रिप मीन्स एक टोल को क्रॉस करना। इसका फ़ायदा ये होगा कि 200 ट्रिप्स यानी 200 टोल क्रॉस करना होगा, और एक टोल क्रॉसिंग की एवरेज कॉस्ट केवल 15 रुपये पड़ेगी। कुछ जगह पर ये 80 रुपये है, 50 रुपये है, 100 रुपये है, तो ये केवल 15 रुपये हो जाएगी। और मान लीजिए एक टोल पर आप 50 रुपये भी देते हो तो 200 टोल क्रॉस करने पर उसकी कीमत 10,000 होगी, उसके बदले में आपको केवल 3,000 रुपये में ये पास मिलेगा, एनुअल पास।
Okay, so sounds good from the point of view of the rider, and of course this is only for private vehicles, but from the point of view of IRB Infra or toll collectors, it's a negative, isn't it, or should be at least. But you know, Anushi, you've spoken with IRB Infra, you've got a sense of what the impact will be. What are you hearing?
Well, right, Tamanna, as you mentioned that while this is a big positive that we are seeing for the consumers on the non-commercial private vehicles that we are looking at, for road developers, this might have been a concern. Well, that's what the expectation was. Now we have IRB's response to this, wherein they are seeing no impact basis this discussion which is ongoing with NHAI. In fact, they are saying that they will be compensating the differential toll to each developer, and this would be on a T+2 basis that we are looking at. So any kind of impact on financials is unlikely to be seen on that basis. Just on that, IRB's outlook, if we just recollect, they see a lower double-digit growth in FY26. This is in terms of toll collection that we are looking at, and they have 2 new toll projects to be operational in FY26. The order book standing at about 31,000 crore as of FY25 end. So that's the story that we are seeing on this bit.
Okay, good one, Anuchi, and an important exclusive coming in. I mean, I still have a few questions there, that how would this T+2 settlement work? What would the calculation be on every toll? Why would the government want to come in and compensate? So I think this street might not be fully convinced that this will be something that IRB Infra will be unscathed from.
Yeah, I mean, the jury is out. I mean, why would the government want to come in? I mean, just ease the life of people who do a lot of transport and give them an incentive to do roads, maybe. So I'm just thinking out loud, right? I don't know the answer really. But if you ask me, right, and you may have a different version, Harsh may have a different version, but one of the versions could be that with competition heating up on trains, planes, etc., the government is saying that we are setting up great highways, come and use them instead of traveling to roads, etc., because we are easing up the toll costs.
Yeah.
Maybe.
Yeah. And also to get people onto FASTag.
That too.
That is the
Maybe,
FASTag adoption is still a pain. I mean, you go out of large cities and those lines start piling up on the toll stations for sure. So that's another pain. Well, the other big story tomorrow that we need to watch out for, folks, is the Fed meet outcome. Now, this could be either a complete damn squib, complete non-event, no rate changes is what's expected. But just with the heat of Trump commentary on Powell, I just want to stick around to see what he's going to say.
Yeah, so my guess is that Jerome Powell would want to end his legacy as somebody who didn't bow down to pressures from Donald Trump. And therefore, does he stand pat this policy? My guess is yes. I don't know. Do you think the same way?
Yes.
Does he stand pat?
There's no reason to actually change the rates.
No reason to change, right?
I in fact fear that if he doesn't, then there could be downside risk, because then you're starting to question the independence of the Fed.
Yeah, so he doesn't. So they will not, right? Because,
yeah,
so the expectations, Fed may hold rates in the 4.25 to 4.5% range. Headline inflation is moderating, but the labor market is very robust in the US. And oil price rise may ensure that Jerome Powell does not oblige Donald Trump, even if he wanted to. But the big question that has come up in a lot of cases is that could the Fed end quantitative tightening? Could that be the big takeaway from this policy? I think that remains to be seen, because that's not a political hot potato. It doesn't seem that there is any obliging happening here. So this is something one watches out for, maybe, according to me. One thing, QT.
QT, quantitative easing. Outlook on inflation is important. Some inputs from our research desk as well. GDP growth is a key watch. The dot plot, and I agree, the dot plot showing fewer interest rate cuts could be a big downer tomorrow. And the street might react very, very negatively for it. Bond futures are hinting at a 60% odd of a next rate cut in September. Well, right now, the way the world is going, September seems very, very far. The amount of things that can happen between mid-June and September with some new, skirmish or war every 2 weeks seems like it's very, very far. But nevertheless, I think IT will remain in focus. Avinash, just a take on, what would be the bet on IT in terms of a derivative of what we might see from the Fed tonight?
No, I think my guess is that interest rates may not change. And I think despite the fact that, inflation there is moderating, I think oil prices continue to be elevated. And as long as geopolitical factors continue to be hostile, I think until that happens, it's not going to happen. That is what my guess is. And most importantly, as far as IT is concerned, I think you will probably see some recovery, only post the second quarter. In the first and the second quarter, it's unlikely that you're going to see any big deals signed up and, Indian companies bagging those. So I think post September is something which you could bet on. But yes, if one were to look at the stocks today, I think companies like maybe Infosys or maybe TCS, the larger boys, and of course from the smaller ones which we mentioned earlier, something like a KPIT or maybe like typically like most importantly smaller companies like Persistent. We are more positive on these management because we believe that they are far more competent to deliver stronger numbers once new deals get signed up. So I think it's going to be a pick and choose. There's no hurry to go and buy these stocks as of now because technically first quarter is also not going to be anything great. It's going to be more of a tepid quarter. Commentary will be more important rather than the numbers.
Okay, Kush, very quick 10-second question. India Shelter Finance, buy, sell, hold, what do you do?
Well, it's not going anywhere. For me, it's a hold. If you have one, if you have a position, continue to hold with a stop loss around the 840 mark. No real momentum, gaining anytime soon. It doesn't look.
Sure, it's a recent listing, but there's some bit of lock-in expiry, and which is why this one is in focus. Lock-in expiry, 21% of the shares to exit lock-in. IKS was the other one today where lock-in expired, and that stock has taken a bit of a beating today. Thank you so much, gentlemen, for coming in, speaking with us today. We'll let you go on that note. We're around a minute from close. Let's quickly look at how the Nifty is shaping up at close. Around a 1/5% lower on the Nifty, so slight bit of recovery, if at all, one can call it that. Let's look at the intraday chart on the Nifty as well. Take that out of the way. Just off the day's lows. The day's low is 24,750. We're closing around 50 odd points above that. So that's the kind of level we're looking at to close today. Let's look at the breadth, and the breadth was particularly weak, and we're seeing how the ratio hasn't significantly declined in the last hour and a half, but nonetheless 2:1, not really sitting in favor of the bulls. Let's look at the heat map on the Nifty 50 index. We've closed for the day now. Again, the breadth here not looking good. In fact, poorer than the larger breadth in the broader markets. IT also seeing some bit of pain. IndusInd standing out on a day like this, along with Titan, Trent, and even Maruti. In fact, auto stocks were the one pocket which have actually outperformed the index for sure today. And you look at some of those names and you'll visibly see that outperformance within the auto pack outside of a consumer, maybe Titan and Trent. Let's look at it sectorally as well, and that's likely what we'll see. Consumer durables 1% higher. Private banks up 1/3% thereabouts. I'll be curious to know the gainers there. But auto around 1/3% higher as well. So those are the three pockets which have stood out. The Nifty Bank has outperformed as well today. In fact, let's pull up the Nifty Bank. I'm curious to know as to whether we've seen a bit of a bounce. We have on the Nifty Bank from that day's low, but near low that we've clocked here in the last hour or so of trade. So we've seen a good bounce on the Nifty Bank. Let's pull up the Nifty Private Bank in terms of constituents and probably see that as well. Zoom in and see what are the maybe a couple of stocks which have moved there. So that's how the private bank has shaped up. There you go. So that's what's pulled the index higher. The Nifty Bank constituents, if we can probably also get an indication there. So it's IndusInd, of course, 5% higher, but some of the smaller private sector banks, AU, Federal, IDFC, which have led the charge on the Nifty. HDFC also closing in the green, seems to have helped, even though ICICI down 1%. So that's how the Nifty Bank has shaped up. Let's go back to sectors and see which ones have really underperformed, and within that is media, but outside of that, IT is the other one which has underperformed. Metals is down 0.7% as well. That's where the underperformance is. But you know what's not done well is broader markets. Let's pull those up as well. Let's pull up the Nifty mid cap, 0.5% lower. So clear underperformance there. The small cap index largely in line. The Nifty IT index, last off, I want to flag off because the first day in the red in the last 4 is what the Nifty IT has clocked today. We've had 3 good trading sessions, after which we've seen the Nifty IT close in the red. So we're 0.1% lower on the Nifty IT index. That's the one
for you, and from the highs, we've come off quite a bit and we've flattened out. Before I quickly flag cues, I want to look at the BSE 500 top gainers, top losers. There you go. Those are some names for you. Some of the auto names really shining in trade, so that's a positive. Among the negatives, Sterlite Tech, no surprise. We spoke about this on closing yesterday. A big red, a couple of sell calls that came through while we were from our guests while we were doing closing. Hindustan Zinc 7%, again not a surprise. We spoke about this. Happiest Minds down 4% as well. We spoke about this as well, in fact, on India Market Close yesterday. So if you've been tracking us, you would have had a bit of a heads up on some of those names. But let me quickly also point out that the big decision tonight is going to be the Fed interest rate decision. That's the one that we'll all be looking out for tomorrow, and more so the commentary. What is it that they are thinking? Some dividend adjustments and that big lock-in expiry that will happen tomorrow. India Shelter Finance, 21% lock-in expiry. Again, we spoke about that as well. Right at close. We'll probably bring you that slightly earlier so that you can action it from tomorrow. But completely out of time on India Market Close today. From Tamanna, Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. Market Express takes the action forward.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
One question can change everything. The big question. Bold, direct, uncompromising. Tough topics, hard-hitting analysis. Conversations that matter. We break it down, cut through the noise and set the context for you. Hear from top policy makers and thought leaders from the world of business and beyond. The big question really is, are companies using dark patterns to take you for a ride? The big question we're asking today, is the US heading towards a recession? The big question is,
hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight into the show, viewers. A volatile day of trade ended with the Nifty and the Sensex in the red. Nifty just about managed to hold the 24,800 levels, while Sensex shed over 150 points, giving up morning gains. All sectoral indices closed lower, barring Nifty Bank and Auto. Media, Metal and IT lead losses. However, the auto and private bank sectors showed resilience, posting modest gains. The National Stock Exchange has also shifted its weekly options expiry day to Tuesday, while the Securities and Exchange Board of India has approved the Bombay Stock Exchange's proposal to set its expiry day on Thursday. Brokerages have issued varied outlooks. Jefferies maintains a hold rating, UBS upholds a buy rating, and Goldman Sachs retains a neutral rating. Hindustan Zinc shares fell nearly 7%, extending a 5-day losing streak as parent company Vedanta offloaded 1.71% stake for approximately 3,323 crore rupees via block deals. The offer for sale was priced at 460.5 per share and 5 to 6% discount from the previous close of 585.95 rupees on the NSE. Despite a 12,000 crore expansion plan to double zinc lead and silver production capacity as well, investor sentiment remains cautious due to the stake sale and the commodity price sensitivity. Vedanta's board has approved a first interim dividend of 7 rupees per share for the current financial year, with the record date set for June 24 to determine eligible shareholders. Over the past 4 years, the company has also distributed over 200 rupees per share in dividends, reflecting its commitment to rewarding its nearly 20 lakh retail shareholders as of March 2025. Now, this payout underscores Vedanta's robust cash flows and shareholder-centric approach. Shares of Divi's laboratory surged following a patent dispute settlement between Novartis and MSN Pharma over Entresto, a blockbuster heart failure drug. Now, as a key active pharmaceutical ingredient supplier for Entresto, Divi's is poised to benefit from delayed generic competition, potentially leading to upgraded financial forecast for FY26 and 27. Now, the settlement provides temporary relief, but the next patent battle looms with the Entresto's patent set to expire in November 2026. Happiest Minds surged in trade after Anand Rathi initiated a buy on the stock. The brokerage saw a 20% upside to the stock. Now, the management also expected double-digit organic growth and hopes to double down on the expansion. The stock was up over 10% in trade today. Hexaware Technologies drew market focus after Citigroup initiated coverage with a buy rating, setting a target price of 980 rupees. Notably, Hexaware was the only stock in Citi's IT sector coverage to receive a buy recommendation, highlighting the brokerage's confidence in its growth potential. Oil prices eased in Asian trade following a 4% rally the previous day. Brent crude fell to $75.96 per barrel, while West Texas Intermediate dropped to $74.46 per barrel as traders balanced Middle East tensions with the anticipated impact of the US Federal Reserve's rate decision. Meanwhile, gold prices also saw a slight uptick, with spot gold and US gold futures both rising 0.1%, supported by a marginally weaker US dollar. Markets remain cautious, awaiting signals from the Federal Reserve's ongoing meeting, which could influence future rate cut expectations. IndusInd Bank shares soared 5% after Nomura upgraded its rating to buy and raised the target price by 50% to 1,050 rupees, implying a 30% upside from the current levels. Nomura also highlighted the bank's improved governance, smooth leadership transition, and proactive cleanup efforts. Positive sentiment was further boosted by supportive remarks from the Reserve Bank of India and potential approval for a promoter stake increase. Having addressed past governance issues with one-time provisions, analysts see IndusInd Bank poised for a strong start to FY26. Jefferies maintained a buy on Adani Ports with a target price of 1,700 rupees. The company also aims to become one of the world's top integrated transport utilities by 2030. It also plans to maintain a net debt or EBITDA ratio of 2.2 to 2.5 times by FY29. Now, this implies fund requirements of 25,000 crore rupees over FY26 to FY29 for acquisitions and equity moves. Its annual report reaffirms focus on Southeast Asia, India, Middle East, Africa corridor. Now, expansion plans also reflect aggressive growth and regional leadership ambitions. India's air conditioner market faced a sharp 20 to 25% year-on-year sales decline this summer, driven by early and unseasonal monsoons that dampened demand during the peak season. Blue Star reported a 25% drop in volumes and reduced production by up to 25% for the first half of 2025, while Voltas and other key players experienced similar trends exacerbated by high channel inventories. Now, manufacturers have also lowered their annual growth forecast to 10 to 15%, down from an anticipated 20 to 30%. Citi maintains a buy rating on Trent with a target price of 7,600 rupees, highlighting the company's ability to expand by 200 stores annually while maintaining quality, customer experience, and strong store economics. New stores mature quickly within 12 to 24 months, and same-store sales growth is volume-driven as Trent avoids price hikes. Meanwhile, Morgan Stanley maintains an overweight rating with a target price of 6,359 rupees, noting management's confidence in growing revenues tenfold by FY32 while balancing profitability. Trent also remains free cash flow and net cash positive with record return ratios driven by improved profitability and asset turns. Now, the company focuses on increasing store density in key markets and expanding into under-penetrated areas to boost growth, underlying its strong position in India's retail sector. Electrosteel Castings has announced a planned maintenance shutdown of its mini blast furnace production facility at the Kharda Works unit and main plant. The shutdown will last for 10 to 12 days starting from June 18, 2025. This routine maintenance is aimed actually to, for ensuring efficient operations of the facility. Other units of the company will continue normal operations during this period. GMR Airports also handled over 1 crore passengers in May 2025, marking a 0.8% year-on-year increase despite geopolitical challenges impacting the traffic. Delhi Airport's domestic passenger traffic declined 6.5% due to regional airspace restrictions, while Hyderabad and Goa airports saw robust growth of 15.3% and 9.6% respectively. Overall, GMR's network demonstrated resilience with steady passenger volumes and increased aircraft movements, reflecting strong demand and operational expansion across key hubs. Procter & Gamble Health reported a strong Q4 with net profits soaring 31.4% to 61.2 crore rupees, driven by robust branding and operational performance. Revenue also rose 23.2% to 311 crore rupees, while EBITDA increased 20% to 81 crore rupees, with margins slightly easing to 26% from 26.7% last year. Now, this marks a significant growth phase for P&G Health, reflecting strong demand and efficient cost management in the quarter ended March 2025. Polycab India has secured a major order from BSNL worth 6,447 crore rupees for the design, supply, construction and installation of the BharatNet project across Karnataka, Goa and Puducherry telecom circles. Now, this contract involves buildings and maintaining the middle mile network under the BharatNet initiative, supporting the expansion of high-speed connectivity in these regions. Polycab also continues to strengthen its position in the telecom infrastructure sector with the significant win reflecting its growing role in India's digital infrastructure development. EMS Limited has secured a significant order worth 183.8 crore rupees from UP Jal Nigam for constructing various components of a sewage and sewage treatment project in Fatehpur. Now, the project is to be executed over the next 24 months. This marks a major addition to EMS's growing portfolio and highlights the ongoing infrastructure push in the state. Now, the company has also declared the lowest bidder for this contract with no promoter or related party interest involved. Now, this win further strengthens EMS's position in the water and wastewater management sector and is also expected to support its robust growth trajectory. Bharat Forge has signed a major memorandum of understanding with French aerospace company Turgis Gaillard to actually jointly offer the AROC UAV to India's Ministry of Defence. Now, the AROC is a medium altitude long endurance drone capable of flying for over 24 hours at high altitudes and is also designed for advanced surveillance, intelligence and reconnaissance missions. Now, it can also carry more than 1.5 tons of payload, including precision weapons, allowing it to strike targets deep behind enemy lines and disrupt enemy defenses, all while staying safely out of reach. Bharat Forge plans to set up domestic production for the AROC, supporting India's push for defense indigenization and greater strategic autonomy. Now, this Indo-French collaboration marks a significant step in strengthening India's defense capabilities and expanding Bharat Forge's footprint in high-tech military manufacturing. Sanjeev Bhasin, a well-known market commentator and former IIFL Securities Director, has been barred by SEBI along with 11 others in a major market manipulation case. SEBI's investigation found that Bhasin would buy stocks before recommending them on TV and social media. Then profit as prices surged after his tips. Now, this front-running scheme, which operated from January 2020 to June 2024, generated over 11.3 crore rupees in unlawful gains, which SEBI has now impounded. The group also misused media influence to sway stock prices, with evidence including WhatsApp chats and audio recordings. All accused are now banned from trading, and their accounts have been also frozen pending further action. DLF achieves another sellout with Privana North in Gurugram ranking in 11,000 crore bookings within a week. The project also marks the third successful launch under its Privana luxury brand. Located in New Gurugram, the 116-acre master plan now spans north, south and west sectors. DLF credits NRI and Pan-India demand for the overwhelming response. Units average 9.5 crore rupees with premium penthouses fetching 25 crore rupees. Now, the developer highlights growing interest in luxury and accessibility among buyers. Aris Infra Solutions IPO opened with a subscription rate of 0.10 times by midday, indicating modest initial interest. The IPO also a fresh issue of 2.25 crore rupees equity shares worth 499.6 crore is also priced between 210 and 222 rupees per share, with a minimum lot size of 67 shares. The issue will also close on June 20, with allotment expected on June 23 and listing on BSE and NSE on June 25. Following an 80 crore rupees pre-IPO placement, the fundraising target was reduced. OnePlus has partnered with Optimus Electronics to manufacture premium Internet of Things devices such as true wireless stereo earbuds and wireless neck bands at OEL's Noida facility in India. Now, this collaboration aligns with OnePlus Project Starlight, a 6,000 crore initiative to enhance localization efforts. The partnership, which began with the production of OnePlus Bullets Wireless Z3, aims to increase bill of materials, localization and reduce costs and improve supply chain resilience, strengthening India's manufacturing ecosystem. Chief Economic Advisor V. Anantha Nageswaran highlighted India's creditable achievement of maintaining a robust 6.5% GDP growth in FY24 to 25 despite global economic and geopolitical uncertainties. He projected FY25 to 26 growth at 6.3 to 6.8%, significantly surpassing developed economies. Nageswaran also emphasized on India's resilience compared to the 2003 to 2008 high growth phase and expressed confidence in sustaining momentum amid external challenges. Zydus Wellness is grappling with slow growth and margin dilution, but aims to achieve a 17 to 18% EBITDA margin in the next few years, up from 14% in FY25. CEO Tarun Arora outlined a strategy focusing on gross margin expansion and ensuring revenue growth outpaces cost, driven by premium products and cost management. Aditya Khemka, fund manager at Incred Asset Management, emphasized the importance of sustained investment in pharmaceutical sector. He highlighted that India's healthcare industry is on a long-term growth trajectory driven by rising demand, innovation, and favorable market dynamics, making it a compelling opportunity for investors. In a major development for Mumbai Suburban Rail Network, BEML has emerged as a key contender for the upgrade of the Mumbai local. The Mumbai Railway Vikas Corporation is set to re-invite tenders for the project, which includes the introduction of automatic doors and modernized coaches. This marks the second attempt at awarding the contract after the previous bidding round was withdrawn last year. The project, part of the Mumbai Urban Transport Project, is being executed by MRVC, a joint venture between the Ministry of Railways and the Maharashtra government. Ajay Srivastava, Managing Director of Dimensions Corporate Finance Services Private Limited, lauded Donald Trump's leadership, describing him as a standout global figure despite the challenges posed by his policies, such as tariffs on Indian markets. Sources have told NDTV Profit that HDFC Bank has moved the Bombay High Court seeking the quashing of an FIR filed against its CEO, Shashidhar Jagdishan. Now, the FIR was based on a complaint by Leelavati Trust, which alleges that Jagdishan accepted a 2.5 crore bribe to harass the family of one of its members. The bank has strongly refuted the claims, calling the allegation absurd. The legal proceeding could shape the next steps in this dispute as both sides stand firm on their positions. In a major push for hassle-free highway travel, Minister of Road Transport and Highways of India, Nitin Gadkari, has announced a FASTag-based annual pass. This is priced at 3,000 rupees effective August 15. The pass is valid for 1 year or up to 200 trips and is exclusively for non-commercial private vehicles like cars, jeeps and vans. The initiative actually aims to cut wait times, ease congestion, and simplify toll payments across India's national highways. Activation and renewal will be available via the Rajmarg Yatra app and the official websites of NHAI and Ministry of Railway and Roadways. In a 35-minute call with US President Donald Trump, Prime Minister Narendra Modi firmly rejected third-party mediation on Pakistan's illegal occupation of Jammu and Kashmir. Briefing the press, Foreign Secretary Vikram Misri said that Modi clarified India's measured response in Operation Sindoor targeted only terrorist camps, not Pakistan's claims of a US-brokered ceasefire. Modi emphasized India's unified stance, no mediation ever. He reiterated India's commitment to resolving the issue bilaterally. This follows Trump's repeated offers to negotiate the Kashmir dispute. The Enforcement Directorate raided multiple premises in Delhi as part of a money laundering probe into the classrooms construction scam that is alleged to have taken place during the previous AAP government. The Federal Probe Agency undertook the searches after registering a criminal case under the Prevention of Money Laundering Act, taking cognizance of a Delhi Anti-Corruption Bureau FIR. Prime Minister Modi called India-Canada ties extremely important during his meeting with Canada PM Mark Carney. The two leaders held their first bilateral talks on the sidelines of the G7 summit in Kanana's Keys. Now, Modi also highlighted the need for win-win cooperation across sectors. Carney, newly appointed in May 2025, met Modi for the first time in his current role. Discussions marked a reset in diplomatic engagement between the nations. Both sides signal intent to strengthen strategic and economic partnerships. US President Donald Trump hosted Pakistan's Army Chief General Syed Asim Munir for a closed-door lunch at the White House, just days after denying the invitation to the US Army's 250th anniversary parade. The meeting, part of Munir's 5-day visit to strengthen US-Pakistan ties, comes amid escalating Israel-Iran tensions. Munir faced protests from Pakistani Americans in Washington, led by Imran Khan's PTI supporters, who branded him a dictator and mass murderer. The visit follows a US-brokered India-Pakistan ceasefire, a claim India denies after the deadly Pahalgam attack. Mount Levo Toby Laki erupted in south-central Indonesia, sending ash clouds to as long as 10,000 meters into the sky. Now, this has prompted authorities to raise the alert to its highest level. An intense spike in seismic activity followed shortly after, with 50 volcanic quakes recorded in just 2 hours. The ash plume was visible from cities up to 150 kilometers away. The expansion of the danger zone has been marked up to 8 kilometers around the crater. While no casualties have been reported, residents have been warned of potential lava flows triggered by heavy rainfall. Well, with that, viewers, it's a wrap on Market Express, but stay tuned to NDTV Profit as there's more lined up ahead for you all.
Imports become the exception rather than the norm, and increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Benchmarks end lower but outperform the mid and small cap indices. Nifty falls 150 points from the day's high. All sectoral indices except Nifty, Bank and Auto end lower. Prime Minister Modi sets the record straight, clarifies to President Trump that Operation Sindoor was paused on Pakistan's request and not due to mediation or offer of a trade deal by the US. Road Minister Nitin Gadkari announces FASTag-based annual pass worth 3,000 rupees for hassle-free highway travel pass comes into effect from the 15th of August and will be valid for 1 year or up to 200 trips. HDFC Bank CEO Sashidhar Jagdishan moves Bombay High Court to seek quashing of the FIR against filed by Leelavati Trust, accusing him of accepting 2.5 crore rupees in bribe. SEBI board meet underway may take up some key proposals on REITs and InvITs. Simplification of QIP norms and FPI rules may also be on the agenda. Outcome expected later in the evening. Early monsoons impact summer AC sales. Blue Star expects volumes to be impacted by 25% compared to last year, while Voltas indicates a 20 to 25% dip in refrigeration, air and air conditioning volumes. Iran's supreme leader issues a war cry on X, vows to give a strong response to Israel and show them no mercy. Warning comes after Iran's Revolutionary Guard Corps said hypersonic missiles were used during the latest attack on Israel. Hello and welcome. Good evening. This is Profit 360 on NDTV Profit and I'm your host Malika Mishra. Along the next half an hour, we will bring you the latest on markets as well as national and international news. To begin with, a volatile day of trade ended with the Nifty and Sensex in the red. The Nifty barely held above the 24,800 mark, while the Sensex slipped over 150 points, surrendering its early gains. Let's now go across to my colleague Harsh for a complete wrap-up of today's market action.
Markets closed lower for a second straight day, and there was pressure largely due to the breadth, at least on the Nifty. We were down just about 0.1%, but we had 30 plus stocks sitting in the red, as you'll see the breadth on your screen. What you're also seeing is certain pockets where there is some bit of outperformance. Consumption was one of those pockets. There's also private banks which did relatively better today, and within that private banking index also it's the smaller private banks which have done better today. So those two pockets. You also had auto which did relatively better in comparison to the index, and IndusInd Bank really stood out among the banking pack, 5% higher in trade after that Nomura upgrade. But let's talk a little bit about the index itself. Outside of that, you didn't have any big moves made by index constituents. So outside of an IndusInd, largely the Nifty 50 index was fairly range bound in terms of its constituents being range bound, and there was also an unfavorable breadth in the broader markets. When you're looking at the advanced decline there, it's 2:1. And even there as well, the Nifty mid cap declined around 0.5%. The Nifty small cap largely in line with the Nifty 50, 0.1% lower on the Nifty small cap. So that's how it played out. Let me talk about sectors now. I spoke about a few. You had the Nifty Bank which outperformed today. You had the Nifty Private Bank which led that outperformance. And you had the Nifty Auto Index which was up around 1/3%, and consumption was up 1% in trade. So the Nifty Consumption Index doing fairly well for itself. What didn't do well were pretty much all of the sectors which sat in the red, but Nifty Metal was one of them, which is down nearly 1% again. And some of these have seen now 2-3 consecutive days in the red, but the Nifty IT, that in that case stands out. It was down around 0.9% in trade today, which is 0.9%. First time in 4 days where the IT index has closed in the red. So a little bit of a cool off that you're seeing on that particular counter. When you're talking about specific stocks, you have something like a Sterlite, a Happiest Minds, which closed deep in the red. And of course, there were certain gainers as well. A Vedanta was okay, but a Hindustan Zinc, where there were blocks where Vedanta sold, was also one of the top losers on that BSE 500 list.
Right, thank you so much for wrapping the market for us, Harsh. And moving on, imagine cruising down the highway without worrying about toll booths or cash payments. The Transport Ministry's latest initiative makes hassle-free travel a reality, as they have now introduced the FASTag-based annual pass, which is priced at 3,000 rupees and offers a 1-year validity or up to 200 trips. Speaking about the same, Transport Minister Nitin Gadkari says that the announcement aims to make travel seamless, affordable and convenient for all. Listen in.
3,000 रुपये में जो पास है साल भर का, उसकी अगर टोल पे किया जाएगा तो उसकी कीमत कम से कम 10,000 से ज़्यादा रुपए का टोल देना पड़ता था, वो केवल 3,000 रुपये में होगा। और ये जो वैलिडिटी है, 1 साल में 200 ट्रिप वो क्रॉस कर सकते हैं। इसके साथ साथ एक ट्रिप मीन्स एक टोल को क्रॉस करना। इसका फ़ायदा ये होगा कि 200 ट्रिप्स यानी 200 टोल क्रॉस करना होगा, और एक टोल क्रॉसिंग की एवरेज कॉस्ट केवल 15 रुपये पड़ेगी। कुछ जगह पर ये 80 रुपये है, 50 रुपये है, 100 रुपये है। तो ये केवल 15 रुपये हो जाएगी। और मान लीजिए एक टोल पर आप 50 रुपये भी देते हो तो 200 टोल क्रॉस करने पर उसकी कीमत 10,000 होगी। उसके बदले में आपको केवल 3,000 रुपये में ये पास मिलेगा, एनुअल पास।
Well, now let's go to my colleague Aishwarya, who is going to give us more details about this exciting pass and what changes for you and I as commuters.
Well, you heard the Union Minister for Road Transport and Highways, Nitin Gadkari, giving us a comparison of how it will be cheaper for private car owners or the non-commercial ones, of course. But here are a few things you need to know about the new FASTag pass. Now, the launch date, of course, will be effective from the 15th of August 2025. Pricing is set at 3,000 rupees per year. And of course, this annual pass will last you up to 200 trips or almost a year, whichever ends earlier as you go by using this particular pass. Now, eligibility, the pass is free for non-commercial private vehicles such as cars, jeeps, and vans, and 3,000 per year is the cost of that, of course. And it is valid, like I mentioned, for 200 trips or over a year, whichever ends earlier. Now, what does it do? It aims to provide seamless and cost-effective travel on the national highways across India. It gives you digital access through its Rajmarg Yatra app and official NHAI as well as Ministry of Road Transport and Highways websites. Now, the policy target is to address issues with these closely spaced out tolls within 60 kilometer or so, which offer a single and simplified toll payment. Of course, this will reduce congestion and also your toll time, even disputes at toll plazas that happen more often than not when you see and you are standing in a queue at a toll plaza. So this is all you need to know about the annual toll pass. And of course, like the minister mentioned, it will be cheaper for you as a private car owner if you go for this pass as compared to 10,000 on a yearly basis. That's an estimate figure that they have given for these private car owners and the general public at large.
Right, Aishwarya, thank you so much for explaining us whatever this new pass entails. But to discuss more on this, I'm now being joined by Dr. Kamal Soy, member of National Road Safety Council of Ministry of Road Transport and Highways. Thank you so much, Mr. Kamal Soy, for joining us this evening.
You're welcome. Thank you. Thanks for having me.
Thank you. My first question to you, sir, would be, yes, this initiative to have an annual pass is convenient, but how would you define the pricing of 3,000 rupees for 200 trips? And is it going to make a huge difference to the pockets of daily commuters? And what do you think was the rationale behind deciding the price and the number of trips? Because that is making us and a lot of viewers, I'm sure, very curious.
Number one, this is today is a historic day in the history of Indian transportation industry. World over, this has not happened. But in India, to ease congestion, to see that the road users are not put at unease, they can seamlessly move through the toll plazas. Now they don't, no more queues, no more stresses. In fact, there was a study done by IIT Kolkata and IM Kolkata and TCI, which said about 70,000 crore of rupees is wasted in traffic congestion, traffic jams, and more so at toll plazas. Now, toll plazas will be, I'll say that congestion free. That is number one, and this 3,000 for 200 trips comes to just 15 rupees per toll. Now, if you go across the country, you'll find somewhere it is 200, somewhere it's 300, somewhere it's 150. Averagely, I have seen myself, we have studied enough of this, and we have seen that it is more or less 150 rupees average tolls. And for daily commuters, you see, it is very convenient. 15 rupees, you can pass through one toll plaza. And in these circumstances, government has given enough of financial benefits to the road users. And we should welcome this step. And wherever I've been now, this is my 6th or 7th TV interaction since morning, since it has been announced by the minister. Everybody is so happy and people are delighted about this. And more the people who are using this toll plaza quite often. And moreover, what you can do is it's like recharging. As soon as your 3,200 trips are over in a month, or maybe in a year's time, you can recharge it for 3,000. So across the 1 year, maybe if less than 200, or if it is more than 200, you can always recharge it. It's really convenient and historic decision by Modi government. I believe everybody is welcoming it.
Right. Definitely a welcoming move, Mr. Soy. I'd like to also ask you, will banks and FASTag issuers now push users into fixed plans affecting pay-as-you-go flexibility? Do you think that's a possibility?
As of now, this is fixed, 3,000 rupees for 200 trips. What flexibility you want in this, I don't know. But as of now, you are into profits. So the consumer, the road user is at profit today, although Sensex has gone down, but your road user is at profit. So let us welcome it. What flexi plan more you want in this? And moreover, a few of my friends who are into commercial sector, they were also looking for it. I can just assure them, just wait and watch. That is also coming. This is going to start from 15th of August. Maybe by Deepavali or by end of this year, we may start this for the commercial section as well. Because a lot of commercial associations and truck unions, they've approached us and said, why don't you take it one time so that the congestion at the toll plazas is reduced and the time wastage. You see how many hours we used to wait, how much fuel we used to waste at in the queues in toll plazas. Now we have RFID tags and it will be really seamless, and you will feel the difference as soon as it is implemented. And generally we used to go abroad in European and in Southeast Asian countries. They've already implemented this, but that was not on the fixed charges that you pay already. You recharge for the 200 trips, and throughout the year this hassle-free travel across the country. So it is irrespective of the fact, whatever the amount of toll you are being. I've seen that many toll plazas, the rates are quite high, keeping in mind the kind of the expressways and the greenfield expressways. So now it will be equal for everybody, 15 rupees flat. Just move through.
Okay. Mr. Soy, I'd also like to understand from you, which sectors apart from banks and wallets and also mobility platforms do you think would benefit from such an initiative?
I tell you, everybody is going to benefit across the sectors. Which sector is not going to benefit, that I'm not able to understand. Everybody is going to get benefit out of this. And once you have this money in place with you, so people are at ease, and every sector is getting benefited.
All right.
Moreover, yeah.
Right. Thank you so much, Mr. Soy, for helping us understand this initiative much better. And definitely, I'm sure this is going to help a lot of daily commuters. Thank you so much for your time.
You're welcome. Thank you very much for having me.
Most welcome. Viewers, moving on, in a 35-minute phone conversation, Prime Minister Narendra Modi informed US President Donald Trump that the pause in Operation Sindoor was at Pakistan's request and not due to US mediation or trade discussions. Foreign Secretary Vikram Misri stated that this was the first discussion between the two leaders since the operation was paused. Misri emphasized that PM Modi firmly reiterated India's long-standing position, saying India has never accepted and will never accept third-party mediation. For further details on the call, we now go over to NDTV's Shiv Arur.
This conversation is interesting on so many levels, and there's a lot to unpack when two leaders like Modi and Trump speak for 35 minutes. Imagine how long that conversation actually is. Number one, of course, the context was set. The fact that it was a phone call and not a face-to-face meeting because Trump had to abruptly leave the G7 in light of what's happening between Iran and Israel. The fact that this is the first conversation really after Operation Sindoor. The fact that Prime Minister Modi, the big takeaway, of course, course, is, setting the record straight, clearing any doubts about the suggestion that there was mediation from the US president's side and that there was absolutely no talk of any trade or any deal or any bargaining chips diplomatically or otherwise during Operation Sindoor is something that the Prime Minister has cleared the decks on, settled the debate on, literally in a conversation with the man who made those claims, the US president himself. So it's very interesting, to see what the next steps in that conversation will actually be. Gauri, I find it interesting that President Trump, moving away from protocol as he usually does. That is brand Trump, after all. Quipping and inviting Prime Minister Modi to stop by in the United States, on his return from the G7. Obviously, that doesn't happen on a dime. The Prime Minister of India is the Prime Minister of the world's largest democracy. He's busy. He's got a busy schedule as well. He can't suddenly divert his travel plans to stop over in the United States, no matter how important that relationship is. And it is a very important relationship, but he's got other work to do. But I think what this does really, Gauri, is set the stage for that next step. I think what the Prime Minister has done in these 35 minutes is clear the air over any lingering doubts over Trump and the United States administration's role in Operation Sindoor and how what happened was a ceasefire that was forced literally only by Indian action and not because of any external mediation. That's the big takeaway from this.
प्रधानमंत्री मोदी ने राष्ट्रपति ट्रंप को स्पष्ट रूप से कहा कि इस पूरे घटनाक्रम के दौरान कभी भी किसी भी स्तर पर भारत अमेरिका ट्रेड डील या अमेरिका द्वारा भारत और पाकिस्तान के बीच मध्यस्थता जैसे विषयों पर बात नहीं हुई थी। सैन्य कार्रवाई रोकने की बात सीधे भारत और पाकिस्तान के बीच दोनों सेनाओं की एग्जिस्टिंग चैनल्स के माध्यम से हुई थी और पाकिस्तान के ही आग्रह पर हुई थी। प्रधानमंत्री मोदी ने जोर देकर कहा कि भारत ने न तो कभी मध्यस्थता स्वीकार की थी, न करता है और न ही कभी करेगा। इस विषय पर भारत में पूर्ण रूप से राजनीतिक एकमत है। राष्ट्रपति ट्रंप ने प्रधानमंत्री द्वारा विस्तार में बताई गई बातों को समझा और आतंकवाद के खिलाफ भारत की लड़ाई के प्रति समर्थन व्यक्त किया।
And moving on, HDFC Bank's CEO Shashidhar Jagdishan has sought relief from Bombay High Court in the Leelavati Trust's case against him. Let's go across to my colleague Vishwanath for more details on this.
Right, so the developments are coming in since this morning. Essentially, HDFC Bank CEO Shashidhar Jagdishan has gone to the Bombay High Court seeking a quashing of the FIR that was filed against him at the Bandra police station in Mumbai on the insistence of Leelavati Trust. Remember that Leelavati Trust actually went to the Bombay magistrate, asked the magistrate to push the police to file this case, and that's why this FIR was filed. The magistrate had at that time asked the police to look into the allegations of about a 2.05 crore rupee bribe that was allegedly paid to Shashidhar Jagdishan to harass a family member of the Leelavati Trust. Now, essentially what the story goes through is in the past there has been a lot of fights between a past set of trustees of the Leelavati Trust and the current set of trustees, and the current set of trustees are also people who are associated with a company called Beautiful Diamonds, which had loans from HDFC Bank, which the company had defaulted on. And the bank was proceeding with recovery measures against this company, and therefore its directors, which are family members who are currently part of the Leelavati Trust. And this is why this entire case sort of has taken this weird turn where members of the Leelavati Trust are saying that the bank is harassing family members of Prashant Mehta, whose father Kishore Mehta was actually one of the founders of the hospital, and his brother Rajesh Mehta, who's currently also a part of this entire trust. While these discussions are still going on, according to the bank, these allegations by the Mehta family are frivolous and only being made to defeat the entire recovery process that HDFC Bank had initiated against Beautiful Diamonds. Of course, this case will now be heard again on the 23rd of June, and we'll find out what Bombay High Court thinks of this entire matter. But suffice it to say, till now, the matter does not seem to be ending.
Right. Right, thank you so much for explaining that story, Vishwanath. And viewers, we will continue to give you the latest developments on the case. But moving on, early monsoons have chilled AC sales. Blue Star cuts output, whereas Voltas sees a 20 to 25% dip. But On the other hand, UBS and NK have stayed bullish. My colleague Mahima is joining us to unpack this cooling crisis.
Right. So, as you rightly mentioned, early monsoons is definitely a bad news for summer AC sales. Now, Jefferies did come out with an interesting note yesterday saying that Q1 last year had a high summer base, because of which earnings of all of these companies, AC retailers as well as manufacturers of components of AC, will be impacted this year. They're estimating first Q1 FY26 unitary cooling products to decline in lower double digits for both Voltas as well as Blue Star, and they're cutting the 26 to 28 FY estimates of EPS by around 6%. The next trigger for these RAC volumes could be an inventory liquidation in Q3 ahead of the new BE norms, which will come on Jan 2026. Now, Jefferies has maintained a buy on Voltas, however, rated Blue Star with a hold. They're saying that risk to reward appears better in Voltas versus a Blue Star. We also spoke to the management of Blue Star, and he did indicate that there has been an impact on volume, which could be around 25%. They've also stalled their production in terms of the first 2 quarters, and they've said that the growth of full year will be at anywhere between 10 to 15% versus that of 20%, which was earlier expected. Yesterday, Voltas also did have an analyst meet where they indicated that industry-wide there has been a dip of 20 to 25% odd volumes in terms of RAC, and a pickup is expected in June. However, the channel inventory remains elevated, around 6 to 8 weeks is the channel inventory, and companies are also giving out freebies in order to boost their AC sales, and despite the subdued demand, these companies are refrained from taking any broad-based price cut.
Right, and SEBI's board meet is currently underway with major reforms on the agenda. Key proposals include the rules related to REITs and InvITs, QIP paperwork, and even FPI norms. Some changes on alternative investment funds are also expected. My colleague Charu is now joining us to explain us what this key meeting will entail.
Hi, so the Securities and Exchange Board of India is currently having its board meeting, and there will be a presser conducted around 6 p.m. So several big ticket topics are supposed to be on the agenda. For example, the co-investment opportunities for the AIF industry. Now, as per the proposals that were released about this means that the investors in an AIF will be given opportunity to invest and get more additional shares in the investee company. Apart from this, there are also discussions likely to happen regarding treating REITs and InvITs asset class as equity. Apart from that, there could be some easing of norms regarding delisting of public sector undertakings, government firms. Apart from that, also some sort of relaxations for founders of startups could also be seen in terms of them being allowed to have employee stock options. Until now, it is only something allowed for the employees or the staff members of a company that wants to go ahead and get listed. Now, if a startup wants to get listed, the founder can also have ESOPs. Apart from that, filling up the vacant ED positions or dealing with the NSEL scam settlements are other things that could also be discussed. Let's see how it rolls out.
Right, Charu. So very clearly some very important proposals to look forward to from this board meeting. But turning the gaze to an international story, as the conflict between Israel and Iran continues with higher intensity, US President Donald Trump today demanded Iran's unconditional surrender. 5 days have passed and America is giving mixed signals of its involvement. Trump, in fact, also wrote on Truth Social that they now have complete and total control of the skies over Iran. To help us understand the latest developments from the ongoing tensions between the two countries, let's go across to my colleague Mohammad Kasali from NDTV.
Just a short while back, we heard the Supreme Leader of Iran, Ayatollah Khamenei, in a televised address issuing a counter statement to what US and Israel have said. You rightly pointed out the way Mr. Trump said that we know where Mr. Khamenei is hiding. We will not kill him now, but we can do it later. And also the way US has been backing Israel. It was very much expected that Mr. Khamenei would address the nation. And just a short while back, he issued a statement saying that any kind of attack which Iran is facing right now will be met with greater resistance. He also called out US that if it continues to support Israel, even the forces of US will also, or their military assets, will also come under attack from Iran. That also kind of shows that Iran is not going to back down. This was acknowledged by one of the top Israeli military officers recently when they spoke to NDTV, that Iran is a kind of adversary that it is not going to take anything lying down. And that is why, as the war enters into the 5th day, both the countries continue to attack each other.
Right, Ghazali, thank you for giving us that update on the ongoing Iran-Israel conflict. But viewers, that's all the time we had on this edition of Profit 360. But do stay tuned to NDTV Profit as we continue to give you a lot more updates on everything that you need to know.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV.
Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Mahima Vachajani, and today we're going to be speaking with as well as analyzing an interesting company, because that stock has just gone up 6% today on the back of Parag Parikh FlexiCap buying 7% in the company. It's a 12,000 crore market cap company, and that's why, in fact, both Mahima and me are quite excited with regard to analyzing this one today, because one, it's FMCG and therefore Mahima is excited, but second, I'm excited because Parag Parikh has just bought 7%, so works well. Okay, so that's how the setup is. But let me talk about what I want to know. And yes, Parag Parikh has bought 7%, but that does not mean in any fashion that you should too, and that's why we've tried to analyze this today the best we can. Let me first start off by understanding what's happening. One is you've seen raw material cost pressures, Mahima,
Right.
due to which we've seen margin compression in recent years.
Can that unwind? And management has guided for better margins going forward. But what are the levers and how much comfort is there is what I would want to understand. And again, we'll contextualize it by showing you the last 3 years' numbers as well and how the numbers have evolved. That will give you better perspective. But that's one piece I want to understand. The second one is, therefore, what the margin trajectory will be. They've said 2 to 3 years. They've said around 17 to 18% margins. Margins currently sit at 14%. Is it linear? Is it going to be an up and down? Is it going to be a gradual increase? And what gives them that confidence? We'll understand all of that. Also, can they hold on to market share? Most products, they have an impressive market share. You would have heard of a Nycil powder, the prickly heat powder. You would have heard of Glucon-D. They have large market shares in some of these products. So can they hold on to that large market share? Because once your market share crosses a certain threshold, it becomes difficult to maintain that.
True.
Really. And every new entrant will start chipping on to that market share. We've seen that in PSU banks as well, all those years ago, with HDFC doing that for over a decade. Now let's talk about the rural versus urban interplay. You've started to see a pickup in rural, and management commentary also suggests that. Does that mean lower margins for them as rural picks up? That's one piece. Second, what does that do to growth? So both of those levers is interesting. So growth expectations in the medium term. We've seen FMCG players demonstrate very sluggish growth. Mahima has been super disappointed for 2-3 quarters in a row. Want to see whether this one has something different in store. But Mahima, why don't you start off by describing everything about the company?
Right. So just to start with and give a perspective as to what the company does exactly, Zydus Wellness basically began its journey as India's leading consumer wellness company. It integrated basically the consumer company in basically the OTC market as well. It launched India's first zero-calorie sweetener, that is sugar-free, in 1988. Everybody knows the sugar-free brand per se. So Zydus Wellness is the pioneer of starting sugar-free as a brand.
Production team should have Katrina Kaif here, because I'm not so sure as to why they have this background. Guys, if you all are listening, this is not okay. But anyway,
okay,
so sugar-free.
And considering the kind of distribution network that they have, the reason as to why Zydus Wellness has done better than most of these FMCG companies is because they are very well penetrated in the rural markets, and they're also set to further penetrate in the rural markets. They've got roughly 1950 plus distribution points, plus they have 6 lakh plus direct reach points as well. They're present in more than 2.8 million stores now. So that includes your large format stores, your quick commerce, your grocery retail stores. That amounts to a big number, and especially in rural areas. In terms of how their manufacturing capacities, at present they've got 4 manufacturing facilities that is spread across Gujarat, Uttar Pradesh as well as Sikkim. In terms of how the business segments are divided, they're divided into 2 parts, that is your food and nutrition and personal care. Food and nutrition includes your Glucon-D, your Complan, your Nutrilite, sugar-free Amlite, and your personal care includes brands like your Nycil, Everyouth, etc. So these are basically the products, but Harsh, give us some perspective as to how the market share pans right now.
Yeah, so let's pull the previous, there you go. So so that's on the market rank. Yes, this is the market share. Just look at the market share of some of these. 59% is the Glucon-D market share in that product category. Nycil is nearly 34% market share. Some deep brands with some very good recall, and generally in FMCG that's what you want, right? You want large brands with very, very deep recall. If you really had to think of a powder, there are very few powders available, and you would go to the one which you have always gone to. And if Nycil is that powder for you, and was the powder for me at least, of choice, and therefore you would the recall would always be to go to that brand which you've always used. Complan is the one pain point, as you can see, in terms of market share, just 4%. You'd want something, a bit of a fillip with regard to that number in terms of Complan. But outside of that, you look at Everyouth facial cleansing. Everyouth scrub has a 49% market share in the scrub market. And you also have Everyouth peel off, which has a 77% market share. So some very, very strong brands. And I want to quickly also highlight a couple of other brands. One is Sugar Free, which again has a very strong brand presence. And along with it, there's Amlite, which also has a very strong brand presence. And then there is Nutralite. If you recall, Nutralite within the butter segment, within the premium butter segment, has again very good brand recall. For those who use Amul, of course, that's big competition for Nutralite, but Nutralite is the other one.
Yeah, and in fact, they've very well penetrated in the restaurant business and your hotel business. That's where their major chunk of revenue for Nutralite comes from.
Yeah,
so that's
the hotel, catering and restaurant, that Horeca segment, they've done very well in. And then you have RightBite, which they've acquired, which is Max Protein. Now again, Max Protein has such a strong presence. Nearly every chemist shop, every Kirana store has a Max Protein lying there in front of you. So great recall in terms of brand. And this one is poised for growth. That's one. And second, it's also got margin upside to it. They're currently doing single-digit margin on Max Protein. So it's in the growth phase. So that's one product you want to keep your eye out on as well. But those are all the brands that it owns. So a large brand presence for 12,000 crore is what I'm trying to highlight for you. Now, in terms of market rank, this is obviously as per company estimates, which is reflecting on your screen. It also has international presence. It has presence in the Middle East. Growth trajectory is good, targeting 8 to 10% of revenue in the next 4 to 5 years from international. And Sugar-Free franchise and Complan constitutes around 85% of the overall international business currently. So there's plenty of tailwind for other businesses to pick up. But let's start off with the key metrics and let's see how the company has done in the last 3 years. Let's start off by analyzing which metrics we look at for this company. We'll start off with the income statement. We'll look at the balance sheet, cash flow. We'll look at return ratios as well, shareholding, street cred, street coverage, and valuations. We'll look at all of those 8. I'll toss it to Mahima, income statement.
Right. So for income statement, in the past few odd years, in terms of the revenue, the CAGR growth has been 10%. But considering that it's an FMCG company, we've seen that all of these major FMCG players have equally not done very well when it comes to the sales CAGR. I mean, if you pick up something like a HUL or a Nestle or a Britannia, you'll see that the CAGR growth has been anywhere between that 4 to 5 or 6 odd %. Versus that, overall Zydus Wellness has done well in terms of comparison to peers, but it still stands at a 10% CAGR growth. In terms of EBITDA growth, that has been just 3 odd %, so that is at par with how other FMCG companies have done. Margins have improved a tad bit in FY25 to that 14% mark, but there was a point of time when they were at that 17 odd %, but management has guided that in a couple of years they'll get to that 17% odd mark. And net profit 3-year CAGR has been around 4 odd %, which is also very similar to how other FMCG companies are doing. So just because it is not a very impressive growth, we've given this a thumbs down for now. But in terms of the overall segment growth, personal care has grown around 6.5% CAGR growth. 16.5% CAGR growth, and food and nutrition has seen a CAGR growth of around 8 odd %. It's interesting because food and nutrition for FY25 especially has not done well for most of these FMCG companies. I mean, you take something like an HUL, your Nestle, your Britannia, all of these companies have in fact seen a degrowth. In terms of EPS trends,
any reason why that is so?
I think it's just the demand that's not picking up. People are not spending on food because that is counted as a discretionary spending. So hopefully, I think Q1 and Q2 will see a better growth in the food and nutrition segment.
And with rural pickup, does this segment?
Not really. That's actually an urban segment that plays well when it comes to food and nutrition because they are the ones who can spend more on healthy or better eating. All right. In terms of EPS trend, it's been a steady set of growth when it comes to the overall EPS growth. Dividend payout is also, decent here because if you look at the overall trajectory, it's been anywhere between that 10 to 12 odd % every year for Zydus Wellness. This year also they've declared a dividend payout ratio of around 11 odd %. So all of this is with regards to where income statements stand, but just because it's not as impressive as it can be, we've just given it a thumbs down.
Yeah, so margin recovery is something we'll await, but at the moment margins don't look as good, right?
Yeah.
The decline in margins is quite steep from 17 to 14, sub 14%. So maybe that, and I just want to probably take a minute to explain dividend payout. Let's look at the dividend payout numbers. And thereafter, there you go. So that's the percentage, and that's the percentage, and remember those percentages, on the EPS. So you want to keep your eye out that this is not on market price, but it's actually on EPS. Let's pull up the EPS numbers as well, and that gives you a sense of what that dividend distribution number would look like, around 4 to 5 rupees a share roughly. But now let's quickly look at the balance sheet, and I'll keep this real quick. Very low debt, all of which is short term, around 100 odd crore, now 12,000 crore market cap, and therefore no concern there. Look at the cash balance, also quite decent, 75 odd crore of cash on 100 crore of short term debt. No concern with regard to that. Your other equity is growing nicely because you have your reserves and surplus, which is burgeoning, and therefore no concern there as well. It's trading at roughly 2 times price to book, and therefore not looking as expensive from a price to book perspective either. Cash flow, Mahima.
Right. So cash flow, we were discussing this earlier as well, and it's a good set of numbers where cash flow from operation has seen a good trajectory of growth as such. Even the overall cash flow to PAT, the ratio that we've seen has been on an increasing trend. It stands at almost 100% in FY25. Net cash flow, however, negative, but since Harsh and I were discussing earlier as well that because the overall operating cash flow to PAT ratio is quite impressive, the negative cash flows don't matter. So that's the reason as to why we've given a thumbs up to cash flow.
Yeah, but what therefore matters is your return ratios.
Correct.
Because what happens is your cash flow gets reinvested into the business, and what you want is your return ratios to be good, because if the cash flow gets reinvested into the business on high return ratios, it's incrementally good for a shareholder, which is likely you, and therefore you want a high ROC when you have all of that cash flow getting reinvested into the business. But doesn't seem like that. Look at the way in which cash flows have moved, or rather return ratios have moved, just about 6 odd percent, or between the 5 to 6.5% threshold. I'd like to correct the FY21 number, that's not 3%, it's probably 6.3%, I'll come back to that. But broadly, it's between that 5 to 6.5% number. So I'm going to quickly get to that. But broadly, not looking good on the return ratios count. Shareholding.
Right. It's a well-held company. It's a fairly well-held company. The promoter holding has gone up from that 66% mark in March 22 to around 69% mark in March 25. FII's holding have remained stable at the 3% mark. DI holding has slightly decreased from the 22% mark to a 19% mark. Public shareholding has remained stable at that 7% mark, and overall number of shareholders have also remained stable. But of course, the big news today is Parag Parikh getting into Zydus Wellness. An interesting fact out there that they were already invested in this counter around 2019. They did exit this counter around that time and moved this counter to their tax saving fund. But again, yesterday they bought around over a 7% stake in Zydus Wellness. So that's certainly a thumbs up, considering all factors, good, well-held company plus PPFS buying the counter.
Yeah, absolutely. I want to quickly go back to ROEs. The ROE number is 3% for FY21 indeed, as per Bloomberg estimates. So that number stands. I'm going to quickly look at how street cred has evolved. 6% 1 month, of course, excluding today's move. Negative 3% 6 months, negative 2% year to date, 5% 1 year. Not looking good across the board. And you also have a 5-year return of just 53%. That's obviously because of the financial numbers which haven't added up, the last 3-year numbers we showed you, and therefore you've seen the kind of street reaction over the last 5 years not looking impressive, and therefore someone who's holding is definitely under some bit of pressure, and therefore street cred is a thumbs down. Valuations, Mahima?
Well, valuations is a thumbs up because, if you compare it to other FMCG companies, Zydus Wellness is trading at better PE multiples, although not cheap at that levels also, but still, as compared to something like an HUL Nestle, which is trading at anywhere between 60 to 75 times, Zydus Wellness is trading at 35 times, and it will further improve to 24 times in 2027 as per Bloomberg estimates. That compared to a Jyoti Labs, because it's a proper competitor of Zydus Wellness and within the same market capitalization as well. Still, in terms of the forward PE, Zydus Wellness PE seems to be more attractive than that of a Jyoti Labs, and which is why we've given a thumbs up where valuations are concerned.
This has changed because today we've seen a 6% stock move, and therefore please keep that in mind as well. Some of these numbers are as of start of day today. Last off, analyst recommendations and what the street how the street is viewing it. 5 buy calls, 1 hold call, 16% upside, maybe 10% now after the kind of move that we've seen. We've given this a thumbs up, of course, but nonetheless, something to keep in mind because that upside has shrunk very, very sharply today. Let me quickly go through all of the metrics and give you the final rating. You're looking at income statement, which is thumbs down, balance sheet, which was fairly healthy, thumbs up, cash flow thumbs up, return ratios thumbs down, shareholding thumbs up, street cred, valuation, street coverage, that's how it sums it up, and 5 out of 8 on our KYC ratings. Let's go across. We had a conversation with Tarun Arora, who's the CEO at Zydus Wellness, to talk to us about how he expects the future to pan out. Listen in. Your margins have recovered from that low of FY24. Give us perspective. There's inflation in the system, of course. How is prices of both edible oil as well as dextrose monohydrate shaping up for you? Because that's kind of causing some bit of a drag. How do you hedge for that, and how much of that has been passed on in terms of price hikes?
So, first of all, thanks for having me on the show. And I think Zydus Wellness has had a very good FY25, coming back on a couple of years of a lot of fairly high inflationary times that we were facing across multiple parts of our portfolio. So I think as things settle down, as we had a very good summer season and some of our categories really picked up, we've been able to overcome the inflationary pressures across certain categories, certain commodities. Oil has been fairly high. You rightly pointed out. Oil has been something which was looking better about a year earlier, and then it just shot up. It further got complicated when the taxes went up and the international prices also remained high. Of late, it's been a little bit more benign, more stable, and therefore we are quite hopeful that we will be able to continue to navigate it. Most of the costs we aspire, the way we look at it, we are able to pass it on to the consumers in a calibrated way. Some of it we try to absorb by better cost management. So I think it's a mix of the portfolio so that we are able to deliver consistency on gross margin. Similarly, on dextrose monohydrate, which is basically based on corn prices, which have over last 3 to 4 years have been consistently moving up. We've been able to manage those costs through, again, better cost management on one side. On the other, we've been able to pass those prices because we are a market leader, and there is a pricing power that brands like Glucon-D and Nycil have, and therefore the dextrose prices have largely been more than covered in our gross margin. So overall, our story from a margin perspective remains positive. There will be certain challenges which we may face because of summers not being good. So it may have a product mix on the portfolio, but brand to brand, we are looking at how do we ensure that we are able to manage our gross margins and continue to build it in a positive direction for our stakeholders.
Right. Mr. I just want to understand that in terms of your EBITDA margins per se, they've started to recover. They were at 17% in, let's say, FY22. They did go down to around 13%, but FY25 they did increase to that 14% mark. Just want to get a sense that from that 14% mark, what is the kind of trajectory that you're seeing for your margins? Let's say 2 years down the line, FY27, do you think you'll be able to come back to the 17% margin levels?
Absolutely. Our journey, I think we've talked about in various forums, including our investors, is that we want to get back to our 17-18% EBITDA margins over the next couple of years. There are 2 or 3 paths that we believe that will help us get there. First of them is that gross margin expansion. So we believe that between FY21 and FY23, largely led by a significant impact on various commodities, milk, oil, practically everything went up, and most of the FMCGs we saw gross margins came under pressure, and we were no exception to that. We've been able to consolidate and improve our gross margins, and there is still scope for building another 1 to 2% gross margins in next couple of years. Furthermore, if we continue to drive our growths ahead of our costs, I do see a scope for building an opportunity around operating leverage which should help us improve our EBITDA margins and take it to closer to 18.
Mr. Arora, will it be a linear improvement? 2 to 3% odd from here. Every year 1%. Is that the way one can look at it, or will it be non-linear? That's the first part of my question. Second, you seem to be confident that margins will recover. What gives you that? Are you hedging certain raw material price concerns in a certain fashion? Is that what kind of gives you the comfort, or how is it that you're so comfortable about this?
So the way I look at it is that if I go back to about 3-4 years when our EBITDA margins were higher, I think product to product, we've been able to largely cover up for the gross margin miss that we had because of the commodity pressures. And typically, most of the FMCGs, most of us will tend to respond to the cost because we are also conscious of high inflation impacts demand. So in my opinion, we've been able to price ourselves up enough to cover most of our costs. And therefore, I do believe that there is, as the product mix gets better, as we keep moving forward, the gross margins have that opportunity to move up 1 to 2%. So that's where I'm coming from. Also, most of our actions are focused on demand improvement, demand enhancement ahead of the industry. And therefore, if the growths really sustain that we want to, we should be able to get operating leverage. Of course, I have not accounted for any disruptions that happen, which are beyond us, but those are something which you can't keep building. And there are risks every day. Today, there are more risks than a decade back because the kind of disruptions, geopolitics and stuff that we are facing today, you just can't prepare for it. So you deal with it every day. I mean, 2 weeks back, somebody would have said, what is your view on costs? And I would have said crude is all sorted. So therefore, the oil prices will stay stable and we are sorted. Now, suddenly the crude has shot up. So those are things that you cannot build in. But from a medium term, we think that our strategy of volume-led growth, a strong pricing power, good capability to procure at a consistent level will all come together to deliver this. Beyond that, what happens from the environment point of view is something which we'll deal with as we face it day to day.
Fair enough, Mr. Arora. Just want to get your sense in terms of the demand outlook, because from what I understand is that you're more penetrated in rural areas, and that is something that is actually working for you, because none of the players in the consumption space have shown double-digit growth in terms of volumes, which you in fact have. So just want to get a sense as to how the strategy is working out for you. What's the next leg of growth strategy like? Will you be concentrating more on rural areas, because now we're expecting urban also to pick up in the second half of FY26, considering the tax cuts, the rate cuts that we have in play, the 8th pay commission. What is the overall demand strategy like, and what's the outlook like?
So in my opinion, I kind of agree with you that the opportunity is both in rural and urban. Rural, of course, has been several quarters been improving over the earlier year. Urban is also seemingly getting better. Better monsoons, government support will help move it forward. And we are believing that at an overall industry level, there could be at least 100 to 200 basis points improvement in demand. Though category by category, it may be different. For us, if I really step back and say, where are we going to be doing? I think we've got badly impacted by a very poor summer season, early monsoon, because we were quite optimistic on how this, growth momentum will stay. But the current, summers have obviously impacted our growth. But if I, isolate this as a one-quarter phenomena, I do believe that most of our actions are built towards a consistent double-digit journey. On rural, we are quite positive, and we continue to increase our investments as well as our distribution. As per Nielsen, while our business is about 25 to 30% rural, our distribution is 50-50 as per Nielsen. Almost out of close to 3 million outlets that's we are available in, Zydus Wellness products are available in, half of them are rural. we continue to build forward also in this financial year. We'll further increase our small town and rural reach by increasing distribution. On urban side, while we are rejigging our distribution because the demand is also shifting substantially on neo platforms like quick commerce, etc. So while we've done rather well on that, we've got almost over last couple of reported quarters, we've almost got close to a triple-digit growths on a small base because this is still building up. We believe that urban demand will behave very differently than rural. So rural will continue to build our general trade-led deeper distribution, more towns, wider reach. In urban, as the demand picks up, we are better equipped with new formats, new innovations, and omni-channel approach to cater to this demand.
Now, we're out of time on this one, but I also asked him on revenue growth, and this is the key metric, right? Can they continue to grow revenue? They said double-digit revenue growth, and let's have the KYC rating as well. But double-digit revenue growth is what he spoke about for the next 2 to 3 years at the very least. And therefore, even if a 10% growth is to be built in, you'll have the numbers likely because he's given us the margin outlook, he's given us the top line outlook. The company doesn't pay any taxes. That's the other thing you want to look out for. But completely out of time on this edition, taxes will get paid FY28 onwards. Completely out of time on this edition of KYC. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.